quickly giving you guys an update. Yes, uh, the material which I am going to use this, that is nothing but a compilation of the past papers that will be available in our marathon video description. Okay, you can just go to our marathon video. There in the description you can download this file. All good. So with that, without making any delay, we can start. So before starting, few things. How many attempts paper will be covered in this, sir? Last 15 attempts papers are covered. That is 2018 May. The new syllabus, that is not this new syllabus. Before that, one new syllabus came, no? From that attempt till your Jan attempt, Jan 2025 attempt will be covering in this. Yes. So sir, this is for whom, sir? This is for those people who are confident about concepts, but they want to solve more and more questions before going to exam. For them, this video will be useful. Sir, till what time it will be there, sir? Even to be frank, even I don't know. Even I don't know till what time it will be there, till we complete this. Okay. I hope you guys will have energy till there. Yes. With that, we can start with May 2018 paper. We can start with May 2018 paper. Yes, guys. Measure. Once again, whoever joined now, I'm telling you guys, if you want this file, all you have to do is go to our marathon video. There in the description, the drive link will be there. Download it from there. Okay, got it. Going to the first one, A. Measure X Private Limited is manufacturing a special product which requires a component sky blue. So, Measure X Private Limited is a manufacturing special product which requires a component sky blue. The following particulars are available for the year ended 31st March 2018. They have given an annual demand, they have given cost of placing order, they have given a cost per unit, and they have given carrying cost per annum. They have given carrying cost per annum. The company has been offered a quantity discount of 5% on the purchase of sky blue, provided the order size is 3000 components at a time. So our supplier is offering us quantity discount if at all we buy the like annual requirement at 3000 per order, 3000 units per order. You are required to calculate the EOQ, advise whether the quantity discount to be accepted or no. Very simple, guys. EOQ, what is the formula for EOQ? EOQ is nothing but square root of 2AO divided by C. So A is what, sir? Annual demand. Basically, sometimes this annual demand could be there as annual requirement. Basically, annual requirement. It could be there as annual consumption, or sometimes it will be annual purchase also. Sir, consumption is also there, purchase is also there. What we should consider, sir? You should consider purchase, because this is relating to purchase. Okay, done. O is what, sir? Ordering cost per order. C is what, sir? Carrying cost per unit per annum. Carrying cost per unit per annum. So this is your EOQ. That is square root of 2 into A. Annual demand is 12,000 and there is no other information is there. So I am going to consider 12,000 components itself. That is one component per unit. Yes, requires a component sky blue. A special product which requires a component, which means one unit takes one component. So that is 12,000 components into ordering cost, which is basically 1,800 divided by carrying cost will be how much, sir? Very simple, 640 into 18.75 percentage. So basically, guys, 640 into 18.75 percentage, which will come to 120 rupees. So 2 into 12,000 into 1,800 divided by 120, square root of that, which will come to 600 components. That is, if at all you order 600 components per order, then your total ordering cost plus total carrying cost per annum will be least. will be least. Advise whether the quantity discount to be accepted or no. Very simple, guys. I am going to calculate my total cost. My total cost per annum under both. First, purchase price. Purchase price will be pretty simple. 12,000 units is required, and in the first case in EOQ as well as in the offer. In EOQ, guys, in EOQ, basically, how many components we are buying, sir? 12,000 into 640, around 76 lakh 80,000. Around 76 lakh 80,000. Whereas at the quantity discount, they are giving it as 5% discount, which means 640 minus 5%, which is 608. So guys, 12,000 into 608, which will be 72 lakh 96,000. This is your purchase cost. Done, sir. Next is what? Next is your ordering cost. That is, at EOQ, how many orders to be placed? 12,000 divided by 600 units per order. We have to place 20 orders. Whereas in our offer, 3,000 components per order means 4 orders. Always remember, guys, if at all it is in decimals, whether it is 0.1 also, you should go to the next number in case of number of orders, not rounding off to the nearest zero. You should go to the next number. Okay. Why, sir? Why and all I have told in marathon as well as regular class. You can go and watch it there. I hope if you are watching questions discussion, then you know about it. So, 20 orders, and each order is 1,800, which will come to 36,000 in case of EOQ. In case of this one, 1,800 into 4, which will come to 7,200. Sir, two things we have seen. That is the least. So better accept the offer. Let's see. Next, guys, next one, carrying cost. Always remember, annual carrying cost will be half of, not annual requirement, guys, half of order size into carrying cost per unit per annum, that is, in case of EOQ, half of 600, 300 into carrying cost per unit per annum is 120, which will come to 36,000. Always remember, your total, ordering cost and carrying cost in EOQ will be same. Done. Next, half of 3,000, that will come to 1,500 into, guys, carrying cost. Be very careful here. Why? Because it is not 18.75% of 640, guys, it will be 18.75% of 608. Here majority of the students will do the mistake. Always remember, it is at the purchase price, whereas when the quantity discount is offered, purchase price is 608 into 18.75 percentage. 114 rupees, 114. So 114 into 1,500, which will come to 171,000. So total cost under EOQ as well as offer price will be 76 lakh 80,000 plus 36,000 plus 36,000, which will come to 76 lakh 52,000 and 72 lakh 96,000 plus 7,200 plus 171,000, which will come to 74 lakh 74,200. Sir, which is better? Of course, as the quantity discount 5% is giving us so much, it is better to go for quantity discount. It is better to go for quantity discount because the price under that is least. I hope the first one is clear. With that, we can jump into the second one. Right? We can jump into the second one, guys. Not in this PDF is not available in this video, guys. PDF is available in our marathon video. Okay, just go to our channel, you will find the marathon video very easily. So there you can download it. Done. Yes. Next, a worker takes 15 hours to complete the piece of work, for which time allowed is 20 hours, which means this is standard hours, this is time taken, standard hours and time taken, and his wage rate is rupees 5 per hour. So hourly rate is rupees 5 per hour. Following additional informations are available. Material cost is 50, factory overhead is 100% of wages. Calculate the factory cost. They're asking you to calculate factory cost under row 1 method, under Halsey method. Guys, factory cost is very simple. Direct material, direct labor, factory overhead and direct expense is there, that will also come. Together it will give you factory cost, correct? Now, direct material under both Halsey and row 1 it will be same, 50 and 50. However, direct labor will change in the Halsey as well as row 1. Why, sir? Direct labor cost under row 1 will be hours work, or you can take it as, tell it as time taken into hourly rate. Halsey also time taken into hourly rate only. However, what Halsey tell, give the bonus to the extent of 50% of the time saved. That is time saved into hourly rate of that, half of that. Whereas in row 1, guys, it is, he is telling, boss, listen, the efficiency should not go beyond 200%. That is, our employee should not save the time more than half of it. So what you should do, till it reaches half, encourage them. After that, discourage them. What do you mean by that, sir? 50% till 50%, fine. Under row 1, the bonus will be more. However, after 50%, if you save the time for more than 50% of the time allowed, then automatically your bonus will start decreasing. Under Halsey, not this the case. Under Halsey, the time will keep on increasing. Not time, bonus will keep on increasing. So here it will be time saved divided by standard hours into time taken into hourly rate. In the first case, under row 1 case, guys, time taken 15 hours, hourly rate 5 rupees plus time saved. If the standard hours were 20, time taken is 15, which means 5 hours are time saved out of 20 hours allowed into time taken is how much, sir? 15 into hourly rate is 5. So under row 1, it will be 15 into 5, m plus 5 divided by 20 into 15 into 5, m plus MRC 93.75 under row 1. Under Halsey, how much, sir? Under Halsey, it will be 15 into 5, m plus 5 divided by 20, or 15 into 5 plus half of time saved 5 into timely rate, hourly rate 5. So it is, guys, 75, that is 5 into 15, 75 plus half of 15, 12.5. 75 plus 12.5, which will come to 87.5, and they are telling factory overhead is absorbed at the rate of 100% of wages, where it will also be same 93.75, 87.5. So total factory cost will be 50, or you can tell 93.75 into 2 plus 50, which will come to 237.5, as well as 87.5 into 2 plus 50, which will come to 225. 237.5 and 225. This will be your Halsey and row 1 total amounts, that is total factory cost under HAL C as well as under row 1. 237.5 and 225. Going to C, following figures have been extracted from the books of measure RST Private Limited. To financial year they have given, sales they have given, profit or loss they have given. You are required to calculate PV ratio, fixed cost, break even point, sales required to make the profit of 45,000, MOS for the year. Guys, very simple. Always remember one thing, change in profit divided by change in sales will give you profit percentage. One more thing you have to remember, your profit percentage will be equal to PV ratio. Profit percentage will be equal to PV ratio, which means if I consider the change in profit now, minus 15,000 minus 15,000, which is basically change in profit is 30,000, divided by change in sales 1 lakh, I will get the profit percentage. At the same time I will get PV ratio also, which is 30%. PV ratio is 30%. Done. Sir, fixed cost. Hey, fixed cost you can apply to any of this. Fixed cost you can apply to any of this. What do you mean by that, sir? Let's apply to this 5 lakh. Guys, 5 lakh into contribution percentage, that is 30% PV ratio, will give you contribution, right? That is 5 lakh into 30% is 1,50,000. Guys, from the contribution, if you reduce a fixed cost, you will arrive at a profit which is 15,000. So, can I tell my fixed cost is 135,000? My fixed cost is 135,000. Done, sir. What about break even? Guys, break even point. Break even point is nothing but fixed cost divided by contribution percentage. If you want it in a amount, if at all you want it in percentage, I mean rupee, if at all you want it in units, that will be fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. Guys, how much is a fixed cost? Fixed cost is 135,000 and contribution percentage we know 0.3. So 135,000 divided by 0.3, which will give me 450,000, or you can tell it as 4,50,000. My break even is 4,50,000. Sales required to earn the profit of 45,000. Very simple, guys. Let me take the sales as S. So 0.3S will be the contribution at which we are going to make the profit of 45,000 minus fixed cost. Fixed cost is 135,000. Yes, sir. Will give me the profit. How much it should give? The profit should be 45,000, which means 180,000 divided by 0.3, 6 lakh. Rupees 6 lakh. Sir, what is the MOS of 1718? Margin of safety, guys, you can find it out in two ways. One is profit by PV ratio, or you can go for total sales minus break even point. Total sales minus break even point. Guys, always remember, break even point won't change unless and until your either fixed cost will change, or variable cost per unit will change, or your selling price will change. In the given scenario, nothing is changed. So break even point will be your 450,000 only, whereas total sales in that year is 5 lakh. So around 50,000 is your margin of safety, or else you can tell it as, sir, our profit is 15,000. Yes, our PV ratio is 0.3. 15,000 divided by 0.3, which will give you 50,000. You can go for that also. I hope it is clear. Marginal costing question. PV ratio 30%, break even 450,000, and sales to make the profit is 6 lakh, and MOS is 50,000. Sir, how come 50,000, sir? It should be 1 lakh 50, no, 6 lakh minus 450. Try to understand. This is desired sales. This is not actual sales. Actual sales is 5 lakh. They have given in the question. So you should find out the difference between those two. Done. Next is what, sir? GK Limited showed a net loss of 2,43,000 as per their financial accounts. Great. However, cost account disclosed net loss of 248,300 for the same period. On scrutinizing both set of book, following informations were revealed. What is it, sir? Works overhead over recovered 30,400. Works overhead over recovered 30,400. Actually, it is not 30,000, 30,400. Selling overhead under recovered, they have given 20,300. And depreciation, admin overhead under recovered, depreciation, bad debt, preliminary expense written off, interest credited during the financial accounts in the year. In financial accounts, prepare the reconciliation taking cost net as a base, which means your starting point is cost book. Generally, you can start with anything, but in the given question, they have asked you to start with the cost books. They have asked you to start with the cost books. So guys, we are going to take the cost book as a base book. We are going to take cost book as a base book. What do you mean by that, sir? Starting point is net loss of costing, which is 2,48,300. What we are trying to arrive at? Trying to arrive at net loss as per financial accounts. First, works overhead over recovered. Works overhead over recovered means in the cost books, you showed more expense. How much? 30,400. But in financial books, it is showed less, which means in financial books, loss is less. So now you should reduce the loss of cost books also. Basically, whatever is done in financial books, you should do that. Whatever is not done in financial books, that you should reverse. Now you should reverse, which means earlier you showed more expense. More expense means more loss. Now reduce your loss by 30,400. By 30,400. Done. Selling overhead under recovered. Selling overhead under recovered. What do you mean by this, sir? Guys, selling overhead under recovered is you are showing less expense in costing. You are showing less expense in costing. Less expense means you showed less loss. Increase your loss at 20,300. Administration overhead under recovered. Same. You showed less expense. Less expense means less loss. Less loss means increase your loss. 27,700. Depreciation overcharged. More expense in costing. More expense means more loss you showed. More loss means reduce your loss. 35,100 loss you should reduce. And bad debt written off in financial accounts. Only in financial account you showed some expense that is not there in the cost accounts. That is not there in the cost accounts. Now show it, which means increase your loss 15,000. Preliminary expense, same, increase your loss by 5,000. Interest credited, there they showed some income. If they showed income, their loss will be less. Here also reduce the loss. Now we will arrive at financial loss. That is 248,300 minus 3,400 plus 2,300 plus 27,700 minus 35,100 plus 15,000 plus 5,000 minus 7,500, 243,300. 243,300. I hope it's clear. With that, one compulsory question of 20 marks is done. Now, going to the second question. Following information relating to the manufacturing concern for the year ended. So they have given 1 year data. Raw material opening Sir, where it will come in the cost sheet? They are asking you to prepare a cost sheet. So where it will come in the, always remember guys, whenever the question is big, all you have to do is, you should first check what they have asked in the question. Then you should just start answering according to that. Reading question in that first 15 minutes is very, 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 very important. Now, raw material opening, where it will come, sir? Raw material consumed. Raw material closing, raw material consumed, purchase of raw material, again it will come in the raw material consumed. Sir, freight inward, again you can treat it as a cost of purchase for the raw material, direct wages paid, it will come as direct labor, direct wages outstanding. Guys, always remember, expense will be on accrual basis, not on the incurrence basis, which means this both is your labor cost. Factory overhead, 20% of the prime cost. WIP opening, WIP closing. Administrative overhead related to production is 173,000. Distribution expense is rupees 16 per unit. Finished stock is so much. Sale of scrap is so much. The firm produced 14,000 units of output during the year. Always remember, when you are calculating per unit, till the cost of production, it is per unit will be calculated on a units produced. For opening stock, you will calculate opening stock. For closing stock, you will calculate it per unit of closing stock. For goods sold, you are going to calculate it on sold unit. For admin general, sold units. For selling and distribution, sold number of units should be considered for calculating cost per unit. Firm sold 14,153 units at a price of 618. Prepare a cost sheet. Very simple guys. Raw material consumed. First, direct material. Direct material will be very simple. 228,000 opening plus purchases 25,000 plus freight inward 1 lakh minus closing 305,000. 42 lakh 48,000. Next is direct labor. Direct labor is guys 12 lakh 56,000 plus 1 lakh 50,000, 14 lakh 6,000. Next is direct expense. There is no any direct expense as such, so it will be nil, which will give you prime cost. Prime cost how much, sir? 42 lakh 48,000 plus 14 lakh 6,000, which will give you 56 lakh 54,000 plus factory overhead. Factory overhead is 20% of the prime cost. Factory overhead is 20% of the prime cost, which will come to 11 lakh 30,000. Factory overhead is 11 lakh 30,000. It will give you gross works cost. Gross works cost is how much, sir? 56 lakh 54,000 plus 11 lakh 30,000, which will come to 67 lakh 84,000. Add opening WIP minus closing WIP. Opening WIP is how much, sir? 1,92,500. Closing WIP is 1,40,700. So plus 192,500 minus 140,700, which will come to 68,35,800. This will be works cost. And also add admin overhead, which is related to production. If at all it was not related to production, you would have treated it as general, which is 173,000 guys. 173,000. So anything else is there? Nothing is there. Scrap recovery, nothing gets where is scrap recovery? Scrap recovery is there. Sale of scrap is there. Correct. Sale of scrap is there. So minus sale of scrap, which is 8,000. That will give you your cost of production. Your cost of production will be 68,35,800 plus 173,000 minus 8,000, which will come to 70 lakh 800. Guys, this 70 lakh 800, your raw material consumed and your yeah. So sale of scrap of material. See, if at all you want to treat, you can treat it two ways. One, sale of scrap of raw material, sale of scrap of goods in process. If at all goods in process you are going to reduce while arriving at COP. If at all you are going to treat it as a raw material, then you are going to reduce it from the cost of material consumed. That is from the direct material cost. Okay. You can take it in any way. You can take it in any way because they are not particularly telling which one. You can consider it as material as raw material also, no problem. However, in examination answer they have given already this tested like that sale of scrap. They have taken as an alternative answer. Two answers they have given in exam. One, treating it as scrap of raw material. Two, treating it as normal scrap. Let's say if you treat it as scrap of raw material, what we are going to do, sir? You are going to do, see FOH, I am telling you guys, here it is coming wrong or it is coming different answer compared to ICM suggested answer, because sale of scrap I am assuming it as normal in process, whereas they assumed it as raw material. Chalo, we'll assume it as raw material. Then how much it will be, sir? It will be 8,000 will be reduced here only. It will become 42 lakh 40,000 and direct labor. Okay, so it will become how much, sir? 42 lakh 40,000 plus 14 lakh 6,000. Sorry, 14 lakh 6,000, which will come to 56 lakh 46,000. Okay, factory overhead will be they are telling 20% of prime cost. Factory overhead they are telling it as 20% of prime cost into 20%, which will come to 11 lakh 29,200. Your gross works cost will be plus 56 lakh 46,000, which will come to 67 lakh 75,200. So your works cost will automatically will become plus 192,500 minus 147,700, which is 68 lakh 27,000. So scrap won't come here if you don't want it here. Okay, if you want I say suggested answer, let me do it as per that only, no worries. But yeah, in examination, if at all they clearly don't mention it whether it's raw material or in the process, then you can go for anything. Okay, so plus 173,000, which will come to 70 lakhs. Your cost of production is 70 lakhs. Now, how much is the cost to produce one unit, sir? It is 70 lakhs divided by how many units were produced? 14,000 per unit. It is rupees 500. Why it is required, sir? To value your closing stock. That is, for the COP, I am going to add the opening stock of finished goods. How much was the opening stock of finished goods, sir? 1217 unit, which is 6,08,500 minus closing stock of finished goods. Guys, how many units are finished stock closing? Very simple, guys. We had 1217 plus we produced 14,000. Total available were 15,217. In that 14,153 were sold already, which means 1064 are there, and per unit it is 500. 1064 into 500, 5,32,000 is a closing stock. You will get a cost of goods sold. That is nothing but 70 lakhs plus 608,500 minus 532,000, which will come to 70 lakh 76,500. For that, add admin overhead. Any general is there? There is no admin overhead general as such. selling and distribution overhead 16 rupees per unit, but always remember now the 16 should be calculated on units sold, not on units produced. 14,153 into 16 which will come to 2,26,448. That is your selling and distribution overhead. Now you will get the cost of sales. Cost of sales will be 76,500, which will come to guys 73,02,948 plus profit will give you sales. Sales will be how much, sir? Profit will be balancing figure, guys. Sales will be how much? Sales, they are telling each and every unit were sold at 618. That is 618 into 14,153, which will come to 87,46,554. The profit will be minus 73,02,948. 14,43,606. This will be your profit. This will be your cost sheet. I hope it is clear. Yes. Next, they have asked this one. This is basically your contract costing. Now it's not there in your syllabus. Done. With that, second question is also done. Going to the third question, guys. The information regarding number of employees on roll in a shopping mall for the month of December are given. Opening they have given, closing they have given 1 month. That is, average will be how much, sir? 900 plus 1,100 divided by 2, 1,000 employees. 1,000 employees. During December, 40 employees resigned, 60 employees were discharged. What do you mean by that, sir? Whether they resigned, whether they discharged, whatever it is, separation will be that. 300 employees were recruited, which means this is accession, guys, not replacement. Why, sir? Replacement means appointing the people to the same role. That is where the employees will leave and go, no, as per separation. If at all we refill that vacancy, that is your replacement. If at all you create a new job itself altogether due to new process or due to expansion, etc., that is your new joinees. Okay. Out of these 300, 225 were relating to expansion project, new joinees, whereas the rest, that is 75 were replacement, that is due to exit of employees. Assume 365 days in a year. Okay. Calculate employee turnover rate and equivalent annual employee turnover rate by applying replacement method, separation method, flux method. Now replacement method, very simple, guys. How much is a replacement in a given time? 75. On an average 1,000 were there, which means 7.5 percentage. Guys, best part is this 7.5 percentage is for 31 days. December 31 days, no. 7.5 is for 31 days for 365 question mark. 7.5 divided by 31 into 365, which will come to 88.31 percentage. Done. Next, separation. How many separations? 100. 100 divided by 1,000 into 100, which will come to 10 percentage. That is 10% for percentage for 31 for 365 question mark, which will come to 117.742 or 74 percentage. Flux method, you are going to consider accession, that is basically 300 employees plus separation, which is 100 employees, divided by, if the accession is not there, at least replacement you should consider. Replacement plus new joinees plus separation, divided by 1,000, which will come to 40 percentage. that is 40 for 31 days for 365 question mark. %471 or 470.97%. Hope A is clear. Hope A is clear. Done. Now going to B. Going to B. Alpha Limited is engaged in the production of product A, which passes through three different processes P, Q, R. The following data relating to cost and output obtained from the books of accounts is as follows. Process P, process Q, process R. Direct material and direct labor relating to that they have given. Production overhead 90,000 were recovered as a percentage of direct labor. So here direct labor is how much, guys? Total 30 plus 40, 70, 70 plus 50, 120. Which means basically 90,000 divided by 120,000 into 100, 75% of direct labor. 75% of direct labor. 10,000 kg of raw material at rupees 5 per kg. We issued to process P, that is opening material. After that, there will be no introduction of material, I mean direct material at least. There was no stock of material of WIP, which means opening is not there as well as closing is not there. Also, the entire output was directly transferred to the next process and to the finally to warehouse, which means opening and closing is not there. Why it is not there, sir? If the opening and closing is there, then you have to calculate equivalent units also. That's why they haven't given. There is normal wastage, that is 10% in the scrap, and 1 rupee is recovered per scrap. The total output transfer to next process they have given 9,000, 8,200, 7,300. Company fixes a selling price of the end product in such a way so to yield a profit of 25% on selling price. Process A, P, process Q, process R also calculate selling price per unit of end of the product. Sir, till what time will you be live today? Even I don't know, sir. Till we complete all the 15 attempts paper. It could be 4 a.m. or it could be 3 a.m. or it could be 12 a.m. Depends on how fast it gets completed. Now, guys, process P. Process P. To material. Guys, how many materials were introduced? 10,000 at the rate of rupees 5, which will come to 50,000. 50,000. Done. Next. Material is introduced here, 38,000. For that unit column don't take, only and only for the first raw material it should be taken in the first process. Why? I already told you in the regular class as well as marathon, you can check there. Direct labor, 30,000. Overhead is, guys, 75% of your labor, that is 30,000 into 75%. 22,500. 22,500. That will be your total cost. By normal loss. Guys, normal loss, how many units? 10% of the input, that is 1,000 units. Always remember, the recovery from the normal loss should be reduced from the cost. That is, again, 1,000. Per unit 1 rupee, no? So, 1,000 into 1. Now, by process B or process Q, how much you are transferring to process Q? They are telling 9,000, which means, guys, there is no abnormal loss, there is no abnormal gain. So, per unit, how to compute, sir? Very simple. Total cost minus scrap recovery from the normal loss. Total cost is how much, sir? 50,000 plus 38,000 plus 30,000 plus 22,500 minus, that is 140,500 minus normal loss recovery 1,000 divided by 10,000 total input minus normal loss 1,000. You will get a cost per good units minus 1,000 divided by 9,000, which will come to rupees 15.5. So I am going to transfer it at 15.5. 9,000 into 15.5, 139,500. If you see the total, both it will be 140,500, 140,500, 140,500, 140,500. Sir, please do little faster. We'll do. Once we get the flow, we'll go fast. Don't worry. Because if someone is writing along with me, for them also it should be, they should be able to write. No. Now here, from process P, we got 9,000 units at the value of 139,500. 139,500. Done. Next, material 42,500. Next, labor 40,000. Overhead 75% of that 30,000. Done. Normal loss guys, 10% of 9,000 unit, which will come to 900. Scrap recovery again 900. Scrap recovery again 900. Now guys, how much you transfer to next process? That is to process R. PQR. Process R, you are transferring 8,200. Guys, out of 9,000, if you transfer 8,200, your actual loss is 800. But your normal loss itself is 900, which means 100 is a abnormal gain. 100 is a abnormal gain. Now, always remember abnormal gain, what you should debit? You should debit the scrap recovery relating to that abnormal gain. Because that is not actually recovered. No, that's why you should reverse before you taking the amount to costing P&L. I'm talking about abnormal gain account. Okay. Now, basically, credit side you will write by process Q. Correct? You will write by process Q. But you should write 2 normal loss, that is 100 units into 100 in the debit side. Remaining you should take to your costing P&L. Always remember that point. Now, how to compute the cost per unit, sir? Very simple. Find out the total cost. 139,500 plus 42,500 plus 40,000 plus 30,000, which will come to 252,000 minus 900 scrap recovery from normal loss divided by 9,000 minus normal loss units 900. So 252,000 minus 900 divided by 8,100, which will come to 31. So 8,200 into 31, which will come to 2,54,200. Here 100 into 31, 3,100. So my debit will be 139,500 plus 42,500 plus 40,000 plus 30,000 plus 3,100 minus or 255 100. Here also you just see 254 200 plus 900, 255 100. Got it? This is your process Q. Process R, quickly I will show in the answer itself, guys. Process R 8,200 units. units at the rate of 254 200, and if you see here, direct material 42,880, direct labor 50,000. So overhead will be 75% of 50,000, 37,500. So 42,880, 50,000, 37,500. Done. Now, how much you have introduced, sir? You have introduced 8,200. Okay. In that loss should be 820. So normal loss is 820, fetching 1 rupees. Sometimes different process, scrap will fetch different amount. Keep that thing in mind. Done. Sir, Out of 8,200, if the 820 if you introduced, that is 7,380 is remaining, no. But the best part is just 7,300 is remaining, which means 80 is abnormal loss. 80 is abnormal loss. How you are going to value the abnormal loss as well as transfer to finished goods, sir? Very simple, guys. How much is the cost? 3,84,580 minus 820 recovery from normal loss, whole divided by 8,200 units introduced. In that, normal loss expected was 820. That is 384,580 minus 820, which will give you 383,760 divided by 8,200 minus 10%, 8190. 383,760 divided by wait, give me a second, 8,200 minus 820, 7380, that is 383,760 divided by 73, which will come to rupees 52. That will be the abnormal loss as well as your finished goods will be valued at that price. I hope this one is clear. Done. Now proceeding to fourth question. PQR Limited manufactures two products, gel pen and ball pen. It furnishes the following data. Output they have given, machine hours taken they have given, number of purchase orders given, number of setup they have given, annual overhead, volume related activity, setup related activity, purchase related activity. This is your overhead if at all you are going to do it as per activity based. This will be total overhead only. How much is total overhead, sir? Total overhead is 475,020 plus 579,988 plus 504,992, which will come to 15,60,000. 15,60,000. Done, sir. Now, traditional method of charging overhead. Guys, traditional method means you are going to charge on the machine hour or labor hour basis. In the given question, machine hours are available. 24,000 plus 54,000, 78,000. 15,60,000 divided by 78,000. Rupees 20 per unit. This is your traditional. Now, if at all you go to activity based costing, what you are going to do, sir? Volume related activity. You are going to apportion it. On the basis of machine hours used. Setup related, again they have given how many setups are there, and purchase related, total purchase orders. When you divide it, you will get a different cost that you are going to divide by number of units. You will get the absorption rate. I hope it is clear. Now see the next one. A group of healthcare has decided to establish a critical care unit. This is basically your same question like your the question of hospital which is available in your study material. 85 lakhs. The unit's capacity shall be 50 beds and 10 more beds can be added if required. Done. Building rent 225,000. Manager salary 3 managers 50,000 per month. which means around 150,000 per month. Nurse salary, 24 nurse are there, 18,000 per month, 24 into 18,000, which will come to 432,000. Ward boy, 24 ward boy at 9,000 per month, so monthly is 2,16,000. Doctor's payment on the basis of the patients attended and time spent by them. So they are telling doctor's cost is variable cost. Sir, why is that important? You will get to know. Food and laundry, variable. Medicine to patients, variable. Admin, see, this is for a whole year. You can take per month. Depreciation on equipment, 15% on the original cost. So equipment is here, 85 lakhs. Depreciation will be 85 into 15% like that. It was reported that 200 days in a year, 50 beds were occupied. So 200 into 50, done. 105 days, 30 beds were occupied. 105 into 30, and also 60 days, 20 beds were occupied. 60 into 20, and they are telling we hired 250 beds. So along with that, guys, 250 extra beds we hired, not per day and all, throughout the year. Throughout the year. Okay. Now, however, this never exceeded. And always remember, per bed you have to pay 950. This will come as variable cost. Find out the profit per patient day. If the hospital charges break-even point, basically break-even point, you are going to do it under marginal costing kind of thing. Sales minus variable cost, you will get the contribution, and you will minus fixed cost, you will get the profit. Now, you know fixed cost, you know contribution, you can find out a break-even patient days. Okay, patient days while calculating, this is how you are going to compute per year. Per year, as it is there in the study mat. I am not going to discuss it again, once again. Okay, going to the fifth one. The following details are provided by measure SKU. They have given opening stock, they have given closing stock, they have given purchase during the year. They are asking you to turnover as well as which is fast moving, which is slow moving. Assume 360 days in a year. Guys, first, what is the formula for inventory turnover ratio? Very simple. Cost of goods consumed divided by average material. Now, opening is there, closing is there. You can find out average. 6 lakh plus 4 lakh 50, which will come to 10 lakh 50. 10 lakh 50 divided by 2, which will come to 10 lakh 50 divided by 2, which will come to 5 lakh 25,000. Done, sir. 5 lakh 25,000. Okay. Next, 10 lakh plus 725,000, 1725,000. 1725,000 divided by 2, which will come to 8 lakh 62,500. 8 lakh 62,500. Now this is your average inventory. Done. Purchases during the year is there, opening is there, closing is there. Using that you can find out what, sir? Consumed. That is opening 6 lakh plus purchase 9 lakh 50,000 minus closing 4 lakh 50,000. Consumed is 11 lakh. In this scenario, 10 lakh plus 18 lakh 40,000 minus 7 lakh 25,000, 21 lakh 15,000. So inventory in first one will be 11 lakh divided by 525,000, which will come to 2.09, whereas your next one will be consumed 2115 plus or divided by 862,500, 2.45. Now, which is moving fast? How to ascertain that, sir? Very simple, guys. Very simple. All you have to do is find out how many days we are holding inventory. Guys, In a 360 days, if you are doing it 2.09, inventory will be held for around 172 days. Whereas next one it is 360 days divided by 2.45, which will come to 147 days. Which is fast moving? This is fast moving. B is fast moving. Going to the next one. 5 marks, they have to ask the standard costing. They have asked material cost variance. What is the formula for material cost variance, sir? Standard cost minus actual cost. Standard cost means what, sir? Standard quantity into standard rate minus actual quantity into actual rate. Always remember. And standard quantity means standard quantity for actual production. Usage will be standard quantity minus actual quantity into standard rate or standard price, whichever you want to address it as. Material price variance, that is standard price minus actual price into actual quantity. These are the three. Now, Beta Limited manufactures a product and this is manufactured by mixing two material, namely P and Q. The standard cost of mixture is as under: P 150 units, Q 100 liters, and standard loss is 20% of total input expected during the period. Guys, the cost records of the period they have given, units produced is 195. Now we have to find out standard for actual. Actual is 195. Yes, sir. Let's say standard input is I. In that, if it loses 20% of input, then it should give us 195 units. For that, how much is our standard quantity? Standard quantity for actual production, 0.8I is equal to 195. I is equal to 243.75. 243.75. Now this I am going to divide in the ratio of 150 and 100 into 150 divided by 250. 146.25 minus 243.97.5. Now guys, I can do one quick table. Standard quantity are 146.25 and 97.5. Standard price is 40 and 60. Actual quantity is, guys, 140 and 110. Actual price is 40 and 56. Using this table, you can find out all the variances what they have asked for. PH Gems is a manufacturer of a ready-made suit. It has annual production capacity of 2000. Cost is presented as follows: sale 1500 units, direct material, direct labor, overhead is 40% is fixed. Net profit: if the selling price is increased by 200, the sales will come down by 60% of the annual capacity. Should the company increase the selling price? Guys, right now we are making 466, 300. Let's see. If the selling price is increased by 200, then the sales will come down to 60%, which means, guys, I will do one thing. I will segregate this into variable cost and fixed cost. Variable cost will be 594,200 plus 442,600 and 60% of 11,97,000. $7,18,200. Now, guys, variable cost will be how much, sir? 594,200 plus 442,600 plus 718,200 divided by for 1500 units. 594 200 plus 44 4,42,600 plus 7,18,200 divided by 1500. 1170. This is your variable cost per unit. Correct? Now, guys, contribution. First, sales will be how much? Sales will be increased by 200, which means selling price will become 2000. Sales will come down by 60%. Come down to 60%. That is 1500 into 60% will be our new sale. 900. Should the company accept the offer or no? Very simple. 900 unit will fetch you 2000, which will come to 18 lakhs. Okay. Minus variable cost. I have already calculated. Variable cost as 1170 into 900. 10,53,000, which will come to minus 18 lakh 7,47,000, which will come to 7,47,000. From that, if I reduce the fixed cost, which is 11,97,000 into 40%, 4,78,800. Seven lakh 47,000 minus 4,78,800. 2,68,200. So we are going to get a profit of 2,68,200, which is less than 4,66,300. So it is better not to do any changes. The company can earn a profit of 20% on sale if the company provides a type-in with the ready-made suit. The cost of each type-in is rupees 18. Calculate the sales to earn the profit of 20% on sales. So guys, sales will remain same. That is 1,500 units into 1,800. 27 lakhs. That will be your cost. Now, variable cost excluding type in is 1170. Including type in, it will be 18. 1188 into 1,500. 17 lakh 82,000. 9 lakh 18,000 minus fixed cost, which is 4 lakh 78,800. 4,39,200. So new profit is less than again, so better not to go for it. See here. So hope it is clear. So we took 90% somewhere when calculating what I have taken. Oh, sorry. Actually, I have taken 60% of 1500 units, but you should take 60% of 2000 units because your annual capacity is 2000 units, not 1500 units. Okay, accordingly, the answers will change. Okay, I'm not going to solve it once again, but I showed you how to solve it. Not going to solve it once again. I showed you how to solve it. Kindly go through that kind of questions once. Sixth one is theory. I'm not going to discuss theory here, but listen, this question is one of the important question for your exam. That is JIT system, as well as zero based budgeting is one more important question. Zero based budgeting is once again one more important question. These two are the important questions for your examination. With that, we have completed our discussion on May 2018 paper. Now we'll take the quick small 5 minutes break and start at 5:40 p.m. We'll start with your November 2018 paper. Okay, November 2018 paper will be discussing but after this. Yes, now we'll do November 25 question. Sorry, November 2018. Measure SJ Private Limited manufactures 20,000 units of product per month. Okay. The cost of placing an order is 1500. Purchase price of raw material is rupees 100 per kg. Reorder period is 5 to 7 weeks. The consumption varies from 200 kg to 300 kg per week. The average consumption being 250 kg. The carrying cost of inventory is 9.75. Reorder quantity, guys, always remember, if in the question, if they don't give a ROQ and if they give a information about EOQ, then your ROQ will be nothing but your EOQ. Square root of 2 into annual requirement. So try to understand, we are consuming 300 kgs per week. On an average, we are consuming 250 kgs per week. So 250 into how many weeks? 52 weeks. Into how many weeks? 52 weeks. Annual requirement, I am going to consider how much, sir? Annual requirement. If I take on the basis of average consumption, I am going to consider 13,000 kgs. 13,000 kgs into ordering cost per order. Ordering cost per order, they are telling it as 1500 divided by carrying cost per unit per annum is nothing but 100 into 9.75 percentage. That is 2 into 13,000 into 1500 divided by 9.75, square root of that, which will come to 2000 kgs. Reorder quantity is 2000 kgs. Next is reorder level. Reorder level, two formulas are there. One is minimum plus average into average, or it is maximum into maximum. Here minimum also we don't know, so I am going to consider max into max. Maximum consumption, that is 300 per week. Guys, always remember, if everything is in weeks, everything should be in weeks. If things are in days, you should convert it into weeks. Or if everything is on the basis of days and one is on the basis of weeks, then you should convert weeks into days. Okay, always remember that. It's always better to convert the days into weeks because the rounding of errors won't come. Because divided by 7, generally it don't give you the exact numbers unless and until those numbers are divisible by 7. Correct? But if at all multiply by 7, anyhow you will get a whole number. So better convert it into days to weeks. If at all they will give like that, leave that, anyhow not applicable to this question. Max into max, 300 into 7. So 300 into 7, guys, reorder level is 2100 kgs. Maximum level, very simple, reorder quantity 2000, reorder level 2100 minus minimum into minimum. Minimum is 5 days and minimum consumption is 200, which is 1000. That is 3100 kgs. Minimum level, that is also very simple. Minimum level is reorder level 2100 minus average into average. Average is 250 kgs and average number of weeks are 6. 250 into 6 is 1500. 600 kg is minimum level. Your minimum level is 600 kgs. Average, you can take it in two ways. One is minimum plus half of ROQ, or you can take minimum plus maximum divided by 2. 3100 plus 600 divided by 2, which is 3700 divided by 2. 1850 kgs. 1850 kgs. Hope the A is clear. Going to B. A manufacturing concern has provided the following information relating to fixed overhead. Manufacturing concern provided you the following information relating to fixed overhead. They're asking you, see here, generally we do in a hourly basis, but here they have given a unit basis, so you should know the meaning of it. Fixed overhead variance is very simple. How much you are supposed to absorb, how much you actually incurred. Basically under absorption or over absorption. Now, absorption rate will be calculated on budgeted data. Budgeted is, we thought of 5 lakh. We thought our overhead would be 5 lakh divided by 5000 units, which means per unit we thought of recovering 100 rupees. Per unit we thought of recovering 100. However, we were able to produce only 4800 units, and if we recover 100, we are able to recover 4,80,000. However, guys, we incurred 4,90,000. So actual overhead is 490, absorbed overhead is 480, which means rupees 10,000 is under absorption. Under absorption means always and always adverse. Under absorption means always and always adverse. Fixed overhead expenditure variance. Expenditure variance is how much you thought of spending, 5 lakh. How much you actually spent, 490. So again 10,000 rupees adverse. Done. Volume variance. Volume variance is very simple. From how many units you thought of recovering? You thought of recovering from 5000 units, 100 rupees. But actually from how many units you are recovering? Just 4800 units, 100. Which means you thought of recovering 20,000 more, but you couldn't. So again adverse. Again adverse. Fixed overhead efficiency variance. Efficiency variance is in the actual number of days, how many units you should have produced as per the standard. Very simple. I thought of producing 5000 units in 25 days. However, I am working for 23 days. Fine. I want to know just efficiency. In the working number of days you work, number of hours you have actually taken, whether you are producing standard number of units or no. Efficiency. 5000 divided by 25 into 23. You are supposed to produce 4600 units. Oh my god, guys, you are actually producing 4800 units, which means 200 units extra you are producing. Awesome. Extra production means extra recovery. Extra recovery means favorable. 200 into 100, which will come to 20,000 favorable. Simple question. Hope this question is clear. Done. Next, following details are provided. you are supposed to calculate equivalent production and cost per equivalent units. Guys, as it is a 5 marks question, they are not asking you like material, labor and all. Very simple, they are asking on total cost basis. You want to do it under FIFO as well as calculate cost per equivalent units. First up, opening WIP 3000 units are there. Okay, introduced 17,000 are there. Done. Next up, here this is input. This is input. Concentrate on output now and equivalent units. Okay. Now percentage and equivalent units. Output. Guys, transfer to next process is 15,000 units. In that 15,000, what FIFO tells? Whatever was there first was transferred first. So 3,000 units will be transferred. However, those were 70% complete, which means during the period, other 30% will get over. That will be equivalent to 900 units. Okay. So remaining 12,000, that is from the fresh only, which means whole 100% is happening in the during the period only. That is 12,000 equivalent units. Done. Closing 2,200. Closing 2,200, 100%. 2,200, not 100%. If it's 100% finished goods, no, 80%. So 80% of 2,200, 1,760. Done. Next, sir. Normal loss, 12% of the input, including beginning. So, and scrap or 50% complete, doesn't matter, guys. Doesn't matter at all, because for normal loss, always and always, you should take 0. If the question is silent, for abnormal loss and abnormal gain, you should take 100%. If question tells some other percentage, you should take that percentage. For normal loss, you should take 0, because that should not be considered as a units. If you consider, the cost will get divided for that also. Got it? So total input is 20,000. On that 12% is a normal loss they are telling, which is 2,400. 2,400, 0, 0. Done. Sir, 20,000 we have input. Yes. 15,000 got over. Yes. 2,200 in closing. Yes. 2,400 in normal. Yes. Where the hell did other 400 go, sir? Abnormal loss, 100%. If they have told it 90%, then I would have taken 90%, 100%, which is 400. Now, equivalent units are 900 plus 12,000 plus 1,760 plus 400, which will come to 15,060. Equivalent units are 15,060. Guys, how much is the cost during the year? 33 lakh 12,720 divided by 15,060. Cost per equivalent unit is 3312,720 divided by 15,060. 15,060, which will come to almost 220 rupees. Almost 220 rupees. I hope it is clear. Oh, scrap recovery is there. Okay. This one thing you have to remember here. Scrap recovery is there, guys. Scrap recovery is 50 rupees per unit. Remember one thing, everyone. Remember, concentrate and remember this point. What point, sir? Scrap recovery. Guys, if the scrap recovery is there, scrap recovery relating to normal loss, you should reduce it from the cost. Sir, which cost, sir? You should check, guys, whether they have given a split between the cost as material, labor, overhead. If at all they have given a split between the cost as material, labor, overhead, reduce it from the material cost. Sir, current year material cost or last current years? Okay. Sir, they haven't given, sir. Haven't given. Then what you should do? From the total cost, you should reduce. Guys, 50 rupees per unit? Yes, sir. How much is a scrap? Scrap is normal loss, 2,400. So 2400 into 50. 1,20,000. So my cost for the period will be 33 lakhs 12,720 minus 1,20,000, which will come to 31,92,720. Per unit it will be divided by 15,060. 212. 212. Cost per equivalent unit is rupees 212. Hope it's clear. Done. Yes. Thank you. Now, guys, this one is a contract. Ignore. With that, we completed the first question. Jumping to the second question straight away without wasting any time, because we don't have time to waste. Correct? Exams are very near. We should give our 100% in the today and tomorrow and day after tomorrow till 5 p.m. Then costing is sorted. Correct? So just push yourself for the next 1.5 2 days. Following details are provided for the quarter. Okay, they're asking you prepare a cost sheet showing raw material consumed, prime cost, factory cost, cost of goods sold, cost of sales, and profit. For the quarter ending, they have given direct expense, direct wages is 175% of the factory overhead. So factory overhead will be how much, sir? Factory overhead will be 175% of factory overhead means 2,57,250 is 175. 100 is question mark. 1,47,000. 1,47,000. Always know the difference. They are not telling it as factory overhead as 175% of direct wages. They are telling direct wage is 175% of factory overhead. Cost of goods sold they have given, selling and distribution they have given, sales they have given, and admin overhead is 10% of factory overhead. Factory overhead is so much, admin overhead is 14,700. You can treat the admin overhead as related to production, related to general admin overhead. If related to production, form part of COP. If no, it will be forming part of your cost of sales. Done. Raw material consumed, opening raw material they have given, closing raw material they have given, purchases they haven't given, fine. WIP they have given, finished goods they have given. Guys, they have given COGS 18,75,000. Correct? 18,75,000. Reverse calculation, that's it. I will show in the solution itself, it will be easy. See here. Reverse calculation, they have given COGS. Here they have taken admin overhead as other than production. I suggest you guys to take it related to production. Why, sir? Because it is 10% of your factory overhead, which means somewhere related to factory. So better take it as a related to production. COGS they have given. For that, closing stock, opening stock adjustment also they have given. And admin overhead we can find out. Using that we found out factory cost. We know the closing WIP, opening WIP. Using that we can find out factory cost. And also factory overhead we calculated. Using that we know prime cost. For the prime cost we know direct wages, direct expense. We'll get to know how much is raw material consumed. We also know that opening stock and closing stock. So the balancing figure will be purchases. Okay. For the cost of goods sold, if you add the S&D, we'll get the COS. For that net profit, we will get a sales. Simple one. So I'm not going to solve it again. See here. 10 marks they are telling. A manufacturing company is producing product A which is sold in the market at rupees 45 per unit. Okay, the company has the capacity of 40,000 units per year. The budgeted is 30,000. So this is your normal units or normal output or normal capacity. Okay, the cost, material, wages, overhead, total is this much. How much, sir? 21 plus 6, 27. If the question is silent about admin overhead, should we take it as related with production? See, if the question is completely silent, then take it as general. If somewhere it is related, like percentage of factory overhead, percentage of factory cost, or related to production, like that, if they give, take it as production. Anyhow, you write the assumption and come. MOS, they have given it as 4,12,500. They are asking you to calculate FC as well as break-even point. Calculate the volume of sales to earn the profit of 20%. And if the management is willing to invest 10 lakh with an expected return of 20%, calculate how many units to be sold to make this profit. That is, they are expecting profit of 2 lakh. That is, to earn the profit of 2 lakh, how much you should make? Management expects additional sales if the selling price is reduced to rupees 44. Calculate units to be sold to achieve the same profit as desired in point number 3. So, now, guys, what you can do? What you can do? We are planning to sell rupees at the rate of rupees 45. We are planning 30,000 units. 30,000 units. Correct? Yes, sir. Correct. Now what, sir? Which means we are expecting our sales to be 45 into 30,000. 45 into 30,000. Correct? Yes, sir. Correct. Which means we are expecting our sales to be 30,000 into 45. Which will come to 13,50,000. Which will come to 13,50,000 minus 4,12,500. See, this is your total sales, expected total sales. They have given margin of safety, which means the difference should be break-even point. No, so the break-even point they are telling is 9,37,500. 9,37,500. This is your break-even point. This is your break-even point. Next, they are asking you to calculate the fixed cost. Next, they are asking you to calculate the fixed cost. How we can compute fixed cost, sir? Very simple. Find out the PV ratio. Sir, how to find out the PV ratio? Guys, you know the selling price? Yes, sir. You know the cost? Yes, sir. May I know the profit? Rupees 18. Virat. So, 18 divided by 45 into 100. 20%, no. 18 divided by 45 into 100. Sorry, 40%. So, PV ratio is 40%. Now, guys, MOS is profit by PV ratio. 4,12,500 is equal to profit. Sorry, give me a second. How many units are sold? How many units are sold? 4,12,500 divided by 45. MOS is around 9177. 9177. 66.67. This is your MOS. Profit is how much, sir? At MOS into around rupees 18. Profit will be around 165,000. So 165,000 divided by X will give you 4,12,500. Will give you 4,12,500. That is 165,000 divided by 4,12,500 will give you 0.4. Your PV ratio, you can tell it as 0.4. You can tell the PV ratio as 0.4. I told no, profit percentage itself will be PV ratio 0.4. Now 40%. Now guys, try to understand. Your MOS, you know, your break even point, you know. Your MOS, you know, your break even point, you know, which means using break even, guys, you know one thing, contribution at break even point is equal to fixed cost. Otherwise, your break even point won't give you zero profit. Okay. Sir, contribution at break even point will be how much? My break even is 9,37,500 and contribution percentage is 40%. So 937,500 into 40% will give me the fixed cost as 375,000. Calculate the volume of sales to earn the profit of 20% on sales. Let the sales be X. To earn the profit of 20%. So contribution of that sales will be 0.4x. From the 0.4x, if I reduce 375,000, that should give me profit of 20% on sales. That is 0.2x. Now I can tell it as 0.4x minus 0.2x is equal to 375,000. I just reframe the equation. That is 375,000 divided by 0.2. 18,75,000. 18,75,000. Done. Next, if they want to earn the profit of 2 lakh, then how much units to be sold? First, let's calculate the sales to be made. Let's take it as X. Contribution will be 0.4x. Yes, sir. Minus fixed cost 375,000. Okay. That should give me the profit as 2 lakhs. That is 5,75,000 divided by 0.4. Rupees 14,37,500. 14,37,500. Done. Next, if the and units they ask, no, that is 14,37,500 divided by selling price is 45. 31,944.44, around 31,945. Management expects additional sales if the selling price is reduced by 44. They are telling if the selling price is reduced by 44, they are expecting additional sales. Calculate the units to be sold to achieve the same profit as desired above. Now guys, now try to understand. When the 45 was selling price, PV ratio was 40%, which means variable cost was 60%, 27. Always remember one thing, variable cost per unit won't change with the change in selling price. What do you mean by that, sir? What I meant was, if the number of units sold, let it be S, that is selling price will be 44S. Variable cost will remain 27 only, it won't change. So that is 18S. Sorry, 17S. Contribution is 17S. Fixed cost also remains same, 375,000. That should give you a profit of 2 lakh. So 2 lakh plus 375,000 divided by 17, around 5 lakh 75,000 divided by 17. Units to be sold is 33,823.5 or 824. So many units to be sold. %. Fixed cost is 375. Break even is 937,500. 20,833 if you want it in units. 41,666. 31,945 and 33,824. These are the answers for my question there relating to this one. Hope it is clear. Sir, how many papers will be covered today? Everything. All the 15 papers. Done. Next. XYZ Limited has obtained an order to supply 48,000 bearings per year from a concern on a steady basis. It is estimated that it cost rupees 0.2 as inventory holding cost per bearing and setup cost is 384. You are required to compute the optimum run size and number of runs per bearing. They are asking about EBQ. EBQ is square root of 2ds. 2ds by C. Sir, what do you mean by D, sir? Guys, D means your annual demand. S means setup cost per setup. Carrying cost per unit per annum is C. Optimum run size. Square root of 2 into annual demand is 48,000 units. Here you have to consider the production, not the purchase, into setup cost is 384 per setup divided by holding cost per bearing per month they have given. You want per bearing per annum. That is 0.2 into 12, 2.4. That is 2 into 48,000 into 384 divided by 2.4. Square root of that 3919. 0.18, you can take 3919. Done. Sir, number of runs per for bearing manufacture, very simple. How many bearings we want, sir? 48,000. Okay. Per production, if we produce 3919 units, we have to produce 12.25 runs, basically 13 runs. Compute the interval in 12 months. 365 they have given, so days you have to consider. 365 divided by 13. Basically 28 days once we have to run one batch. Find out the extra cost to be incurred if the company adopts a policy to manufacture 8,000 bearings per run as compared to optimum run size. Now, if at all you go for this one, 48,000, 48,000 divided by 3919. Basically, you should go for 13 run. No, 13 run means setup cost will be 384 into 13. 13 run, 13 times setup. 384 into 13, which will come to 4992. Okay. Your carrying cost will be 3919, half of that, into 2.4. 3919 divided by 2 into 2.4. which will come to 4702.8, which is 4703. Your total cost will be 4992 plus 4703, which will come to 9695. 9695 under EBQ. What if I don't go for EBQ? If I go for producing 8000 units, which means 48,000 divided by 8,000. We have to run six times. We have to make a batch, 6 batches. So 6 batches into number of setup cost is 384 per batch. So my setup cost is 2304. Carrying cost will be half of 8,000, 4,000 into 2.4, which will come to 9,600. Total will come to 11,904. 11,904. 9695 and 11,904. Sir, which is better, sir? There is no better and all here, because here no discount and all will be there. Always EBQ will be better. However, how much you can save, sir? 2209 you can save. 2209 you can save just by going for EBQ. Extra cost will be 2208. This is basically they didn't round it off. Here they have rounded off based on that. Hope it's clear. A is clear. Going to B. HMB Limited is producing a production in 10 batches, each of 15,000 units. Material procurement, maintenance, setup cost, quality control. So total overhead will be how much, sir? Total overhead will be 22,50,000 plus 17,30,000. Guys, actually we'll do one thing. If at all it is this ABC question, for the time being, if this kind of question, apportionment question and all, I'm not going to do, because you know this is very simple. Based on the activity drivers, you are going to distribute it and you are going to find it out. Let's not waste the time on this one. Okay, this one, if time permits, let's see later. If time permits, let's see this ABC questions later. Let's not waste time on that. They have given fourth one. The following balances were extracted from the company's ledger: raw material control, WIP control, finished goods, general ledger adjustment control. Which means here what we are following is non-integrated accounts. Non-integrated accounts, because GLC or GLA or CLC will be opened in case of non-integrated accounts, not in the integrated accounts. Not in the integrated accounts. Done. The following transaction took place. What they're asking you to prepare these ledgers. Anyhow, I'm not going to tell the ledgers. I'm just going to tell you what are the entries. Factory overhead allocated to WIP. Basically, they are telling that you are absorbing, which means you should debit the WIP, credit the factory overhead. Absorption. Goods furnished at cost. That is basically finished goods they are talking. From WIP, it will be moved to finished goods. Finished goods to WIP. Raw material purchased. That is stores ledger control. Or here they are using the term raw material control. Raw material control ledger to general ledger control. Direct wages allocated to WIP. That is WIP to wages control. Cost of goods sold. Cost of goods sold is you are going to transfer from finished goods to the cost of goods sold or cost of sales. Raw material issued to production. Later you should don't forget to transfer that COGS to costing P&L. Raw material issued to production, that is WIP to SLC. Raw material credited by supplier, SLC to, if that person credited us, we are going to debit that person. That is GLC. We can't take the supplier directly, no. So instead of supplier, it is GLC account to SLC account. Raw material losses, inventory, so which means loss. So costing P&L to SLC. WIP rejected with no scrap value, again loss. Costing P&L to WIP. Customer returns of finished goods. That is basically finished goods to COGS. Very simple. Based on this, you are going to prepare the accounts. Measure XY travels have been given a 25-kilometer long route to run a air conditioned minibus. The cost of the bus is 20 lakhs. It has been insured at 3% premium per annum, while annual road tax is 36,000. Guys, if at all anyone is using a old study material, there they have done one thing. What they have done? Basically, to calculate insurance of 1%, they have taken the cost minus scrap value. On that, they have calculated a insurance cost. Guys, always remember, don't take it on this. In new material, they corrected it in overheads chapter. Okay, they have taken it on cost. So it should be taken on cost. Okay, done. Annual repairs. Annual repairs will be rupees 50,000 and a bus is likely to last for 5 years. Okay, driver's salary will be 240,000. Conductors will be 180,000. In addition, 10% of the takings they will get as a commission. Office and admin overheads will be rupees 18,000 per annum. Diesel and oil will be 1,500 per 100 kilometer. Bus will make 4 round trips carrying on an average 40 passengers on each trip. Assume 25 profit on takings and consider the bus will run on an average 25 days in a month. You are required to prepare operating cost sheet and calculate the fares to be charged. Very simple. I am going to show different things first required. First, I want to know the passenger kilometers. How to compute that, sir? Very simple, guys. First, let's compute how many kilometers we are traveling. First, let's compute how many kilometers we are traveling. Guys, 25 kilometers. Yes, 4 round trips, which means 2 sides. 8 times, 8 sides we travel. And for 25 days, which means in a month, kilometers traveled is 25 into 4 into 2 into 25. We are traveling 5,000 kilometers. We are traveling 5,000 kilometers. How many passenger kilometers, sir? 5,000 kilometers into on an average 40 passengers, which is basically 2 lakh passenger kilometer. Guys, here one more thing, remember, they will tell bus seating capacity is 50 seats. Okay, and they will tell cleaner will be there for each bus, and bus is 100% occupied, which means passengers you should not consider 50, you should consider 49. Why? In one seat, one cleaner will sit because he can't stand, he will sit. The assumption is that 49 seats you should take it as a passenger if they give in an examination. Don't forget. Now, 2 lakh is passenger kilometer. Done. We'll do the cost one by one. Cost of the bus is 20 lakh they are telling. Cost of the bus they are telling 20 lakh, which means depreciation will be 20 lakhs divided by, we are expecting it to run for how many years, sir? 5 years. Per year 4 lakh, but for 12 months it is 33,333. Done. Next, insurance 20 lakh into 3%, 60,000. That is per year divided by 12, 5,000. Done. Road tax 36,000 for 1 year. For 12 months, 3,000. Annual repair 50,000. 50,000 divided by 12, 4,167. Done. Driver's salary 240,000 per annum, 120,000. Conductor salary 180,000 per annum, per month 15, sorry, 2,40,000 means 20,000 per month. Conductor salary 15,000 per month. That let it be the commission. Office and admin overhead will be 18,000 per annum, which means 1,500 per month. Diesel will be 1,500 for 100 kilometer. So how many kilometers we are traveling? 5,000 kilometer. 100 kilometers means we need 50 liters or 50 this thing of 1,500. 75,000. That is basically 5,000 divided by 100 into 1,500. Done. Now this will be my total cost excluding commission. Excluding commission, this will be my total cost. 33,333 plus 5,000 plus 3,000 plus 4,167 plus 20,000 plus 15,000 plus 1,500 plus 75,000. 1,57,000. Okay, and they are telling commission is 10% of takings. If I take the takings as T, then commission will be 1.1 T. Okay, that should give you total cost. That is 157,000 plus 0.1 T will be your total cost. They are telling profit is 25% on takings. 0.25 takings should give you takings. Now I should calculate takings. That is, guys, 157,000 divided by 0.65. 2,41,538 divided by 2 lakh per passenger kilometer. Rupees 1.21 per passenger kilometer. 1.21 per passenger kilometer. What 1.21? No, give me a second. Total cost is coming to 21,84,000. How much we got? Basically 21,84,000 they are getting for a year. So per month they are getting 182,000, right? That is depreciation correct, insurance correct, road tax correct, and your annual repairs correct, office administration. Office administration, guys, actually here in the question I think they missed it. In the answer they are taken it as 3,18,000. Okay, but while giving it in this suggested answer question, they are taking it as 18,000. There is a typing mistake. Okay, if you take that, then your answers will match. Kindly go through that once. Okay, here if you see very carefully, office administration they have taken it as 318,000, but while giving for us they have given it as 18,000. Okay, there they have done a mistake. If they take consider that, you will get like this. So accordingly you can solve it. Till what time you will be doing the sum, sir? Till I get tired or papers get over? Is the video lagging only for me? Might be. Others are not responding. It will be only for you. Yes, give me a second. Going to the question number 5. An electric gadget manufacturer has prepared a sales budget for the next few months in this respect: January, February, March, April, and May. 5 months detail they have given. To manufacture an electronic gadget, a standard cost of 1500 is incurred, and it is sold through dealer at a uniform price of 2000 per gadget. Dealers are given a discount of 15% on selling price. Basically they are given a discount of 300, which means 1700 is the price at which we are selling it to them. Apart from the other material, 2 units of batteries are required. What is required, sir? 2 units of batteries are required to manufacture a gadget. The company wants to hold a stock of batteries at the end of each month to cover 30% of the next month's production. So they want to hold up batteries at the end of each month. That is, they are talking about a closing stock of the raw material to cover 25% of the next month's sales. Sorry, 30% of the next month production, and they want to manufacture, that is finished product, they want to keep 25% of the next month's sales. Okay, 3250 units of batteries and 1200 units of gadgets were available on 1st January. Prepare a production budget for the month of January, February, March. Guys, how much units you should produce? Very simple. How many units you should produce? Very simple. The units to be produced is nothing but how much opening stock is there, or you can tell it as how many units you want to sell. Correct? Already opening stock, some units will be there that need not be produced. However, you are planning to keep some closing stock that you have to produce. How many units to be sold? In that already how much exists that need not to produce, exclude it. But you have to keep the closing stock, which means you have to produce, that you should add. You will get units to be produced. So listen here. What they are telling, for which month they are asking? For January, February, March and April. Jan, Feb, March and April. So January sales 5000 units, Feb 6000 units, March 7000 units, April 7500 units. Opening stock, January opening stock they have given it as 3250 batteries and 1200 of gadgets. So 1200. Closing they are telling the company wants to hold a stock of next month's production and to hold a stock of manufactured gadgets to cover 25% of the next month's sales. So in January we want to keep 25% of the February sales, that is 1500. In February we want opening stock will be 1500. We want to keep March month's 25%, that is 7000 into 25%, which will come to 1750. Done. March 1750 we want to keep 25% of 7500, 1875. Opening is 1875. We want to keep May month's 25%, 2000. That is, guys, 5000 minus 1200 plus 1500, 5300. 6000 minus 1500 plus 1750, 6250. 7000 minus 1750 plus 1875, 7125. 7500 minus 1875 plus 2000, 7625. This is your consumption. Okay. If this is our consumption, sir, sorry, this is your production. If this is our production, consumption of battery will be how much? 2 batteries for each and every unit, right? 2 units of batteries. So 10,600, 12,500, 14,250, 7,625 into 2, 15,250. Okay, this is what required. However, should we purchase this much also, sir? No. Why? There is a opening stock. No. Minus opening stock. Okay. But to keep closing stock, we have to purchase. Yes. Plus closing stock. That will give you how many units to be purchased. That will give you how many units to be purchased. That will give you purchase budget. Now, guys, purchase budget. For the month of Jan, Feb and March. They are asking only for 3 months. Great. What they are telling here, closing stock, batteries at the end of each month to cover 30% of the next month's production. That is, opening stock is how much? Opening stock is 3250 units. However, we want to keep 30% of 12,500. 3750. 10,600 minus 3250 plus 3750. 11,100. Now, 3750 is opening stock. Closing will be 14,250 into 30%. 4,275. 12,500 minus 3750 plus 4275. 13,025. Now, 4275 is your opening stock. Closing will be 15,250 into 30%. 4575. That is 14,250 minus 4275 plus 4575. 14,550. 14,550. This will be your purchases. Done. Now, they are asking a profit also. They are asking profit for which month, sir? Profit for the quarter ending on March. Guys, cost we know. Cost we know. How much? 1,500. Selling price 1,700 in fact. 300 discount, no trade discount. 200 per unit. January, February, March. How many units we are planning to sell? We are planning to sell 5,000 plus 6,000. 11,000, 11,000 plus 7,000. 18,000 units. And per unit, if we make a profit of 200, we are going to have 18,000 into 200, which will come to rupees 36 lakhs as a profit. This was your production budget. This was your purchase budget. This was your profit. I hope it matched. 11,100, 13,025, 14,550. Yes, and production 5300, 6250, 7125 and 7625. It's matching. Hope it is clear. 5A, hope it is clear. Done. Going to be following data have been extracted. They are asking you annual cost of each employee. So you should think from the employer point of view. That is how much we are spending, not earnings. Earnings means from employee point of view, in hand how much I am getting. But cost means employer point of view. Employee cost per hour. Cost per hour means which hour, sir? Effective hour. Effective hour means what, sir? Total hours paid minus normal idle time. Okay. Cost of abnormal idle time per employee. Let's see. Now, salary per month, it is 30,000, but they want annually. So I am going to take 360,000. Bonus 25% of salary, which is 90,000 if I'm not wrong, let me check, into 25 percentage, 90,000. Okay. Next, employer's contribution, of course that is our cost only, no doubt in that. 360,000 into 15%, 54,000. Sir, what if it was employee contribution? Employee contribution means out of 360,000 we will reduce that and remaining will pay to employee and the reduced amount will pay to government, which means extra I am not incurring. Total 360 only. 3 lakh we give to employee, 60 will give to government. End of the day 360. So that I would have ignored. Total cost of employee, of course it will form part of your this thing, but that is total cost of employee welfare activity 661,000. That is total employee cost. But we have 175 employees, which means per employee how much, sir? 661,500 divided by 175. Per employee it is 3,780. Done. Anything else? No. This will be my total cost per employee per annum. 3,60,000 plus 90,000 plus 54,000 plus 3,780. Rupees 5,07,780. Done. Employee cost per hour. Per hour means I want to know the hours. If I want to know the hours, I want to know the effective hours. Try to understand. Total leave permitted during the year is 30 days. Normal idle time 70 hours per annum. Other than this, see, leave permitted is paid leaves. Paid leaves means normal idle time. If you don't give leaves, who will work for you? Correct, normal idle time. Abnormal idle time also they have given it as 50 hours. Working days per annum they have given. Try to understand, guys. Now, you have two assumptions can be made here. What are those, sir? You can take 310 as net of 30 days. That is, total working days is 340. In that, employees 30 days leave is given. 310 is actually they are working. They should have worked. They are getting, they should have worked. Or you can take 310 is total number of days they should work. But 30 days is before excluding 30 days, it is 310. Sir, which is better? Considering 310 as total working days. That is better. Because Sunday, Diwali, Ganesh Chaturthi, Ramzan, Christmas, Good Friday, so many things will come. No, that's fine. So, 310 days, we are expecting them to work. However, 310 into 8 hours. We are expecting them to work for 310 into 8 hours. 2,480 hours. However, guys, 30 days, they can't work, no. Why? They have a leave. What leave? Their paid leave. They can take a leave. 30 into 8. 240. Okay. To calculate, I am calculating effective hours. Effective hours means total time minus normal idle time. So, leave I am considering it as normal. Done. Next, normal idle time again 70 hours because of course they can't work for 8 hours completely, no, in between break and all. Total per annum it is allowed is 70. Done. Now my effective hours would be 2,480 minus 240 minus 70, which will come to 2,170. So, employee cost per hour will be rupees 5,07,780. I am expecting them to work for 2,170 effectively. So, per hour rate would be 507,780 divided by 2,170. Rupees 234. Rupees 234. Cost of abnormal idle time per employee. Per employee idle time is 50 hours. Okay. And cost is 234. So cost per abnormal idle time is 50 into 234. Rupees 11,007. Done. Next one you see. Measure NOP Limited has its own power plant and generates its own power. Great. Captive consumption. Information regarding power requirement and power used as follows. Needed capacity production. Used during the year. Sir, why they have given two things? You will understand. During the quarter ended, cost for generating power amounted to rupees 12.6, out of which 4.62 was considered as fixed. Guys, try to understand. Fixed will always and always and always be apportioned on a normal capacity. That is how much you thought. Variable, if they give actual, that will be on the basis of actuals. No. If they give variable for normal, then it will be on the absorption rate is based on the budgeted. But if they just give the total incurred as well as total hours, then that will be on the total, no, actual basis. Service department X renders a service to A, B and Y in the ratio of 6:4:1, whereas Y renders to A and B in the ratio of 4:1, which means non-reciprocal, one-sided love story. What do you mean by that, sir? X is providing service to Y, but Y is not providing service to X. Service departments. Non-reciprocal means which method? Step method. Done. Direct labor hours of department A and B are 67,500 and 48,750 respectively. Prepare overhead distribution sheet. Calculate factory overhead per labor hour for department A and department B. Very simple, guys. Fixed you are going to distribute in this ratio, and variable you are going to distribute in this ratio. Then service you are going to distribute. Okay, nothing much, only I wanted to tell that. See here, horsepower used for variable, for fixed it is horsepower, normal horsepower assumed. Sixth one is theory question. I am not going to touch it. In this theory, anything important we have to go through once, sir. Then it is how the byproduct is treated in costing, that you can go through once. And also activity based budgeting. These two are the important one once you can go through it. Hope it is clear, guys. Sir, please do like this for CMA Inter also. Yeah, I will try. Yes. Guys, by the way, whoever wrote first group, how did your first group go? I hope it went well. Yes. Yes. Proceeding with May 2019 question. Of course, the same question, 1A is the same question of what is there in your study material in the budget chapter. Correct? In the budget and budgetary control, what is there? Same question it is. 1A. See there, they have given standard working hours, 8 hours per day of 5 days per week. Maximum capacity is 60 employees. So, number of hours available is 8 into 5 into 60 per week. 8 hours, 5 days, which means 40 hours per week, 60 employees. Actual is, that is budgeted. With number of our workers available, how much we are planning to touch or planning to work. 8 hours into 5 days into 50 employees. Actual hours expected to be worked per 4 week. Expected to be worked. Standard hours expected to be earned. That is your budgeted hours. Your 8,000 is there, no? 8,000. This is expected to work. That is nothing but, I will tell you. Actual hours worked in 4 week. This is your actual hours. Standard hours earned. Standard hours earned. This is your standard hours. Then what is this 9,600 hours, sir? This is standard how much we expected to earn. That is 8 hours we will work, 5 days we will work, with 60 employees we will work. 60 employees we will work. Per week 2400. For 4 weeks we'll work 9600. So 9600 is maximum number of hours available. Maximum number of hours available. However, we knew. What, sir? We can work for 8 hours, yes. 5 days in a week, yes. But not with 60 employees, because we don't have 60 employees. We have only 50. Only with the 50 employees for 4 weeks, 8 hours. Now, this is your budgeted hours. Now, efficiency ratio is what, sir? Efficiency ratio is standard hours by actual hours into 100. Standard hours 8,800. Actual hours 7,500 into 100. 8,800 divided by 7,500 into 100. 117.33 percentage. Activity ratio is what, sir? In a given number of hours, how much we thought of you working, budgeted hours. How many hours work you have completed? How many hours you worked, I don't want. How many hours activity you have reached, standard hours for actual production. That is, standard hours is 8,800. I was expecting you to produce only 8,000 units. Oh my God, nice. You guys are working more, 110 percentage. Standard capacity usage ratio. Standard capacity usage ratio, that is how many hours you are using out of the available hours. That is standard hours divided by maximum number of hours available, 9,600 into 100. 83.33 percentage. Actual usage of budgeted capacity ratio. That is out of the budgeted hours, how much you are actually using. 7,500 divided by budgeted hours for how much? 8,000 hours. Correct? Into 100. So you are using around 93.75 percentage. 93.75 percentage of your capacity. I hope it is clear. Done. Next is what, sir? See, immersion is there. That no need. Earlier it was there. Now they have eliminated. So just ignore it. Only 3 you should consider. Measure Zeba Private Limited allotted a standard time of 40 hours. This is standard hours. At the rate of 75. This is hourly rate. The actual time taken is 30. This is actual hours. You are required to calculate the total earnings under the following plan. HALC, premium plan, that is hours work, that is hours it will be Harini. It will be. Now hours worked 30 hours into hourly rate 75 plus half of hours saved 10 into hourly rate 75. 30 into 75 m plus 10 into 75 divided by 2 m plus MRC 2625. 2625. Done. This is your HALC plan. This is your HALC plan. Row 1 30 into 75 plus hours saved 10 divided by standard time 40 into time taken 30 into 75. That is 30 into 75 m plus 30 into 75 into 10 divided by 40 m plus MRC. Rupees 2,812.5. This is under row 1. Time wage system. Time wage is basically hourly rate. 30 hours they have worked and they will get 75 rupees per hour. 30 into 75. 2250. Piece rate system. So one job takes 40 hours. Correct. So for that particular job, how much we have planned of giving? We planned of giving 40 hours into 75. Rupees 3000. Rupees 3000 per unit. One unit completed in 30 hours. How many hours we completed doesn't matter. One unit we completed. So per unit we have to pay 3000. So 1 into rupees 3000, which will come to rupees 3000. Simple. Immersions ignore. A factory is engaged in the production of chemical Bomex, and in the course it manufactures a byproduct Chromex, which is after further processing has a commercial value. For the month of April, following are summarized cost: joint expense, labor, overhead. These are your joint cost. Okay. What are these are then, sir? All these are further production. All these are further production. In fact, not so much also. I can tell only these three are further production cost. This is selling price after further producing. Estimated profit per unit of sale of Chromex is 5. Okay. Number of units produced are 2000. Factory uses NRV method of apportionment of joint cost to byproduct. Okay. You are required to prepare a statement showing joint cost allocable to Chromex. Chromex is what, sir? Byproduct. Product wise and overall profitability of the factory. Very simple, guys. Here try to understand. You know for Chromex, very simple. Joint cost plus further processing cost plus profit will be selling price. Joint cost plus further processing cost plus profit is nothing but selling price. Yes, sir. Now joint cost is how much, sir? We don't know. But profit, you know? Yes. How much? 5 rupees. Profit is 5 rupees. And selling price is how much? 40. Which means we are expecting our cost to be 35. Total cost will be 35. And how many units it is? How many units? 2000 units. Which means my total cost is 70,000. Which means this includes two portions. What and all, sir? Joint cost and further processing cost. Guys, I know how much is my further processing cost. 28,000. 4,000 plus 18,000 plus 6,000. 28,000. Guys, if the joint processing cost is 28,000, if the joint further processing cost is 28,000, then the joint processing cost should be 42,000. 42,000. Now, out of the total joint cost, 1,80,000. If 42,000 is relating to Chromex, then 138,000 will be relating to Bomex. So joint cost allocable to Chromex is 42,000. Product wise and overall profitability. Now, Bomex. Guys, how much is the selling price? 100. How many units? 2000 units. Sales will be 100 into 2000. 2 lakh. Sales will be 2 lakh. Minus joint cost 138,000. Minus further processing cost. Further processing cost is 42,000. Sorry, not 42,000. 36,000. Two lakh minus 138,000 minus 36,000. 26,000. This will be relating to Bomex. Chromex. We know that 5 rupees per unit into 2000. 10,000. So total profitability will be 36,000. Total profitability will be 36,000. Simple. Mr. Abid Private Limited disclosed the net profit of 48,408 as per cost book, whereas Financial disclosed the net loss of 15,000. On scrutinizing both the set of books, the following informations were revealed. Works overhead under recovered. See, I will start with they're asking a memorandum reconciliation, let it be. But my starting point, I'm considering it as cost book now. Now, works overhead under recovered. If it's under recovered, in costing we showed less expense. Okay, which means we showed more profit. Now reduce the profit. Okay, done. Office overhead over recovered. More expense, less profit. Now increase the profit. Dividend received in shares. Less income, less profit, increase the profit. Interest on FD, again, less income, less profit, increase the profit. Provision for doubtful debt, less expense, we showed more profit, now reduce the profit. Basically, we are trying to do whatever the financial account we have done, same thing we should do in cost accounts. And what is not done there, here we will reverse. What is done there and we haven't done, we are going to do that. Obsolescence not charged in cost accounting. More profit, reduce. Stores adjustment, debited in financial accounts. Here more profit we showed. There one expense is there. We haven't booked that expense. Now book that expense. Depreciation charge in financial accounts, 30. Depreciation charge in cost account, 5,000 is over. Increase your profit with that. Now, memorandum reconciliation, what we should do, sir? Same like any other ledger. I will start. If it's a profit, I will start in the credit side. If it's a loss, I am going to start in debit side. As it's a profit, by profit as per cost accounts. How much it is, sir? By profit as per cost accounts. 48,408. Done. Next, whatever the add is there, I am going to take it in the same side. Loss, I mean, if we start with the loss also, whatever the add is there to the loss, same side. So, 11,500. 17,475 minus is their opposite side, 48,600, 21,650, 17,800, 17,200, 35,433, 5,000. Now, if at all I get the amount in the same side, that will be loss because I started with profit. If I get in the opposite side, that will be profit. Now, let's see. Debit side, 48,600, 17,800, 17,200, 35,433. Debit side, it is 1,19,033. Credit side, it is 48,408, 11,500, 17,475, 21,650, 5,000, 104. So credit side it is less, which means loss because we started with profit. By loss as per financial accounts, how much, sir? Minus 119,033, 15,000. Net loss of 15,000. Hope it is clear. Normal production capacity is 36,000. What they're asking here, whenever it's a big question, all you have to do is what they're asking a cost sheet. Calculate the selling price per unit for remaining 9 months to achieve the sales. Now, normal production capacity is there, 36,000. The estimated cost of production are as under: direct material 40, direct labor 30. Subjected to minimum of 48,000, which means if the actual is not 48,000, then you should pay them 48,000 per month, like that. Factory overhead 360,000 per annum, variable is rupees 10 per unit. Okay. Semi variable rupees 108,000 per annum up to 50% capacity, and 46,800 for every 20% increase in the capacity or any part thereof. Admin overhead 518,400 per annum fixed. Selling overhead 8 rupees per unit. Each unit of raw material yield a scrap which is sold at the rate of 5 rupees. In the year 2019, Factory worked at 20% capacity for the first 3 months. First 3 months, 50% capacity, not 20%, sorry. And remaining 9 months, 80% capacity is what we are expecting. During the first 3 months, selling price was 145. Great. Prepare a cost sheet showing prime cost, works cost, COP, cost of sales. Calculate the selling price per unit for the remaining 9 months to achieve the total annual profit of 876,000. First, calculate for the first 3 months. Okay. Direct material, 40 unit. Guys, 36,000 per annum, which means 36,000. In that also we are producing only 50%. That too, 36,000 is for 12 months, but we are producing in 3 months. So in the first 3 months, how many units we have produced, sir? 36,000 into 50% into 3 divided by 12. 4,500. Direct material will be 4,500 into 40, which will come to 1,80,000. Direct material 1,80,000. Going to the labor. But they are telling that each and every raw material there is a scrap of 5 per unit, which means scrap recovery is there. That is 4,500 into 5, 22,500. So direct material cost will be 180,000 minus 22,500. 1,57,500. Direct labor 30 per unit. So 30 into 4,500, 135,000. 135,000 guys divided by 3, which means 45,000. Try to understand what is happening. Minimum we should pay is 48,000 into 3, 1,44,000. 1,44,000. However, how much we are actually getting the payment to be made? 30 rupees per unit. We are producing 4,500 units, 135,000. So we are going to pay 144,000 only, because minimum so much to be paid. Done. This will give me prime cost. 157,500 plus 144,000. 3,01,500. Add factory overhead. They are telling fixed 360,000 per annum. So 360,000 into 3 divided by 12, 90,000. And variable 10 per unit. So 4,500 into 10, 45,000. Done. Also they are telling semi-variable 108,000 per annum up to 50% capacity. So now we are getting only 50% capacity, right? So 108,000 into 3 by 12, 27,000. Now this will give you factory cost, because there is no closing and opening WIP. 301,500 plus 90,000 plus 45,000 plus 27,000. 4,63,500. Admin overhead 5,18,400. I can consider it as general, or I can consider it as related to production. However, they are asking factory cost as well as, that is works cost, as well as COP separately, which means somewhere something should be there in between this. The only possibility is your admin cost, which is 5,18,400 per annum. So 5,18,400 divided by 4, 1,29,600 divided by 4 in the sense 3 by 12. Admin overhead. That will give you cost of production. That is 463,500 plus 129,600. 5,93,100. There is no opening and closing stock. Great. So this itself will be my COGS. This itself will be my COGS. Great. Add selling and distribution to that. 8 rupees per unit. 8 into 4,500 units. 36,000. I will get the total cost as, cost of sales as 593,100 minus 36,000, 5,57,100. 5,57,100. Sales will be how much, sir? They are telling the units were sold for the first 3 months at 145. So 145 into 4,500. 6,52,500, which means profit in the first quarter is 95,400. Done. Next, what they are asking? They are asking for the whole year. Yes, and upon that, calculate the selling price per unit for the remaining 9 months to achieve the total profit of 876,000. So try to understand. DM will be how much? Remaining 9 months, out of 36,000 production capacity, I am going to use 80% of it for 9 months out of 12 months availability. So 36,000 into 80% into 9 divided by 12, which will come to 21,600 units. So direct material will be 21,600 into 40, which will come to 8,64,000. However, for 21,600 into 5 will be scrap recovery, 108,000. So my direct material cost will be 8,64,000 minus 108,000, 7,56,000. Done. Labor, minimum how much I should pay, sir? 48,000 into 9 months. 4,32,000 is minimum you should pay. Now as per the unit basis, how much you should pay, sir? 30 rupees per unit, 21,600 units, 6,48,000. This is only more. So I am going to pay 6,48,000. Done. It will give me prime cost plus 7,56,000, which will give me 14,04,000. Done. Factory overhead fixed 3,60,000. 3,60,000 divided by 4 into 3, 2,70,000. Okay. Variable 10 per unit, 10 into 21,600, 2,16,000. Done. Semi-variable, try to understand. Up to 50% it fixed. For every 20% increase, 46,800 will happen, which means it is going to be 50 plus 20, 80 means you should further go for next one more 20, which means for this 108,000, yes sir, for this 46,800, yes, for the next 10% again 46,800. So your semi-variable will be 46,800 into 2 plus 108,000, which is rupees 2,01,600. Done. That is per annum. Divided by 4 into 3. For 9 months it is 151,200. My factory cost will be 14,04,000 plus 270,000 plus 216,000 plus 151,200. 20,41,200. How much they are telling admin overhead? 518,400 fixed. So 518,400 into 3 divided by 4. 388,800. My COP will be 20,41,200 plus 388,800. 24,30,000. Done. S and D, 8 rupees per unit, 8 into 21,600, 172,800. My COS will be 26,02,800. Profit, how much I am expecting, sir? Guys, try to understand. We want to make the profit of 8,76,600 for whole year. However, 95,400 is in the first quarter we already earned, which means from the next quarter we want to make next 3 quarters we want to make 7,81,200, which means in those 3 quarters my sales should be cost plus profit. How much it should be, sir? My sales should be 33 lakh 84,000. So to make the sale of 33 lakh 84,000 from 21,600 units, I should sell it at rupees 156.67 per unit. I should sell it at rupees 151 point this much. Done. So my selling overhead is 172. So my total cost of sales is so much. My profit, guys, give me a second. I'm expecting my total profit to be how much? 8,76,600. In the first quarter, how much profit I already made? In the first quarter, I already made a profit of 95,400, 781,200. Then accordingly we'll get some amount, so we're going to do it. Okay, selling and distribution we didn't add off. We added no 172,800. Yes. Next, see here, KD Limited produces a product EMM which passes through two processes before it is completed and transferred to FG. The following data are relating to May 2019. Process is there, finished stock is there. Opening stock, direct material, direct labor, factory overhead, closing stock, interprocess profit in the opening stock. So this is the question of interprocess profit. Done. Output of process A is transferred to B at 25% profit on the transfer price, that is selling price, and output of process B is transferred to finished goods at 20% profit on the transfer price. Stock in process is valued at prime cost, same like our study mat question. However, in study mat 3 processes are there, here only 2 are there. Finished stock is valued at the price at which it is received from process B, same. Selling price during the period is 75,000. Prepare a process account and finish code and each element. So guys, what you should do whenever there is a interprocess profit is, see, this is one of the important question. This is one of the very important question. You can expect this in an examination. Interprocess profit question. Guys, you have to divide it into 3 columns. The amount should be in 3 columns. Now, first process A. Process A. First one, I am going to take it as a cost, profit, total. cost profit total. Guys, opening stock, cost being 5,000, profit element is not there in that, so total also will be 5,000. Next, direct material introduced 9,000, profit won't be there in that because that is not our profit. Profit column means we are talking about our process, interprocess profit. But this whatever direct material is there in that, our profit won't be there. Our supplier's profit will be there. That we are least concerned. That is not our profit. That's our cost only. Direct wages 5,000. Again, no profit. 5,000. Now, this will give you prime cost. How much, sir? 19,000. No profit in it. 19,000. Done. Factory overhead 4,600. No profit in it. 4,600. Closing stock 2,000. No profit in it. 2,000. Done. Now they are telling what we are going to do. We are going to transfer it to process B. No. At what price we are going to transfer, sir? We are going to transfer at cost plus profit. What are you talking? Yes. So the total cost is how much? 23,600. Total cost is 23,600. Guys, 23,600. This 23,600 is there? No. I am going to transfer it at a profit. How much profit, sir? 25% on sales, which means 33.33 on cost. That is 23,600. However, the transferred is only 21,600. Transferred is only 21,600 because 2,000 is still with us. 21,600 into 33.33333 percentage, 7,200. The profit what we are going to transfer is at 7,200, which means I have to book a 7,200 profit. Done, sir. So total it is 21,600 plus 7,200. 28,800. I am transferring at 28,800. So guys, total cost is so much. Profit is 7,200. The total will be 3,800. Here also, total is 23,600, 7,200, 3,800. This is relating to process A. Simple. This is relating to process A. Basically, always remember, if we write profit, that will be profit relating to that particular process. If at all total profit column, sir, is it our profit, that particular process? No. That includes previous process profits also. However, before A, there is no other previous process. So it will be only of A. Now going to B. Now going to process B. I'm just going to write it here only. Now process B. Okay. In process B, of course, the opening stock will be there. How much will be the opening stock, sir? Opening stock, guys, is 5,500. Okay. But that is not the cost. What do you mean by that, sir? That is total. Why? In this opening stock, don't you think A's profit will be there? Yes. How much it is? 1,000. Which means cost is 4,500. Okay. Material introduced will be how much, sir? Material introduced is 9,500. Sir, will that be a total or cost, sir? For the time being, write it as total only. Cost also will be same. Why, sir? Because that 9,500 is not our profit. Whatever is there in that. That is our suppliers. We have least, like, we are, for us, it's cost only. No profit for our whole organization. Next is employee wages. How much it is, sir? Wages 6,000. Okay, cost only. So the prime cost will be how much? Prime cost will be how much? Prime cost will be, guys, 4,500 plus 9,500, 14,000, 20,000. Profit in it is 1,000, 21,000. Okay. Factory overhead is how much, sir? Factory overhead is 2030. Done. Factory overhead is so much. Done. Closing stock. Closing stock is, guys, 2,490. But is it at a cost, sir? The answer is of course no. Then what is it, sir? Total. Because that includes the stock which we bought from process A also. Correct? Which means that is total. Process B, closing stock is total. How much is total, sir? 2,490. Okay. Now in that, how much is profit, sir? How to evaluate? Very simple. They are asking us to value closing stock at as per prime cost. Now, when the total was 21,000, the profit in it was 1,000. Now the total is 2,490. Profit in it will be question mark. 2,490 into 1,000 divided by 21,000. 118. So give me a second. We forgot to bring the process A. Process A is there, no? How much? 21,600, 7,200, 28,800. So total will be 4,500 plus 9,500. Or I will do one thing. Let's not mess up the things. I will just show it here. Okay. I'll just show it here. Because this is important. I'm expecting an exam this time, interprocess profit questions. So I'm going to do this way. Concentrate. Now I'm going to do the process B. Done. First, opening stock. Guys, this is cost, profit, total, cost, profit, total. Opening stock, total we know. Opening stock, total we know. How much it is, sir? Opening stock, total is 5,500. 5,500. In that, the profit element they are telling 1,000. Which means cost is 4,500. Sir, is it our profit element? Not of process B. Not of process B. It is of process A. Done. Next, process A. Process A. Guys, process A, we are getting 21,600 cost along with the profit in it at 7,200. For us, it is cost only, no? 28,800. For us, the cost is 28,800 only. But for the whole organization, it's not the cost. Done. Next, material. That is someone from like buying from outsider, 9,500. So cost is also so much, total is also so much. Profit won't be there in that. Why? Because that is not ours. Wages, profit is our suppliers. Wages, 6,000. 6,000, 6,000. Now this will give me prime cost. This will give me prime cost. How much, sir? 4,500, 21,600, 9,500, 6,000, which will come to 41,600, 8,200, and 41,600 plus 8,200 will give 49,800. Done. Closing stock. Closing stock they are telling total as 2490. 2490. In that, how much is the profit element, sir? Guys, when 49,800, profit was 8,200. Now it is 2490 in that question mark. 2490 into 8,200 divided by 49,800. 410. Which means here it is 2080. Cost is 2080. Done. Next, transfer to next process. That is finished goods. Finished goods. Guys, try to understand. Try to understand. We are transferring it to next process. We are transferring it to next process at 20% on transfer price. Now, which means 25% on cost. Now the question comes, sir, for cost, what you should consider? Before that, there is overhead also. There is overhead also. Guys, how much is a overhead? Overhead is 2030. Now, sir, which I should consider as a cost? Guys, for process B, 49,800 is also cost only. 8,200 profit is there, no sir, not of process B, that is of process A. Okay, 2030 also cost. For process B, the cost is 51,830. On that they want 25%. 49,800 plus 2030 into 25%. So they themselves want a profit of how much? 49,800 plus overhead of 2030, 51,830. In that, anyhow 2490 is not sold, which means for them the cost sold is 49,340. On that they want 25%, which means they want the profit of 12,335. They want a profit of 12,335, which means total profit will be 12,335 plus 8,200, 20,535. However, in that 410 is already there with us, which means when transferring it to finished goods, we are going to charge 20,125. Okay, cost will be how much, sir? Cost will be 41,600 plus 2030. This is for the whole organization cost, 43,630. In that, closing stock cost is 2080, 41,550. And total will be how much? 43,630 plus 25,35. 64,165. 43,630, 25,35, 64,165. Here it is 41,550 plus 21,25. 61,675. This is how it's going to work. Okay, done. Now, sir, finished goods account. That I am going to show it here only. Finished goods account, concentrate. Opening stock is there. 10,000. In that they are telling profit included is 4,000, which means cost is 6,000. Process B, 61,000 is the total. Profit included is 2125 and 41,550. Now, closing stock. They are telling we have a closing stock of total 5,000. Okay. And this closing stock to be valued at the price what we receive from the process B. Which means when we received from the process B, guys, when the total was 71,675, profit in it was 24,125. Now 5,000 is a total. In that how much will be the profit? Oh sorry, that is not only process B. Only process B you should consider. That is total. Process B, when we received, total was 61,675. Profit included in it was 20,125. Now 5,000 into 2125 divided by 61,675, which is basically 1,631. Profit is 1,631. Accordingly will value. You know the total sales. Balancing figure will be the profit. Like that you are going to do it. Okay. Kindly do it accordingly. And please before going to examination, that interprocess profit once you have to revise and go. Without missing, you have to revise and go, guys. Don't forget. You have to revise and go this particular question. This question as well as what is there in your study material. Done. Third one, see. A gang works normally consisting of 30 workers, skilled workers, 15 semi-skilled workers, 10 unskilled workers. They are paid at a standard rate of 70, 65, 50. If a normal working week is 40 hours, gang is expected to produce 2,000 units output. During the week, the gang consisting of 40 skilled, 10 semi-skilled, 5 unskilled workers. The actual wages, that is, paid were 75, 60, 52. 4 hours were lost due to machine breakdown. 1,600 units were produced. 1,600 units were produced. They are asking you to calculate labor cost variance. What is the formula? Standard hours into standard rate minus actual hours paid into actual rate. Actual hours paid into actual rate. Done. Labor rate variance, that is standard rate minus actual rate into actual hours paid. Actual hours paid. Labor efficiency, standard hours minus actual hours worked into standard rate. Into standard rate. Mix, that is revised standard hours minus actual hours into standard rate. It is available in the marathon video. Okay, not in this, the concept marathon video. In that description, the notes is available. I mean, this question bank is available. You can go and check. Actual hours worked. Done. Idle time variance. Idle time variance is basically, guys, actual hours paid minus actual hours worked into standard rate. Actual hours paid into actual hours worked, actual hours paid minus actual hours worked into standard rate. Now, they have given standard for standard, which means skilled, semi-skilled, unskilled. Guys, 30 workers works for 40 weeks. 30 workers for 40 weeks. 1,200 hours. Semi-skilled, 15 workers works for 40 hours. 600 hours. And unskilled, 10 workers working for 40 hours. 400 hours. Now, if these guys works for so much, that is, if these guys works for 2200 hours, then you are able to produce 2000 units. So to produce 2000 units, skilled 1200 required, semi-skilled 600 required, unskilled 400 required. This is standard for standard. Now I want to know the standard for actual. Standard for actual, that will be my standard hours. So my standard hours will be very simple. Guys, for 2000, 1200 is required. But actually I am producing 1600. For 1600, question mark. Basically, to produce 75%, how much I want, sir? That is 75% of standard. 1600 into 1200 divided by 2000. 960. Okay. Next. For 2000 unit 600. For 1600, how much you want? 600 into 75%. 450. Sir, how that 75 and all? Now don't start learning how that 75 and all. Follow this method. 400 into 75%. 300 hours. This is your standard hours. Actual hours is how much, sir? Actual hours. 40 skilled workers are working for 40 hours. 1600. Wow. This is not adverse. This is adverse pro max. Semi-skilled are 10. 10 into 40. 400. 5 unskilled. 5 into 40. 200. This is your actual hours. So I will write here. Standard hours. Actual hours. Paid. Not actual hours worked. Okay. Standard hours are 960, 450, 300. Also I will write the standard rate. Standard rate. It is basically 70, 65, 50. Actual hours paid 1600, 400, 200. Actual rate 75, 60, 52. And what they are telling here, they are telling that 4 hours were lost due to machine breakdown. So each and every employee's 4 hours is lost, idle time. So first case, 40 skilled workers 4 hours is lost, 160. 10 semi-skilled workers 4 hours is lost, 40. 5 unskilled 4 hours is lost, idle time. So actual hours worked will be 1600 into minus 160. Sir, normal idle time, what we should do? Normal idle time, no adjustment, because your standard time means including normal idle time. Your standard time, what we are computing, that is including normal idle time. Okay. Now, actual hours worked will be 1600 minus 160. 1440, 360, 180. Revised standard hours. Guys. Sir, revised standard hours. How to arrive at a revised standard hours? Guys, revised standard hours is nothing but your actual hours. Sir, worked or paid? Worked. Your actual hours worked in standard ratio, that is 1440 plus 360 plus 180, 1980 in the standard ratio. So standard is how much? 960 plus 450 plus 300, 1710. Now 1980 divided by 1710 into 960, around 1111.5. Give me a second. Done. Accordingly, 1980 divided by 1710 into 450, 521, and the balancing figure 1980 minus 1111.5 minus 521, like this, 347.5. If you do this, automatically you will get how much is your revised standard hours. Now you have all the required information in this table. All you have to apply, going to apply is formula. Guys, don't do this 1 minus 2, 2 minus 3, 3 minus 4, some nonsense things. Try to understand. If at all you miss one thing in exam, whole answer will go wrong. So remember the formula and go. Sir, but I didn't learn on formula basis, sir. What to do? In marathon, we have covered in one and a half hour based on formula. So try to watch it once, and if you get it, great, because there won't be any possibility of you missing it. Okay, that is the thing. Give me a second. For 2000, it's 600. For 1600, question mark. So not 450, guys, 480. Sorry. Sorry, 20% of it. Sorry, 20% of it. I took it as 25. Sorry. 20% of it is this thing. So 480. It will be 320. So standard will change accordingly. Your revised standard also will change accordingly. Okay, just change it. That's what I told. Don't go for that. Sometimes you might do some mistakes. Just go for that. If this is so much, that is so much. That thing. Okay. Yes, you can round it off. You can round off. No worries. But I think necessity won't arise because that calculation error, because of that, you got in decimals. But however, in examination, if you get in decimals, just you can round it off. No problem at all. Okay. Done. Sir, this absorption costing, cost driver and all, for the time being, I won't touch that. As I already told you, ABC, all you have to do is read the question, whatever they asked in the question, do it. You will get the answer. For the time being, I won't touch that. Okay. Now going to fourth one, A. X Limited distributes its goods to a regional dealer using a single lorry. Great. The dealer premises are 40 kilometers away by road. The capacity of the lorry is 10 tons. The lorry makes journey twice a day, fully loaded on the outward journey and empty on the return journey. The following information is available. So our point is here, our dealer is here. The distance between our factory warehouse and our dealer is how many tons? How many kilometers, sir? 40 kilometers. Capacity is 10 tons. The lorry makes journey twice a day, which means from our warehouse till dealer it goes once, come back, go, come back. Which means 4 sites it covering of 40 kilometer, which means lorry travels 160 kilometers per day. Done. Fully loaded, which means 10 tons only it will carry. Done. Diesel consumption. 8 kilometer per liter. Mileage is 8 kilometer per liter. So they have given per week a statement total for 4-week period. So you want to find out for a 4-week period, and a lorry operates on a 5-day week, which means 20 days basically. We want everything for 20 days, or you can tell it as 4 weeks. Now 160 per day means for 20 days how many kilometers we travel? If it is 160 per day for 20 days, how much? 3200 kilometers will travel. Correct? Now guys, 3200 we travel, whereas 8 kilometer per liter, which means how many liters of diesel we want? We want 400 liters of diesel, which will cost us rupees 60. 24,000. Our diesel cost would be rupees 24,000. Engine oil 200 per week. For 4 weeks it will be 800. Driver wages 2,500 per week. For 4 weeks it will be 10,000. Repairs 600 per week. 4 weeks it will be 2,400. Garage rent 800 per week. 3,200. Cost of lorry excluding cost of tires. Excluding cost of tires, which means tires is extra. Now that is 9,50,000. So 9,50,000 and life of lorry is 1,60,000 kilometers. So per kilometer, scrap is not there, no? Scrap is there, no? 150,000, which means 9,50,000 minus 150,000. So the depreciable value of lorry is 8 lakh. We should depreciate it over 1,60,000 kilometers. Rupees 5 per kilometer is a depreciation, and we are running for 3,000 kilometers. 3,200, which will come to 16,000. Depreciation will come to 16,000. Life of lorry done. Insurance 18,200 per annum. So 18,200 per annum means for 52 weeks. Correct? For 52 weeks, because assume 52 weeks a year. So per week it is 350. For 4 weeks it is 1,400. Cost of tire 52,500. Life of tire is 25,000. So 52,500 divided by 25,000. Tire cost per kilometer is 2.1. We are running it for 3,200 kilometers. Tire cost is 6,720. Cost of tire is 6,720. Life of tire done. Estimated sales value done. Vehicle license cost 7,800. 7,800 for 52 weeks. For 4 weeks it is 600. Other overhead cost 41,600 for 52 weeks. For 4 weeks it is 3,200. Done. Calculate the vehicle operating cost per kilometer and per ton kilometer. Now guys, how much is my total cost? My total cost is 24,000 plus 800 plus 10,000 plus 2,400 plus 3,200 plus 16,000 plus 1,400 plus 6,720 plus 600 plus 3,200. 68,320. My total cost is rupees 68,320. Okay. Next, they are asking you vehicle operating cost per kilometer. So 68,320 is there to operate at 3,200 kilometer. So per kilometer it will be 21.35. 21.35. Per ton kilometer they are telling. Guys, try to understand. each and every day, first we travel one day, we travel 2 trips, that I am going to split with load, without load. That is 2 times we go with load for 40 kilometers, 20 days. In a same day, 2 times 20 days without anything, but while going with the 10, which means, guys, always remember, if they ask you commercial ton kilometer while finding out the average, if at all something is having 0 tons, then consider it for calculation of number of kilometers, but don't consider that as observation at all while calculating average. Example, there is one illustration in your study material, go through it. That is 2 into 40 into 20 into 10, 16,000 ton kilometer. That is 68,320 divided by 16,000, rupees 4.27 per ton kilometer. This will be your cost for 4A. The following are the details of the receipts and issue of material CXC. They have given so and so and so. Opening stock is there. It was found 50 kg of material was fraudulently misappropriated, which means it is abnormal loss. Abnormal loss means in issue column, both value as well as units you should write. If at all it is normal, then only units you should write, value you should not write, because value should get a portion to good units. Like rusting and all, you should not write value, normal loss. But here misappropriation, abnormal loss. Prepare a ledgers using weighted average and LIFO. What would be the value of material consumed and value of closing inventory as per 2 methods? So I am going to show it along with the answers only, so it will be easy. So concentrate here. First, opening is there, 1000 kg at 15, it will come in the balance column, 1015. FIFO we are doing, sorry, weighted average we are doing first, 1015, 15,000. Next, purchased 3000 at 16, 3000 at the rate of 16, 48,000. So now the total will become 4,000 units. Total cost will be 15,000 plus 48,000, 63,000. Now per unit will be 63,000 divided by 4,000, 15.75. Sir, in average method, there is no question in our study material, sir. There is no question in our study material under average method. If they do it, or if they give it in examination under average method, simple average method, how to solve it, sir? Guys, one question of CMA material I solved in a marathon. Okay, you can go and check it there. One question I have solved under simple average, go and check it there. Done. Next up, issue 1000 units. Okay, at the rate of 15.75, 15,000. So accordingly, done. Purchase is there, 1500 at 18. 1500 at 18, 27,000. Now, earlier 3000 was there. Now add 1500, 4500. Amount 63,000 was there. Now add 27,000 to it. Sorry, 47,250 was there. Now add 27 to it. 74,250. Now 74,250 divided by 4,500. Average price works out to be 16.5. Next, 1200 issue. at 16.5. Return to supplier 300 units. Guys, try to understand. Here you can't issue to your supplier at the price whatever your issue is happening. He will be like, boss, I gave it to you at different rate. I want that rate. So your issue, return to your supplier, you should always take at what you bought it. That is, you bought it at 18 rupees. No, is going to take back at that only. Accordingly, your average will change. Issue 1000, new average rate. Purchase 500, 17 for this 2000. If you add 500, 2500. For this 32,800, if you add 8,500, 41,200. Now, again, 50 kg. Sure, Ashwini. 50 kg, we are going to fraudulently misappropriated. So 50 kg, we are going to take the amount column also because it's an abnormal loss. Correct? So we'll be left out with 2450. 16 point. This is the FIFO. Sorry, LIFO they are asking, right? LIFO. Under that, opening, we purchased 3000. Now the stock has become like that. We issued 1000. As it's a LIFO, we are going to issue it of the recent stock. So this 1000 will be as it is. From this 3000, it will become 2000. Again we purchased, it will get added. Again we issued 1200. Of course, out of recent stock only will issue. So it will become 300. 2000, 1000. Again 300 is reissued. So that we are not 300, I think 1300, right? 300. Returned. 300 is returned. At the rate we know which it is. 18 rupees only. So that will go. Remaining will be this. Issue 1000. So we are going to issue it out of this 2000. So 1000. Now left with this. Again they are telling purchase 500. That will come and get added to stock here. Next there is a abnormal loss of 50. We are going to issue it out of recent stock. Now if I take the issue columns other than this loss, I will get to know how much is my other than loss and other than returns, whatever is there. If I take, I will get to know how much is a material consumed. If I consider this, I will get to know how much is a closing stock. That's it. Done. Going to fifth one now. Going to fifth one. Measure Gaurav Private Limited is manufacturing and selling two products, black and white, at a selling price of rupees 20 and rupees 30. The following sales strategy has been outlined. Sales planned for the year will be 81 lakh in case of black, 54 lakh in case of white. The selling price of black will be reduced by 10% and white will be reduced by 21%. Break even is planned at 70% of the total sales of each product. Profit for the year to be maintained at 8,26,200 in case of black and 7,45,200 in case of white. This would be possible by reducing the present annual fixed cost of 42 lakh allocated as 22 to black and 20 to white. Number of units to be sold of black and white to break even during the financial year, whatever they have given. Guys, first black, white, total sales. Sales planned is 81 lakh for black, Sales planned for white is 54 lakhs. Done. Break even sales. Break even sales, they are telling that 70% of the total sales. That is 81 into 70%. 56 lakh 70,000 and 54 lakh into 70%, that is 37 lakh 80,000. This is what the break even we are planning. Correct? Yes. Number of units to be sold. Now selling price is how much? Selling price of black will be 20, white will be 30. So units guys, units will be 37 lakh 80,000 divided by 30, that is 126,000 units. That is 126,000 units. Selling price is selling price, they are telling it should be reduced by 10%, and for white it is 20%. So selling price it will be 18. For white it would be 30 minus 20%, which is 24. Units to be sold would be 56 lakh 70,000 divided by 18, 3 lakh 15,000. 37 lakh 80,000 divided by 24, 1 lakh 57,500 units. Done. Amount of reduction in fixed cost product wise to achieve desired profit mentioned at point number 4. Profit for the year to be maintained at 8,26,200 in case of black, 7,45,200 in case of white. Okay. Now one thing you have to understand. What is it, sir? We want to know first how much is a variable cost right now. We want to know how much is a variable cost right now. How we can find it out, sir? Can I tell contribution? Can I tell contribution of break even sales will be equal to fixed cost? Contribution of break even sales will be equal to fixed cost. Yes. Or also I can tell that profit by PV ratio will give you margin of safety. Now to apply this, you don't know the fixed cost. To apply this, you don't know the fixed cost, so that I can compute the PV ratio. Because I don't know PV ratio, I don't know fixed cost also. But in this case, profit by PV ratio is equal to margin of safety, we can find out. How, sir? You know the profit? Yes. You know the margin of safety? No, sir. Guys, if 70% is break even, then MOS will be how much? Remaining no. Out of total sales, 81 lakh, 56 lakh 70,000 is your break even sales, which means margin of safety would be 24 lakh 30,000. In case of white, 54 lakh minus 37 lakh 80,000, 16 lakhs 20,000. I know MOS, sir. Yes. At the same time, we also know the profit. So can I tell profit by PV ratio is equal to MOS? Using this, we can find it out. First one, profit for black is how much? 8,26,000. PV ratio, I don't know, let it be P, is equal to MOS, 24,30,000. Now, 826,200 divided by 24,30,000 will give you 30%. 34%, sorry. PV ratio of black is 34%. What about white, sir? Guys, profit is how much? 745,200 divided by margin of safety 16,20,000, which will come to 46%. Now, we know that at break even, contribution is equal to fixed cost. I know the break even, 56,70,000. I know the contribution, 34%. $19,27,800. This will be fixed cost of black. For white, it will be 37,80,000 into 46%. Fixed cost of white will be 17,38,800. But they are asking amount of reduction. They are not asking how much it should be. Reduction they are asking. Right now it is 22 lakh for black. So how amount of reduction required is 22 lakhs minus 19,27,800. 2,72,200. For white it will be 20 lakhs minus 17,38,800. 2,61,200. This will be the reductions. Done. B. Measure. They are asking you to calculate the comprehensive machine hour rate. Sir, what do you mean by comprehensive machine hour rate, sir? Try to understand, guys. Generally, the wages relating to machine operator is direct wages. However, if they ask you to calculate comprehensive machine hour rate, then you should also include the wages relating to operator also as a overhead. You should treat that also as a overhead. Then, if you consider that while calculating hourly rate, you will call it as a comprehensive machine hour rate. They purchased a machine costing 29,14,800. It has a salvage value of 150,000 at the end of its effective life of 15 years. So, 29,14,800 minus 1,50,000. Rupees 27,64,800 is depreciable value. Effective week 15 years. Ordinarily, machine is expected to run for 4,500 per annum, but it is estimated that 300 hours per annum will last due to normal repairs and maintenance. So effective hours per annum will be 4,200 hours. Effective hours is 4,200 hours. The other detail, repair and maintenance during the whole life of the machine are expected to be 5,40,000. Insurance premium, 2% of the cost of machine. Oil and lubricant required for the operating a machine. power consumption 10 units per hour, number of power consumption, no power consumption during repairs and maintenance. Salary to operator 24,000, operator devotes 1/3 of his time. So try to understand. First, you can calculate per annum only or per month, anything is fine. Let's calculate per annum, no worries. Now guys, 27,64,800 should be for 15 years. So per year it is 1,84,320 per year. Depreciation is 1,84,320. Done. Next, repairs and maintenance per annum 5,40,000 divided by 15. That is 36,000. Insurance premium per annum 2% of cost 29,14,800 into 2%, 58,296. Oil and lubricant 87,384. Power consumption 10 units per hour at rupees 7 per unit. No power consumption during repairs and maintenance. So 4,200 only is consuming power. Per hour 10 units. So total units we are consuming is 42,000 at rupees 7, which will come to 2,94,000. Salary of the operator 24,000 per month. Per annum it will be 24,000 into 12. However, that operator is giving only 1/3 of his time. So into 1/3. 96,000. So my total cost per annum will be 184,320 plus 36,000 plus 58,296 plus 87,394 plus 294,000 plus 96,000. 7 lakh 184,320 plus 36,000 plus 58,296 plus 87,384 plus 294,000 plus 96,000, 7,56,000. Done. Divided by effective hour 4,200. If it's abnormal loss, I wouldn't have reduced. As it's a normal, I am going to reduce. That is rupees 180 per hour. Comprehensive machine hour rate is rupees 180 per hour. See contract account, ignore. Not there for you guys. With that, we have completed May 2019 question paper also. This is in which is important. In this, no theory questions are not that great or not that important. Go through that once anyhow. With that, we have completed May 2019. Next, we'll be discussing November 2019 at 8:40 p.m. Okay, we'll be discussing in another 4 minutes. Done. No audio. Yeah. Got it. Yeah. Got it. I hope now I'm audible. Sorry. I'm audible now. I'm audible. Hi. Don't worry. Sorry. My bad. I turned off the mic. Yeah. Sorry. So first one, I hope no doubts are there. I hope you guys saw how I solved it. So I will continue with the second one. Second one, what I was telling was, it is your Job costing study material question. Yeah, got it. Job costing study material question. So I just split it, the direct wages and all. Now you see, factory overhead. Guys, this factory overhead, we can take it as a percentage of wages. Percentage of wages. Department A, 12,000 was factory overhead when the wages was 12,000, which means 100%. Department B, 6,000 is a factory overhead and the wages was 8,000, which means basically 75%. Department C, 9,000 when the wages was 10,000. Can I tell 90% of the wages is overhead? Department D, 17,000 when the wages is 20, which will come to 85%. Now overhead I am going to allocate the same way. 100% of A. A how much? 16. So 100% of A will be 16 only. B 28. 70% of 28. 75%. 21. C 90% of wages. 90% of A. 8. 7.2. Next 85% of 8. 8 into 85%, 6.8. So my factory overhead will be 16 plus 21 plus 7.2 plus 6.8, which will come to 51. How many questions are so far completed? I think three are completed, fourth one we are in. As that May 2019 was lengthy, I hope the same length won't come in your day after tomorrow's exam. Okay, don't worry, don't. But yeah, your effort you have to do now. So it will be 51. Overhead will be 51. Done. Next, selling expense. Guys, selling expense, we can do it as a total of or percentage of factory cost, because you don't know the sales right now under job. So I'm going to take the factory cost. How much it will be, sir? Factory cost, guys, 2 lakh plus 50,000, 2 lakh plus 50,000, 250, 256 plus 44, 256, 260, 260, 3 lakh, right? 3 lakh. Guys, 3 lakh is a factory cost. So 90,000, 3 lakh, which is basically 30% if I am not wrong. 30%. Now here the factory cost will be 120, 180 plus 51, 231. 231 is your factory cost plus selling overhead, which is 30% of it, 69.3. 231 plus 69.3, 300.3. That is your total cost. What they are telling? Add 20% on selling price, which means 25% on cost. Sir, how that 25 and all? Do the cross multiplication, that is also fine. That is, selling price you take it as 100, then total cost will be 80, correct? So 80 means 300.3, 100 means question mark. You will get the selling price. Or you can just take 300.3 into 25%, 75.075. So your selling price will be, or job price will be 300.3 plus 75.075, which will come to 1. Also, there is a chargeable expense, 20. Chargeable expense is there, 20. So the prime cost is there, separately prime cost is there, 200. Prime cost 200, add factory overhead. That we calculated and I showed you 51. So total it will come to 251. Selling overhead is 251 into 30%. 75.3. Total cost would be 251, 326.3 into 25%. That is 81.58 or 575. So plus 326.3, 407.88. 407.88. 407.88 will be where this thing. Give me a second. I am unable to access your chats. Give me a second. Give me a second. Yeah, fine. A factory produces two products, A and B, from a single process. Joint process cost is so much. Okay. Sales A 100 units at 600, B 120 units at 200. Apportion the joint cost on the basis of physical quantity of each product, contribution margin method. Determine profit or loss under both the methods. So, guys, first physical quantity method. For that, I am going to take the total joint cost. 30,000 plus 9,600 plus 12,000 plus 32,000. 83,600. Done. On physical unit method, 83,600 divided by 220, 380. 380 into 100 for A, for B. 380 into 100, 38,000. 380 into 120, 45,600. This is your joint cost allocation. Okay. Selling price or sales, you can take it as sales. 100 units at 600, 60,000. 120 units at 200, 24,000. So, in first case, A giving you a profit of 22,000, B giving you a loss of 45,600 minus 24,000, 21,600 in the quantity method. Now, contribution margin method. Sir, contribution margin method, what we should do, sir? First, you should calculate only variable joint cost. Variable joint cost. That is 30,000 plus 9,600 plus 12,000. 51,600. Now, 51,600 divided by 220. Variable cost per unit. 234.54. Now try to understand. Sales 60,000 and 24,000 minus variable joint cost. Variable joint cost will be, guys, 30,000 plus 9,600 plus 12,000, 51,600 divided by 220 into 100, 23,455. 23,455 and 51,600 minus 23,455, 28,145. That will give you contribution. Contribution will be 60,000 minus 23,455, 36,545, 24,000 minus 28,145, negative 4,145. Always remember, once you get negative, then fixed cost also you won't apportion there, which means you leave it here. Fixed cost you apportion only and only to the A, that is 32,000. which means first one will give you a loss of 4145. This one will give you profit of just 4545. This is how you are going to do it under this one. When the volume is 4000 units, average cost is 3.75 per unit. When the volume is 5000, average cost is 3.5. Guys, try to understand. Total cost. Units. They have given 2 units. 4000 units they have given. 5000 units they have given. When the 4000 units, total cost was 4000 into 3.75. 15,000. When it's a 5000 units, it is 5000 into 3.5. 17,500. So now guys, 2500 is a change in cost when change in output is 1000, which means per unit it is 2.5. What is this, sir? Variable cost. What is a variable cost per unit formula? Change in cost divided by change in output. 2.5. Done. Variable cost per unit is 2.5. Now fixed cost, you can take anything. Let's say 4000 units. For 4000 units, variable cost was 2.5, which will come to 10,000. But the total cost was 15,000, which means 5,000 unit is fixed cost. Profit volume ratio. You know the variable cost. Break even they have given it as 6,000. Break even they given it as 6,000. What do you mean by break even, sir? Break even is nothing but, guys, at 6,000 unit, you are going to, that is, make no profit, no loss. That means for 6,000 units, your total cost will be equal to sales, which means I can tell it as 6,000 into variable cost is 2.5. 15,000. Fixed cost is 5,000, which will come to 20,000. Which means at 20,000 units or at 20,000 rupees is your total cost, and we know that at break even cost is equal to sales. Can I tell my selling price will be 20,000 divided by 6,000 units, that is 20,000 divided by 6,000, rupees 3.333333. 3.33. Okay. Variable cost is 2.5, which means 0.83333. Now guys, can I tell 0.8333333 divided by 3.333333, that is contribution divided by sales, which will give me PV ratio 24.99, that is 25%. My PV ratio is 25%. I hope you guys understood how I calculated PV ratio. Guys, before going to exam, you have to go through this one also. Nice question it is. Calculation of PV ratio in a different way. Done. Now, going to the second one, guys. This is profitability of customer. This is ditto question what is there in your study mat, so I am not going to touch it now. This is the overhead question, which is, of course I am going to do it. Why, sir? I am expecting it to come. That is treatment of under absorption and over absorption. ABS enterprise produce a product and adopts the policy to recover factory overhead applying blanket rate based on machine hours. So whatever the overhead it is, overall we are going to recover on machine hour basis. The cost records reveal the following. Budgeted production overhead is so much, budgeted machine hour is so much, which means recovery rate. I will calculate on budgeted hours only, no. 1035,000 divided by 90,000. Rupees 11.5 per hour. Rupees 11.5 per hour. Now, actual machine hours worked is 45,000 hours. Actual production overhead is so much. However, guys, see here. Production overhead includes 50,000 paid as a court's award, court's judgment, which is abnormal. Don't consider it to calculate under absorption over absorption. So, to calculate under absorption over absorption, your actual should exclude this 50,000. Okay, sir. Wages paid due to strike period, again abnormal. Don't consider it. Okay. Stores written off, again don't consider it. 22,000. Done. Previous year's book current year, not current years, so reduce it. So your actual production overhead for computation of your under absorption over absorption is 8,80,000 minus 50,000 minus 38,000 minus 22,000 minus 18,500, 7,51,500. Okay. How much is absorbed, sir? Absorbed will be 45,000 into rupees 11.5. Rupees 5,17,500. This is your absorbed. Actually 7,51,500. Which means we are under recovering, under absorbing. How much, sir? Rupees 2,34,000. We are under recovering 2,34,000. Now, they are telling that, so find out the amount of under absorption. Under absorption is, guys, 2,34,000. Way of treating it, try to understand. 1/3 is due to defective production planning. Straight away, out of 234,000, guys, 1/3 I am going to charge it to costing P&L, because that is our production plan defect, not due to increase in the prices and all, not uncontrollable, it was controllable. So around 78,000 straight away I am going to charge it to costing P&L. Okay, remaining 2/3, sir, 234,000 into 2 divided by 3, 156,000. That is due to increase in the cost, which means here I am going to calculate the supplementary rate and I am going to charge it. If at all they give the WIP, you should take the equivalent WIP for the actual production. Now, anyhow, they haven't given. They are told production. We produced 30,000, in that sold 27,000, which means closing 3,000. However, try to understand, this 156,000 is extra cost incurred to produce 30,000 supplementary rate. Already normal rate is passed, charged. This is extra rate, again we are going to charge. To customers, no, only for accounting purpose. Customers, you can't ask money back. Rupees 5.2. Instead of charging everything to costing P&L, we will find out normal cost and we will apportion it to normal cost only. Okay. Of course, profit will fall anyway. But instead of charging to costing P&L, correct treatment we are doing. That's it. You can't charge it extra to customers. No, you can't recover from customers now. Done. Now, 5.2 per unit. What we should do, sir? To the cost of sales, I should charge 27,000 into 5.2. 1,40,400. To the closing stock of finished goods, cost of closing stock of finished goods, 3,000 units are there. I should charge 3,000 into 5.2. 15,600. This simple treatment. This simple treatment I should do. Easy question. If at all this question comes in examination, that too for 7-8 marks though, you guys are the luckiest. Correct. Proceeding. A hotel is being run in a hill station with 200 single room. The hotel offers a concessional rate. This is the same question of your ICA material service costing. I'm not going to see again. However, there was one confusion. What is it, sir? Winter, that electricity they are telling, no, 30 rupees. Sir, how do you know that in winter it is off season? In examination they have clearly given. Winter season to be considered as off season, which means in your 6 months of off season, 4 months is winter. 6 months of off season, 4 months is winter. Okay, I'm not going to do that. I assume you guys know about it. Same question it is. So next one, they are asking you to prepare the value of material purchased. You have to calculate cost sheet, which means value of material purchased. If they are asking, very simple guys, by looking at question only you should understand it is a reverse calculation. It's a reverse calculation question. Now raw material opening and closing they have given, WIP opening and closing they have given. Firm incurred the following expenses to produce 1 lakh units during 1 month. Consumable stores spares of a factory, factory overhead, research and development for the process improvement, R&D. After factory cost you should add to arrive at a COP. To arrive at a COP you should add it if you know research and development. Quality control, again after factory cost you should add it to arrive at a cost of production. Packing cost, secondary. Selling and distribution or in a cost of sales you can show it as separate line item. Lease rent of the production asset. Lease rent of the production asset, guys, you can treat it as a direct expense or you can show it as a factory overhead. Better show it as a factory overhead. I hope you remember the keyword which I gave to differentiate between direct expenses and factory overhead. Direct expenses and factory overhead. Direct expenses, trash, DP. Factory overhead, ADI is DSLR. T, technical know-how. R, royalty. A, amortization of molds, jigs and all. S, specific software. H, hiring charges of the particular equipment. D, drawings and designs cost, not drawing and design department. P, power, fuel and steam. Coming to factory overhead. A, again amortization of the patterns and all. Okay, jigs, those things. D is your depreciation. I is your indirect expenses, indirect labors, correct. Your S is service departments, these things. One more D is drawings departments overhead, and S is stores and spares. L is lease rentals. Lease rentals, that's what the lease rentals is all about here. That L is lease rentals. One more R is repairs and maintenance. Now you can treat it as a factory overhead. Administrative expense, general, it will form part of your cost of sales. Selling and distribution, cost of sales. Finished goods, after COP you should add opening. Finished goods, closing, minus. However, 5,000 they have given. What you should do, sir? Cost of production you should calculate. Total cost of production divided by units produced. How many units you have produced in total? They are telling you have produced 1 lakh units. So divided by 1 lakh. Divided by 1 lakh. Okay. Done. Next. Guys. Defective output, which is 4% of the target production. That is 4,000 units. realizes 61 rupees scrap recovery. You should reduce it while arriving at COP, which means now cost of production, cost per unit, you are not going to consider total units produced, you are going to consider 96,000. Closing inventory is valued at COP. Cost of goods sold excludes admin expense is 78,26,000. They have given COGS. For this, you adjust the COP, closing stock, opening stock, you will get. Direct employee cost is half of the cost of material consumed. You will find out cost of material consumed, or you will take the cost of material consumed as X. Then the employee cost will be 0.5x. Your prime cost will be 1.5x. Prime cost will be 1.5x. If there is no direct expense, there are no direct expense if I am not wrong. Yeah, there are no direct expense. Selling price you are going to take. Easy. You are going to do the reverse calculation. You will get the answers. Look at this fourth one. Zico Limited has its factory in two locations, Nasik and Satara. Rowan plan is used in Nasik and Halsey plan is used in Satara. Standard time and basic rate are same for the job which is similar and is carried out on similar machinery. So they are telling basic wage rate, because premium, of course premium will change. Why? One uses Halsey, one uses Rowan. But they are telling standard time remains same. Normal working hours is 8 hours per day in a 5 days week, which means in a week we are planning that to work 40 hours. Job at Nasik plant factory is completed in 32 hours, while Satara is taken 30 hours. So this is time taken. Conversion cost at Nasik and Satara are 5,408. Sir, conversion cost means what, sir? Conversion cost means cost incurred to convert the raw material into finished goods. Basically, were direct wages plus factory overhead. Direct wages plus factory overhead. 4950. Overheads account are rupees 25 per hour. They are asking you to compute normal wage, how much it is, and compare the respective conversion cost. They are asking you to calculate the conversion cost. Very simple. All you have to do is, guys, direct labor for Nasik. What they are telling? Rowan plan, or that is time taken. Job is completed in 32 hours. Great. And what is hourly rate? We don't know. Can I take it as R? Yes. Time saved. Guys, try to understand. Instead of taking so many integers, like now you can tell time saved, I will take it as this thing, sir. No, time saved, we know that. How much it is? 8 hours. Because 40 hours is allowed. Time taken is 32, which means time saved is 8 out of 40 into time taken is how much, sir? Time taken is basically, guys, 32 hours into hourly rate. I don't know. I will take it as R. So I can take it as 32 R plus 32 divided by 5, 6.4. 6.4 R, which will come to 38.4 R. 38.4 R. Done. So direct labor. One is Nasik, one is Satara. Nasik 38.4 hour. Now going to Satara. Satara is using which one? Halsey. So time taken. Time taken is 30 hours. Okay. Hourly rate they are telling it is same. I will take it as R itself plus half of time saved. Time saved is 10 hours into rate R. I will take it as 30 hour plus 5 hour, 35 hour. 35 hour. Overheads. Overheads what they are telling? 25 per hour. That is 25 into 32 for Nasik. 25 into 32. That is 800. For Satara it is 30 into 25. 750. For Satara it is 750. That will give you total conversion cost, which is 5408 and 4950. Now if I write it in equation, guys, 38.4 hour minus 800 is equal to 5408. 35 hour minus 750 is equal to 4950 minus plus minus, basically 3.4 hour minus 50 is equal to 458. R is equal to 458 plus 50 divided by 3.4. Or you can tell it as 5408 minus 800. 4608 is equal to 38.4 hour. R is equal to 120. R is equal to 120. Instead of solving this, we can take it that way easily, because two equations are there. No, R is equal to 120. Find out the normal wage rate, rupees 120. Compare the respective conversion cost. Direct labor you can split into normal and bonus and overheads again, and you can compare it. A product passes through two distinct processes. A product passes through two distinct processes before completion, process 1 and process 2. Raw material used 10,000, of course only in the process 1. 75 is the cost. Transfer to next process is 9,000, 8,200. Normal loss is 5%, 10%. Direct wages, direct expense 50% of wages, 65% of wages. Manufacturing overhead. Realizable value of scrap. 8,000 units of finished goods were sold at a profit of 15% on cost. There was no opening and closing. They are asking you to prepare process 1, process 2, finished goods, normal loss, abnormal gain. I will show it with the solution here. That will be easy. If I show it with the solution, that will be easy. Okay. So instead of wasting time by solving, by drawing the process accounts and all, I will better show it here only. First, process 1 account. Guys, 10,000 units into 75 rupees in amount column. 10,000 units, 75, 7,50,000. Next, direct wages 3 lakh. Next, Direct expense 50% of direct wages 150,000. Next, manufacturing overhead 25% of direct wages, that is 75,000. Done. Now they are telling out of 10,000 5% is normal loss. So normal loss unit column I will write 500. Amount column should I write? Yes sir. Why? 13.5 is realizable. 13.5 into 500, which will come to 6750. Normal loss 500, 6750. But the best part is, if at all 10,000 we introduced and only 500 was loss, we should have transferred 9,500. But we are transferring only 9,000, which means 500 is abnormal loss. 500 is abnormal loss and 9,000 is transferred to next process. Sir, that will be valued at what rate? Sir, for that, very simple. Total cost 12,75,000 total of debit side minus recovery from normal loss 6750 divided by total units introduced 10,000, normal loss 500. I will get a rate per unit, which is basically here they are telling 133.3. I am going to value abnormal loss as well as my process 2 at that. Now going to process 2. From process 1, 9,000 at this rate. Done. Next. Normal 10% is there. So 9,000 is introduced. You should take actual introduced. So 9,000 into 10% of it, which will come to 900. So my normal loss will be 900. However, there is a scrap recovery. How much? 145 rupees per unit. 10 that is 900 into 145. 1,30,500. Next up, direct wages debit side. This one 65% of 560,000, 15% of 560,000. Done. Also try to understand, we introduced 9,000. In that, if at all actual loss was 900, the output must have been 8,100. Oh my god, the output is not 8,100, it is just 8,000, it is 8,200, which means 100 units extra you produce than what you thought. Abnormal gain. Sir, how to be valued? Very simple. Total of this, which will come to 22,09,500 minus 1,30,500 divided by how many units? 8,100 units. That is total minus introduced minus normal loss. We'll get the rate per unit, which is basically 256.67. Accordingly, you are going to multiply here as well as finished goods. Now going to finished goods, from process 2 we got it, and whatever we sold will transfer to COS and balance carried out. Now normal loss, try to understand. Normal loss account will come in the amount only and only if the scrap recovery is there. Best part is scrap recovery is there. That is what you are going to write: bank account debited to normal loss or CLC account debited to normal loss. So in the normal loss it is by cash. Process 1, process 2. How much I recovered? However, accordingly I charged it. But try to understand, in the process 2, we thought 100 units are more normal loss and we credited a normal loss with that. However, that is not correct. So what you should do, debited normal loss with that, now credit it back to the abnormal gain with the salvage value of that. So abnormal gain account also, process 2, in that 100 is salvage value, remaining only will go to costing P&L. This is what I told you. Abnormal loss also you are going to do accordingly. After adjusting whatever the loss with the CLC, that is nothing but by cash you can take whatever it is salvage realization relating to abnormal loss. Balancing figure you are going to charge it to costing P&L. Listen here. We'll go to A later, but B we'll see first. A standard cost for a chemical mixture is 60% of material A is required, 40% of material B is required. Standard loss is 25% of output is on output. Try to understand. Majority of the cases they will tell on input, but in this question in examination they told it on output. If anyone by hearted and went, gone. Now, how many units are good process? 680, which means 25% on this is how much? Because we need standard for actual, that is 680 into 25%, 170. So your standard input should be 680 plus 170, around 850 kgs. Okay, how much A, how much B, sir? 60% and 40%. 60% A, that is 850 into 60%, 510, and 850 into 40%, 340, 510 and 340. Done, sir. Done. This is what? This is your standard quantity. Actual quantity is 540 and 260. Standard rate is 50 and 60. Actual rate is 60 and 50. Now, revised standard quantity, that is actual quantity total, 540 plus 260, 800 in the ratio of standard, that is 800 in the ratio of 6:4. 800 into 60%, 480, 800 into 40%, 320. This is your RSQ. Now, if you want me to write in table, I can write it as standard quantity, actual quantity, standard price, actual price, revised standard quantity. Standard quantity 510 and 340. I hope you guys understood how we arrived. Always and always remember, in marginal costing, standard means standard for actual. So actual quantity 540 and 480. Your standard price 60 and 40, 60 and 50. Your actual price, that is 50 and 60. Actual price 60 and 50. RSQ 480, 320. Using this, you are going to calculate the things. Cost variance, standard quantity into standard price minus actual quantity into actual price. Material price variance, standard price minus actual price into actual quantity. Material usage variance, standard quantity minus actual quantity into standard price. Mix variance, revised standard quantity minus actual quantity into standard price. Yield variance, revised standard quantity minus standard quantity, or standard quantity minus revised standard quantity into standard price. Basically guys, formula don't buy it. Try to understand how it works. If the revised standard, new standard is more than old standard, then it is adverse. If the actual is more than even new standard, then that is adverse. If the standard is more than actual, favorable, because cost. Like that you should think. Done. Going to A now. So they are asking, calculate the lowest price that can be quoted that the company can earn the same profit as it is earned in the current year. So this is decision making question, which means it will be relating to marginal cost. PJ Limited manufactures hockey sticks. It sells a product at rupees 500 each and makes a profit of 125% on each stick, which means cost is 375 right now. Company is producing 5,000 stick annually by using 50% of machinery capacity, which means machine has a capacity of 10,000 hockey stick. Cost of each stick, direct material variable, direct wages variable, works overhead 125, in that 50% is fixed, 50% is variable, that is 62.5 is variable, 62.5 is fixed. Selling expense 50 and 25, 50, in the 25 is variable, rupees 12.5 is variable, rupees 37.5 per unit is fixed. This all they have given for 5,000 level. The anticipation for the next year, cost will go up fixed charges by 10%, direct wages 20, direct material 5. There will not be any changes in the selling price. There is an additional order for 2000 sticks in a next year. Calculate the lowest price that can be quoted so the company can earn the same profit as it has earned in the current year. See, in your recent exams, they are asking marginal costing on decision making based. So this is one of the question. It might help you out in examination. You never know, because this is of November 2019, like 5 years back question. So you never know, it might come back. Of course, not with the same things, same way. Okay. So how to solve it, sir? First, calculate how much is our current profit. Our current profit is 5000 units into rupees 125 per unit. Rupees 6,25,000. 6,25,000. Now, guys, works overhead. I am going to divide it into two parts. Variable, fixed. Variable, how much they are telling? 62.5, half of it. 62.5. That I will keep it as it is, no problem. That I will keep it as it is, no problem. But fixed, let me calculate the total. Let me calculate the total. How much it will be, sir? 62.5 per unit when you are producing and selling 5000 units. Which means the total works overhead fixed is 3,12,500. Done. Next, selling overhead. Again, fixed and variable. Again, fixed and variable. Variable is how much, sir? 25% of it, that is rupees 12.5. Fixed is how much, sir? Per unit 37.5. However, variable let it be, no problem, but fixed we have to calculate. Total is how much? 37.5 into 5000, which will come to 1,87,500. 1,87,500. Done. Now, we have to calculate how much is the price we are going to quote to earn the same profit as in the current year. Guys, revenue I am going to make. Revenue I am going to make is, see, my capacity is 10,000 units, which means 2,000 is well within that. I don't have to sacrifice anything and all, which means nothing to be sacrificed. I can produce it as an extra, which means by selling 5,000 units at the rate of 500, because selling price is not changing for this 5,000. 5,000 into 500. I am going to make 25 lakh rupees. Correct. Now, this 2,000 units, let's say I am going to sell it at X. The price will be 2,000X. So my revenue is, don't write now 25 lakh 2,000X. 25 lakh plus 2,000X, because there is a variable in it. Match. So now cost will be how much, sir? Material cost 150. They are telling it will get increased by 5%. So material cost will be 150 plus 5%, which is 157.5. Direct wages 50 is there, and it is increasing by 20%, which is basically rupees 60. Done. Variable units, variable it is not changing. So variable overheads, this is remaining 62.5 itself. Okay. Next one is remaining 12.5 itself. Okay. Which means both together will be 75 only. This is important. Variable won't change. However, fixed is there, no? Total fixed how much, sir? 3,12,500 plus 187,500. 5 lakh. Last year 5 lakh was fixed, but now they are telling this is increasing by 10%. which means new fixed will be 5,50,000. New fixed will be 5,50,000, which means, guys, my total cost will be variable cost 157.5 plus 60 plus 75, 292.5 per unit. So I know how many units I am producing. Don't take it as X, Y and all. Why? Because I exactly know how many units I am producing. 7,000, which is basically 20 lakh 47,500. 20 lakh 47,500 plus fixed cost 5,50,000, which means my next year's total cost would be rupees 25,97,500. What we are expecting, boss, my revenue will be 25 lakh plus 2000x. My cost will be 25,97,500. That should give me same profit like last year, which is 6,25,000. Which means how much will be my X? X will be 6,25,000 plus 97,500. 7,22,500 divided by 2,000. Rupees 361.25. My selling price, which I should quote minimum is 361.25. If I quote less than this, then I won't be able to make the same profit what I used to do earlier. 361.25. Mark it as last minute revision for your tomorrow's revision. Actually, we are in the last minute of the examination only, but still that will be there. No, before going to exam, I have to see and go this question. That is this question. Decision making question. Nice question. Please see and go this. Sixth one. Guys, composite cost units. Important question. Go through that. Journalize the following transaction. Credit purchase of material. SLC to CLC. As it is a non-integrated, doesn't matter credit or cash. Manufacturing overhead charged to production. WIP to manufacturing overhead. Selling and distribution overhead recovered from sales. Cost of sales to S&D. Indirect wages incurred. Wages control to CLC. Material returned from production to stores. That is SLC to WIP. And this cost unit, mark it as important theory question. As I already told you, zero-based budget, one of the important theory question. With that, we have completed 2019 paper. Now, sir, May 2020 you missed it, sir. I didn't miss. COVID missed. So, 2020 May exams were not there. In November it was there. So, guys, we'll do one thing. Sharp at 10 PM we are starting. Yes. Guys, shall we start? Shall we? With the November 2020 attempt. Hi. Yes. G Limited manufactures a single product for which market demand exists for additional quantity. Present sales of 6 lakh utilizes only 60% of the capacity of the plant, which means if we utilize the 100%, we will be able to sell to the extent of 10 lakh. The following data is available. Following data are available. Selling price 100, variable cost 30, semi-variable cost 60,000 fixed and 5 rupees per unit. Fixed expense 1 lakh at present level, estimated to increase by 25% at and above 80% capacity. Okay, done. You are required to prepare a flexible budget has to arrive at a operating profit at 60%, 80% and 100%. So to arrive at a operating profit. Now guys, sales at 3 levels. I will show with the answers, that is better. Sales first, 100 rupees at 60%. Guys, first, how many units will calculate? 6 lakh is the sales at 60%. So 100 rupees per unit, which means 6,000 units. Correct. So 80% means 8,000 units. 100% means 10,000 units. Now sales will be, guys, 6 lakh, 8 lakh and 10 lakh. 6 lakh, 8 lakh, 10 lakh. Next, variable cost 30 rupees per unit. That is 6,000 into 30. 6,000 into 30. 1 lakh 80,000. 8,000 into 30, 2 lakh 40,000. They are doing it under marginal. If you want, you can do it. Otherwise, normally also you can do. We'll do it. No worries. We'll do it as per that only. Try to understand. In semi-variable also, there is variable of 5 rupees. So they are taking variable as 35. Now, 35 into 6,000. 2 lakh 10,000. 35 into 8,000. 2 lakh 80,000. 35 into 10,000. 3 lakh 50,000. Now we'll get the contribution. Sales minus variable contribution. Now going to fixed cost. 60,000 is fixed. No doubt in that. In all the 3 levels, 60,000 is fixed. However, fixed expense 1 lakh at present level. So at 60% it is 1 lakh. Estimated to increase by 20%, 25% at and above 80%. That is at 80% and 100%, it will be 125,000. Which means, try to understand, guys. Right now it is 1,60,000 total fixed cost. However, once you go for 80 and 100, it will become 1,85,000. 1,60,000, 1,85,000, 1,85,000. You will find the operating profit. Simple. Done. Now going to B. Sir, how many papers more? 11 more. Now going to B. Identify the best possible product mix. Calculate the total contribution from the best possible product mix. So it is the key limiting factor question. By just looking at this thing, you can tell it is a key limiting factor question. See, Moon Limited produces 3 products: X, Y, Z. Product mix. Variable overhead, you know. Direct material cost, you know. Direct labor also, you know. Department A, Department B. Rate per hour, hours per unit of X, hours per unit of Y, hours per unit of Z. From the current budget, further details are below. Annual production at present. Estimated selling price. Sales department estimates possible sale in a coming year. So everything is more than what we are selling now. There is a constraint in the supply in the department A, and its manpower cannot increase beyond its present level. So guys, whenever there is a key limiting factor, how to decide it, sir? You should rank it based on the contribution per unit of key limiting factor. You are not going to calculate the normal contribution. You should calculate contribution per unit of key limiting factors. Then you should decide. See here. Right now, X 6 hours of A we are using. And how many units? 10,000 units we are producing. which will be 60,000 hours. Y, 10 hours per unit we are using, and Y we are producing 12,000 units. 120,000 hours. Z we are producing how many units? 5 hours we are using and producing 20,000 units, which means basically 1 lakh hours. So around 280,000 hours we are having in total. But if at all we want to satisfy the market, then we need how many hours? 12,000 units of product X if they want. Per unit it takes 6 hours. 72,000 hours we want. Y, 16,000 is demand. If you want to satisfy 160,000 we want. 20,000, 24,000, correct, into 5, 1,20,000, which means we need 3,52,000 hours to satisfy the market. Can we satisfy that? No. Why? We have only 2,80,000. So now the department A production hours is constraint. Now what you should do, sir? You should calculate contribution per unit of per hour of department A. How to find it out, sir? Contribution. Very simple. Sales per unit X, Y, Z. Sales per unit X, Y, Z are 312, 400, 240 minus variable cost. Guys, variable cost has 3 things. Direct material, which is 160, 120, 80. Variable overhead, 8 per unit, 20, 12. Department A wages, 4 hours. For X, it is 4 rupees per hour, 6 hours, 24 per unit. 40 per unit and 20 per unit. Department B, 8 rupees per hour, 48 and 120 and 88. Now I will find out contribution. That is 312 minus 160 minus 8 minus 24 minus 48, 72. 72 per unit. This is contribution per unit, not per hour. 400 minus 120 minus 20 minus 40 minus 120. 100. 240 minus 80 minus 12 minus 20 minus 88. 40. Now, how much will be contribution per hour? AA. Guys, X 72 per unit, and each and every unit is using 6 hours of A. Each and every unit is using 6 hours of A. So, which means contribution per unit per hour is rupees 12. Next, 100, but we are using 10 hours, which is contribution per unit is rupees 10. Next one, 40, but for 5 hours, rupees 8. Which means rank wise, X first rank, Y second rank, Z third rank. X, Y, Z. Which means X you are going to produce maximum. How much, sir? Whole 12,000 units. So 12,000 units we produce, and per unit it is 6 hours, correct? So here only around 72,000 hours are blocked. 72,000 hours are blocked out of 280,000 hours available. Remaining 208,000 hours are there. Now, Y 16,000 hours are there. Guys, sometimes minimum they will tell, first you have to satisfy minimum, then you have to calculate how much more I can produce. For example, now they will tell Z 10,000 to be produced. Now 10,000 into 10, which is 1 lakh, you should block it. Oh, sorry, 10,000 into 5, 50,000. You should block it out of 280,000. Then remaining you should distribute among X and Y. Still, if something remains, then you should produce Z more. Like that it is. 16,000 into per unit, it is 10 hours. 160,000 hours. 48,000 hours remaining. In that, how many units of Z can be produced? 48,000 hours divided by 5. 9,600 units of Z. 9,600 units of Z will be produced. This is the best possible production mix. Contribution from the best possible production mix. Guys, 72 rupees from per unit from 12,000 units. 100 rupees per unit from 16,000 units. And 40 rupees per unit from 9,600 units. This will be the best contribution. This will be the best contribution. Done. Going to C. When will this get over, sir? Even I don't know, madam, what to do. We'll see till I have energy. A company plans and process 6750 units of raw material in a month to produce M and N. The process yield M 80%, N 12%, process loss 8%. So whatever relating to this, the cost should be apportioned between M and N. The cost of raw material is 80 per unit, which means 6750 into rupees 80. Raw material cost. Rupees 5,40,000. Next. Processing cost is 225,000, of which labor cost is accounted for 60%. So 225,000 into 66%. 1,48,500 is labor cost. So other cost is how much, sir? 76,500. Now they are telling labor charge to product M and N in the ratio of 180. So for this M and N, this they are telling 180, which means 148,500 divided by 180 into 100. 82,500 to M. 148,500 minus 82,500, 66,000 to N. Okay. Now, prepare a comprehensive cost statement. Apportion the joint cost among M and N. Total cost of M and N. So now, material. Guys, material cost we can apportion on unit basis. That is 80 to M and N. Material cost in the ratio of 80 and 12, 92. That is 5,40,000 divided by 92 into 80. Sir, percentage I can apply directly. No, sir, don't do that. Percentage I can apply directly. Don't do that. Why, sir? Because process loss is there. No, that also should get apportioned to only M and N. Which means, guys, total here 5,40,000 plus 76,500 is there, no? 6,16,500. That let's apportion in the ratio of 80 and 12. That is into 80 divided by 92. That is 536,087. 536,087, and one more it is 5,40,000 plus 76,500 into 12 divided by 92. 80,413. Labor, we already know that 82,500 and 66,000. So this is apportionment. Joint cost done. Total cost will be how much, sir? 536,087 plus 82,500, 6,18,587 and 80,413 plus 66,000, which is 1,46,413. D, anyhow, it's not there in your syllabus now. Going to second question. X Limited manufactures two types of pen, super pen and normal pen. Okay, what they are asking here, cost per unit and total cost, profit per unit and total profit, basically cost sheet it is. The cost data for the September: direct material, direct wages, production overhead. Direct material cost of super pen was twice as much as direct material of the normal pen. So per unit of super pen, if the direct material is X, then, or for normal pen, super pen, if the normal pen per unit is X, per unit is X, then super pen it will be 2X. Direct wages for the normal pen were 60% though of those of super pen. If the wages, if you take it as Y for super pen, for normal pen it will be 0.6Y. Done. Production overhead per unit was same at the rate for both the types. So production overhead per unit is same, it seems. Okay. Administration overhead was 200% of the direct labor for each. Okay. Selling cost is rupees 1 per super pen. So normal pen there is no selling cost. Okay. Production and sales. Produced 40,000 and 120,000. Sales 36,000 of super pen, which means normal pen they haven't given. Selling price was 30 per super pen. They are asking only for super pen, cost per unit and total cost. Guys, try to understand. First, direct material 2x per pen, and how many units we are producing? 40,000 units, which means material cost I can tell it as 80,000x, whereas this will be 120,000x, that is 120,000 into x. So 8 lakh divided by 2 lakh. So rupees 4, x is equal to rupees 4, which means normal pen direct material cost is 4 per unit, super pen it is 8 per unit. So direct material will be 40,000 into 8, 3,20,000. 3,20,000. Super pen labor will be 40,000 Y. For the normal pen it will be 120,000 into 0.6, 72,000 Y. So 72,000 plus 40, 1,12,000. So 4,48,000 divided by 1,12,000, 4 rupees, which means Y is rupees 4. So 40,000 into 4, 160,000 is the labor. Production overhead, they are telling per unit at the same rate for both. So production overhead 192,000 divided by 160,000 per unit 1.2 into 40,000, 48,000. Done. Admin overhead is 200% of direct labor, that is 160,000 into 200%, 3,20,000. Done. Selling cost is 1 per pen sold, 36,000. Now guys, this is your total cost, 320,000 plus 160,000 plus 48,000 plus 320,000. 8,48,000 is your total cost. Per unit how much? 8,48,000 divided by 40,000 units produced. Rupees 21.2. 21.2 is cost per unit. Okay. Now, cost per unit is done. Total cost will be how much, sir? Selling cost will be 1 rupees per this. So 22.2. Done. Total cost is 22.2 into units sold. You will get total cost. Profit per unit. Profit per unit will be 22.2 minus 30. Rupees 7.8. Per unit profit is 7.8 and you are going to multiply it with units sold, that is 36,000. Around 2,80,800. $2,80,800. Done. S&D is not considered for total cost. We considered, no. $21.1 was normal cost and we treated it as 22.2 because that 1 rupees is S&D. Yes. B, guys, here it is again ABC and all. I am not going to, overhead basically normal distribution. That is basically repeated distribution you can use, or you can use basically reciprocal method. You can use repeated distribution, or if you want you can use simultaneous, or you can use trial and error. ABC Limited has furnished the following information regarding the overhead for the month of June. Fixed overhead cost variance 2,800 adverse. So they are not telling what it is. 2,800 adverse, which means your actual overhead is greater than absorbed overhead by rupees 2,800. Fixed overhead volume variance 2,000 adverse. Okay. Budgeted RC is 2,400. Budgeted overhead was 12,000, which means how much was a recovery rate or a standard rate? Standard rate is 12,000 divided by 2,400, rupees 5. Rupees 5. Actual rate of recovery of overhead is rupees 8 per hour, which means we are recovering at the rate of rupees 8 per hour. Actual rate of recovery. From the above, they are asking you to calculate few things like fixed overhead expenditure variance. They are asking you actual overhead incurred, actual hours for production, all those things. Listen here. First, fixed overhead expenditure variance. Fixed overhead expenditure variance means what, sir? Budgeted overhead, how much we budgeted, minus actual overhead. Budgeted overhead minus actual overhead. Guys, but one thing is clear here. What is it? Fixed overhead cost variance is nothing but total of expenditure variance, volume variance. Yes, sir. Cost variance is how much? 2,800 adverse. In that, volume variance is contributing 2,000 as adverse, which means expenditure variance is, don't you think 800 adverse? Yes, sir. So expenditure variance is 800 adverse. Okay. Now, sir, What do you mean by expenditure variance? How much you actually incurred, how much you budgeted. Budgeted we know 12,000, but they are telling adverse, which means our actual is more than this. By how much? 800. Can I tell my actual overhead incurred is nothing but 12,800? Simple. Yes. Actual hours for actual production. Guys, they are telling 8 rupees per hour is actual rate of recovery, which means 12,800 divided by 8. Don't you think I have actually worked 1,600 hours? Fixed overhead capacity variance. Fixed overhead capacity variance. Guys, capacity variance is nothing but how many hours we have allowed you. How many hours we have allowed it to you, and how many hours you actually worked into standard rate. Budgeted hours were how much? 2,400. Your actual hours were how much? See, this thing you have to remember like this. Okay. B A S C cab cab BVS. Okay, that is volume variance means budgeted and standard difference. Efficiency variance means standard and actual difference. Capacity variance means actual and budgeted difference. Like that you can remember. That is CAB BVS. Now, actual hours were how much, sir? 1,600 into standard rate is how much? Standard rate we calculated at rupees 5, which means guys 800 into rupees 5, which will come to 4,000. Adverse or favorable? Adverse, sir. Why? We are not using it as per what we budgeted. Standard hours for actual production. Guys, standard hours for actual production, we are going to use it in the efficiency variance. Efficiency variance. Now, guys, your volume variance is nothing but total of your capacity and efficiency. Yes. Now, guys, out of 2,000 adverse, if the 4,000 adverse is just because of capacity, then don't you think 2,000 favorable is your fixed overhead efficiency variance? Yes, sir. So, your fixed overhead efficiency variance is 2,000 favorable. Now, can I tell efficiency variance is standard hours minus actual hours into standard rate. Efficiency SEA. Now, standard hours I don't know, but actual hours I know. Actual hours taken was 1,600 minus standard rate I know rupees 5. That is giving me positive, because if the standard hours is more than actual, that is your favorable. No, 2,000. That is 5x minus 8,000 is equal to 2,000. 5x is equal to 10,000. X is equal to 2,000 hours. So standard hours is 2,000 hours. Simple. Standard hours is equal to 2,000 hours. Done. I hope it's clear. So you can proceed to the next one, right? One more 10 marks question. I'm unable to see your chats actually, but that's fine. Now listen. An automobile company purchases 27,000 spares for its annual requirement. Great. The cost per unit, the cost per unit is 240. Annual carrying cost is 12.5. Each spare part cost rupees 50. Cost per order is 240. Done. At present, order size is 3000. How much company's cost would be saved by opting EOQ model? The reorder point under EOQ model if the lead time is 12 days. How frequently should the order to be procured be placed under EOQ model? Simple question they have asked here. This you haven't solved in your study mat if I am not wrong, because this is one of the different question. Now EOQ is equal to square root of 2 into A annual requirement 27,000 into ordering cost per order 240 divided by carrying cost. Carrying cost will be 12.5% of 50. 50 into 12.5 percentage, which will come to 6.25. That is 2 into 27,000 into 240 divided by 6.25. Square root of that 1440 units. Now they are not asking how many units, they are asking how much cost you will save. Now guys, in EOQ model, how many orders I should place? 27,000 divided by 1440, 18.75, basically 19 orders. Basically 19 orders. Done. Now 19 orders I have to place. Okay. Total cost under EOQ will be how much? See, purchase price, as there is no discount both under EOQ as well as any other size, the total purchase cost will be same. Total purchase cost will be same. However, your ordering cost under EOQ, your ordering cost under EOQ will be 19 into 240. 4560. But if you order 3000 spares, 27,000 divided by 3000, number of orders will be 9. 9 into 240, 2160, which means here you are going to lose 2400. Here you are not saving, here you are spending extra 2400. Carrying cost, half of 1440 into 6.25, 4500. Now what if it is half of 3000, that is 1500 into 6.25, 9375. Here you are saving how much, sir? 4875. Total savings is how much? Your total savings is, guys, 2475. So just because you are opting for EOQ model, you are able to save 2475. Okay. The reorder point under EOQ model if the lead time is 12 days. Guys, try to understand. Right now 27,000 units is an annual requirement, which means per day, because 360 days in a year, that's what they are considering. Per day, how much on an average I will consume? 27, because they didn't give a maximum, so 20,000 into 360, 75 units. I am consuming 75 units. Now lead time is 12 days. So at least for 12 days I need how many units? 900 units, which means Minimum 900 I should maintain, sir. Minimum 900 I should maintain whatever might be the situation. Because if at all it goes below 900, then if I consume on an average also, then I will be end up having stock out, which means 12 days means I have to keep at least 900 units in my stock. How frequently should you order a procurement? Guys, 19 orders to be placed in 360 days. 360 divided by 19. Basically 18.94 or 18.95 days once you should place an order. 18.95 days once you should place an order. It's simple. Nothing special in this. Hope it's clear. Following are the details relating to work done in the process 1. Opening WIP 3000, material, labor, overhead, that is relating to opening. And introduce this 42,000. Unit scrapped is 4,800. The unit scrap degree of completion, material wise 100%, labor and overhead wise 70%. Closing WIP, material wise, labor and overhead. Units finished and transferred is so much. Normal loss 4% input including WIP. Scrapped unit fetch 62.5. Statement of equivalent production. Sir, under which one I should do? Do it under FIFO. Why? Whatever the information is required for the FIFO, they have given. So process 1, normal loss, abnormal loss. I will just show it with the answers only here. See here, opening 3000 units, unit introduced 42,000. They are telling completed and transferred. See, here they are using weighted average method. Here they are using weighted average method. FIFO also they didn't give as an option, leave. I will also show you how weighted average works. Basically you can use it as a FIFO also, no worries. But weighted average will be easy. Simple calculations. Because all you have to do is the cost you should add to the total cost of the period. And you should divide it by equivalent units. See, 36,000, material and 100 I am going to consider. Normal loss, always remember 0. Closing WIP 4,200 units. They have given 150 is a completion. Now, guys, they have given a normal loss. The difference should be abnormal loss. Now I got to know for material equivalent unit are 43,200. For labor and overhead 40,200. This is opening WIP's cost. This is during the period. Scrap recovery, I told you, you should reduce it from the material cost. I got to know the total cost. Equivalent units I will divide. I will get to know cost per equivalent units. Accordingly, I will distribute. Value of units completed and transferred, 137 rupees, 100% everything. Abnormal loss, material wise it is so much, labor wise equivalent units I am going to calculate because price is at equivalent units. No, value of closing. Accordingly, I am going to write it in my process accounts. This I am not going to discuss much. Following are the particulars of two workers R and S. Basic wages 15,000 and 30,000. 15,000 and 30,000. DA 50 and 50. Contribution to EPF 7 and 7.5. Contribution to ESI. Overtime R is working 20 hours. This is your study mat question, if you know. The normal working hours for the month is 200 hours. Overtime is paid double the normal wages. Try to understand, guys. Normal wages and DA. Try to understand. Here they are talking about overhead rate, not overhead premium. Overhead premium means over and above the basic rate. Here they are talking about overhead rate, not overhead premium. Employer's contribution to ESI are equal as the employee's contribution. Both workers were employed on job A, job B, job C in the following R and S, and they are telling overtime was done on job A. R is doing the overtime. No, it is on job A. You are required to calculate ordinary wage rate per hour of R and S. Ordinary wage rate of R and S. Allocate the workers' cost to A, B, and C. I will show it with a solution only. Now, try to understand. Basic 15,000, 30,000. DA 50% of basics they are telling. Overtime, let it be PF. Try to understand, for overtime and all is not, no PF is there. So here they are telling it is 7% and 7.5%. Sir, why you are reducing, sir? Because I am thinking from the point of view of employees now. Earnings I am thinking. Earnings. How much I am paying to them. That is, their contribution I am going to reduce. I got to know how much they have earned. However, for overtime, try to understand. 22,500 is for total. 22,500 is for normal. That is for 200. How much it became? 22,500. 22,500 is for 200. Whereas overtime is 20 hours into 20 into 2, because twice, no, 4,500. Now we got to know how much is our net wages paid to each employee. Done. Now excluding overtime, how much is the ordinary wage rate? That is computation. Okay. Basically exclude the over rate of 4,500. Other things you consider and you calculate. Cost. So ordinary for A, B, C. Overtime only for A. Yes, also in that ratio. Okay. Accordingly, we are going to calculate. This is study mat question. I am not going to discuss much. Both actually, in fact, both were study mat question. SEZ Limited built a 120 km long way, now operates a toll. The company has invested 900 crores using a highway during 10 years tenure. Guys, this is same like what is there already in the study mat. I am not going to discuss and waste your time on the last moment of exam. I assume this you have already revised once in the study mat. Nothing special is there here. This ABC costing, as I already told you. Differentiate between cost accounting and management accounting. Go through this theory once. State the methods used in the following these things. Go through this once. And differentiate between marginal and absorption. Don't go through, like theory also you can go through, but better there is one cost sheet with this thing, no, opening stock and closing stock illustration, Zest Limited or something, 800 units, 400 units per quarter, 200 per quarter it was supposed to be, but we produced 240. That under absorption, over absorption, under absorption. That question of study material, go through that once, guys, before going to examination. Go through that once. Okay. With that, we have completed November 2020. Now, time is 10:48. At 10:52 p.m., we'll be starting with the Jan 21. Okay. Now we are left with Jan 21 3 attempts, 22 2, 23 2, 24 2, 25 1. Nine, 10. So we are starting in other 4-5 minutes. Yes, we'll start, guys. Now we'll be looking at January 2021 paper. Answer the following. During a particular period, ABC Limited has furnished the following data. Sales 10 lakh, contribution to sales, that is PV ratio. Margin of safety is 25% of sales, which is basically 2,50,000. A decrease in selling price and decrease in fixed cost could change the contribution to sales ratio to 30%. Okay. And MOS to 40% of the revised sale. Calculate revised fixed cost, revised sales, and new break-even point. Now, what they are telling? A decrease in selling price and decrease in fixed cost could change the contribution to sales ratio to 30%. Now how much it is? 37. And MOS to 40% of the revised sales. Calculate revised fixed cost, revised sales, new break-even point. See here. Guys, right now, variable cost is 63%. Correct? Right now, the variable cost is 63%. Because 37% is your PV ratio contribution, which means 63% is your variable cost. Can I tell my variable cost right now is 6,30,000. A decrease in selling price. I told in the beginning itself. What? Selling price won't affect the variable cost. The change in unit will affect the variable cost. What they are telling? Variable cost, the change in selling price, which means variable cost remains same because number of units remaining same, would decrease contribution to sales ratio to 30%, which means they are telling 630,000 will be 70% hereafter. So 100% is question mark. 630,000 is 70%, 100% is question mark. That is 6,30,000 into 100 divided by 70, 9 lakh. That will be your revised sales. Revised sales is how much, sir? 9 lakh. Okay. They are telling MOS will be 40% of revised sales. 9 lakh into 40%, 3,60,000. MOS is 3,60,000, which means minus 9 lakh. 5,40,000 is your new break-even point. 5,40,000 is new break-even point. You know that at break-even point, contribution is equal to sales. So 5,40,000 is break-even point. Contribution percentage is 30%. So 5,40,000 into 30%, which will come to 162,000. So contribution of break-even is 162,000. That itself will be the fixed cost. That itself will be the fixed cost. Simple. Going to the second one. They're asking you to calculate the comprehensive machine hour rate. A machine shop has 8 identical machine manned by operators. Guys, this I am not going to solve because I hope you know this. This is already included in your study material. I hope you went through this. But always remember one thing. This is per month. However, these what they have given. These what they have given. This is for a whole 6 months. This is for a whole 6 months. Absenteeism without pay. Anyhow, guys, don't consider 18 hours as idle time at all. Why, sir? Because idle time means you paid for it and they didn't work. Here you didn't pay for it, they didn't work. It is not idle time at all. So 190 hours is what you are paying for. So that you should consider. 190 per, not 190. That's what I told. 208 into 6. 6 months. Minus 18. Because 208 is per month. Sorry, per month. Yeah. That 18 is for 6 months. Accordingly, we are going to do that. And always remember, only 6 operators are there, which means on an average, only 6 machines can run. Because each and every machine needs operator always. Which means although 8 machines are there, only 6 operators are there, you are going to run only 6 machines. They are asking statement of equivalent production and abnormal loss here. FIFO. So opening is there. Material wise 100, labor and overhead wise 70% they have given. Okay. Input of material is 55,000. Amount spent on labor and overhead is so and so. $9,500 units were scrapped. Degree of completion for material 100% and for labor 60%. However, they are scrapped, they are telling, but it includes normal loss also. But always remember, for normal loss this doesn't matter. Only for abnormal loss it is. Closing WIP. Finished units transferred to next process. Normal loss is 5% of the total including opening WIP. Scrapped units would fetch 8.5 per unit. Equivalent units, listen. Opening 10,000 was there. During the year you introduced 55,000. Now transferred. Total how much you are transferring, sir? Total you are transferring 43,500. In that 43,500, first 10,000 will be from opening. Opening material wise 100% already done, only labor wise we need. Units introduced 55, from that remaining 33,500, 0 it was, so 100 is of during the period only. Normal loss 5% of 65,000, 3250, nothing there for the equivalent units. Abnormal, total they are telling 9,500 were scrapped, which means in that 3250 is a normal. Abnormal will be so much. For that scrap they have given percentage. If they don't give, take 100%. Closing WIP percentage they have given, you got to know the equivalent WIP. Done. GHI Limited manufactures a stent that is used by hospitals in heart surgery. As per the estimates provided by Pharmaceutical Industry Bureau, there will be a demand of 40 million stent in the coming year. That is for the whole industry. GHI expects to have a market share of 2.5 of the total market demand, which means 40 million into 2.5 percentage. 1 million. 1 million means how many, sir? 10 lakh. 1 million means 10 lakh. It is estimated that it cost rupees 1.5 as inventory holding cost per stent per month, which means rupees 18 per annum. Setup cost is 225. What would be the optimum run size? Square root of 2 into demand 10 lakh into setup cost 225 divided by carrying cost per unit per annum. 1.5 is per unit per month, so 18 rupees is per unit per annum. Rupees 18. That is 2 into 10 lakh into 225 divided by 18, square root of that will come to 5000 units. 5000 units. What is the minimum inventory holding cost? That is half of 5000 into rupees 18. Rupees 45,000. Assume that the company has the policy to manufacture 4000 stents per run. How much extra cost the company would incur as compared to the optimum run suggested? Now, setup cost. If you produce 4000 stents, which means 10 lakh is what is required, divided by 4000, around 250 setups you should do. So, current policy, economic batch quantity. Now, current policy 250 batches you should do, where it takes 225 rupees per batch. 56,250 is cost. Whereas under EBQ 10 lakh divided by 5,000, 200 batches of 225 rupees, which will come to 45,000. Carrying cost under EBQ is 45,000. We already calculated. Carrying cost under this is half of 4,000, that is 2,000 into 18, which will come to 36,000. Total here it is 90,000. Here it will be 56,250 plus 36,000, which will come to 92,250. So extra cost you are going to incur is 2,250. Extra cost you are going to incur is 2,250. Calculate the effective increase in the earnings of worker in percentage of terms under Halsey and Rowan. Calculate the savings of Z Limited in terms of labor cost. Advise Z Limited about the selection of scheme that would fulfill its assurance incentive. Okay. Labor costing question. Okay. Labor costing question will be discussing now. Z Limited is working by employing 50 skilled workers. Already how many workers are there? 50 skilled workers are there. It is considering the introduction of an incentive scheme, either Halsey or Rowan, so that it will increase the labor productivity, and so that our 40% increase in demand is there, no, that will also get satisfied. The company feels that if proposed incentive scheme could bring about an average of 20% increase in over the present earnings of the worker, it could act as a sufficient incentive for them to produce more. So they are telling that if at all whatever the incentive scheme if we bring that gives 20% more than what they are earning right now, then it will act as a very good motivation for them and we will be able to produce more. Because of this assurance, an increase in its productivity has been observed as revealed by the figures for the month of April. Hourly rate, 50 rupees is hourly rate. Average time for producing one unit by one worker at the previous performance. So this is time allowed, standard time. Number of working days in a month was 24. Number of working hours per each worker is 8. Actual production is 6,001. 20. Calculate the effective increase in earnings of workers in percentage of term under Halsey and Rowan. Now, guys, how much is actual hours taken? 24 days, 8 hours a day, 192 hours. But by how many workers? 50 workers. 1200. Time taken 1200 hours. Standard is how much? 6120 units is what we are producing. Actual. Standard for actual is, for 1 unit it is 1.975. That is 6120 into 1.975. 12,087. That is 12,087. But average time for producing 1 unit by 1 worker at a previous performance, that is 1 unit takes now 24 into 8. 24 into 8, 192 into how many workers actually? 50, right? 50. Now 9,600. That is time taken. Not 1,200, 9,600. That is time taken. Okay. Now, standard time is how much, sir? 6,120 is actual production. 1.975 per unit. 12,087. 12,087 hours. Time saved is how much? Minus 9,600. 2,487. 2,487. Done. Now, this is your time saved. Calculate the effective increase in earnings of workers in percentage of Halsey and Rowan. Try to understand under Halsey. Earlier, how much they are getting paid, sir? Very simple. They were working for 9,600 hours. They were working for 9,600 hours. And they were getting per hour rupees 50. Per hour rupees 50, which is 4,80,000. Earlier, they were getting rupees 4,80,000. Now, shifting to Halsey, how much they will get? Hours worked 9,600 only into 50 plus half of time saved 2,487 into 50 bonus 9,600 into 50, anyhow that is 4,80,000. 2,487 into 50 divided by 2, 62,175 plus 4,80,000, 5,42,175. So bonus, how much they are getting extra? Just for this one, 62,175. They are getting 62,175 as extra. So 62,175 compared to their earnings of 480,000, which is basically around 12.95 percentage. Around 12.95 percentage. Okay, but they're asking now. Next, row 1. If it's a row 1, bonus will be time saved 2487 divided by time allowed 12,087 into time taken 9,600 into hourly rate rupees 50. 2487 divided by 12,087 into 9,600 into 50. 98,786. Sorry, 763.96 plus 4,80,000, that is normal. This you were under row 1. So divided by 4,80,000, what they used to earlier, 20.58. 20.58 percentage is their increase in the earnings. 20.58 percentage is their increase in the earnings. Under row 1. Under row 1. Done. Next up. Under HALC it is 62,175 divided by 4,80,000 into 100, 12.95. Next up. Calculate the saving to Z Limited in terms of direct labor cost per unit under both the scheme. Now, give me a second. I will just charge the pencil and come. Yeah. Calculate the savings to Z Limited in terms of direct labor cost per unit under both the scheme. Try to understand. If at all we didn't do this, they would have taken 12,087 hours only to produce so much, which means it would have costed us 12,087 into rupees 50. It would have costed us 12,087 into 50. That is rupees 6,04,350. It costed us rupees 6,04,350. However, because of going for this, under HALC we are paying 5,42,175. We are saving around 62,175 when we are going to HALC. Okay. If we go to row 1, under row 1 we are paying 480,000 plus 98,763. 64 you can take. 578,764. So we are saving around 25,586 under row 1. 25,586 under row 1. That is total savings. Per unit, how much you are saving, sir? Per unit under HALC, 60,175 divided by 6120. Around 10.16. Under HALC, we are saving 10.16. Under row 1, 25,586 divided by 6120 units, around 4.18. 4.18 we are saving under HALC. Advise Z Limited about the selection of the scheme that would fulfill its assurance of incentive worker and also adjust the increase in demand. Which is going to do that, sir? Our row 1 is going to do that. Why, sir? Because there we can see the 20% above their earnings is increasing by 20.58. So they are going to accept only that. Otherwise, their efficiency won't get increased. Okay. So that's the thing. Hope it's clear. We can proceed to the next one. Done. See here. They're asking the prime cost. This thing, cost sheet. That's for 10 marks. Nice. What is there, sir, in this to ask for 10 marks? Direct labor cost 120,000, which is 120% of factory overhead, which means factory overhead is rupees 1 lakh. Cost of sales is 4 lakh, sales is 5 lakh. That is profit is 1 lakh. Inventory, opening raw material, closing raw material. WIP, opening WIP, closing WIP. Finished goods, opening, closing. Other detail, selling expense is 22,000, general and admin is 18,000. They are asking you cost sheet preparing so and so and so. Cost of sales, they only have given 4 lakh. Profit earned is 1 lakh. Okay. Also we know that general and admin is 18,000. General and admin is 18,000. That is, after adding 18,000 to cost of goods sold, we got 4 lakh, which means 3,82,000 is cost of goods sold. Okay. How we got cost of goods sold? After adding opening stock of finished goods, closing stock of finished goods we reduced to our cost of production. Then we got the cost of goods sold, which means in 382,000, while arriving at 382,000, we have reduced 60,000 that I will add back, and we have added 50,000 that I will reduce, which means my cost of production was 392,000. Done. Oh, selling expense was there 40,000. Sorry. So selling expense was there 40,000, not 18,000 in total. 40,000 it was. So your COGS was 3,60,000. So we arrived at 3,60,000 by adding 60,000. That is closing stock. That I will, sorry, reducing 60,000 closing stock. I will add back, and adding 50,000 that I will reduce, which will come to 370,000. Cost of production is 370,000, and 370,000 while arriving at it, finished goods was done. So cost of production, in between there is no admin expense as such. So your cost of production and works cost will be same. However, to the works cost, while arriving at works cost, we got to know that what we did, 370,000. While arriving at 370,000, what we did was we added 20,000 opening WIP, reduced 30,000 closing WIP. So I will add back 30,000, reduce 20,000, where my gross works cost is 380,000. My gross works cost is 380,000. Okay. Now, while arriving at gross works cost, what I did, for prime cost, I added 1 lakh, which means prime cost was 2,80,000. Prime cost was, that is factory overhead 1 lakh. Prime cost was 2,80,000. Now, if the prime cost is 2,80,000, in the direct labor is 120, which means direct material is 160. How we arrived at 160, sir? Some purchase was there. For the 20,000 I added, closing of 30 I reduced, which means to arrive at 280, I did purchases, add 20,000, reduce 25,000. I arrived at 160. Now 160,000 plus 25,000 minus 20,000, 1,65,000. 1,65,000. Accordingly, I have done that. Purchases 1,65,000, 1,60,000 direct. This one factory cost, gross works cost, that itself is works cost, that itself is a cost of production. I did this, cost of goods sold I got, accordingly I adjusted. Going to the third one. Two manufacturing companies A and B are planning to merge. The details are as follows. Capacity utilization of A is 90 right now, B is 60. Sales, variable cost, fixed cost. Assuming the proposal is implemented, calculate break-even sales of the merge plant and capacity utilization at that stage. Profitability of the merge plant at 80% of the capacity utilization. Sales turnover of the merge plant to earn a profit of 60 lakh. When the merge plant is working at a capacity to earn a profit of 60 lakh, what percentage of increase in selling price is required so to sustain the increase of 5% of the factory overhead? I will just take you through answers and show it there only. See here. A, B. Right now they are working at 90 and 60. 90 and 60. Now, if they work at 100%, both of them work at 100%. Both of that works at 100%. Then sales will be 70 lakhs and 80 lakhs. Together of the plant, it will be 150 lakhs. Variable cost, again, for 100 how much, 60 how much? Variable cost will be so much. Now I will get to know how much is my PV ratio. How much is my PV ratio? Done. Now, from that PV ratio, if at all I work at 100%, I'm talking. Because that's the only way to calculate. Otherwise, the proportion will change, no? So, take the same proportion. Both are working at 100%. Now, fixed cost we got. Using that, we can find out if you work at 100%, how much profit I will be able to make. I will be able to make 40 lakh 50,000 as the profit. Now, guys, fixed cost I know. At 100% capacity, if I work, my fixed cost is 28 lakh. Otherwise also, here you know, right, 13 lakh and 28 lakh fixed cost won't change. Okay. And using that 100% thing, I calculated a PV ratio as 45.67. Using that, I can find out how much is my break even. 100% means 150,000. So 6130 means how much? 40.88%. Now, if they use only 80% of the capacity, their sales will be so much. Their contribution will be 80% into 45.67. From that fixed cost, if you reduce, they will get a profitability. Now, if they want to make the profit of 60 lakhs, then extra they should make, no? For that, how much it should be? Again, their profit they should take as 60 lakh. Sales you take it as X. Contribution will be 0.4567X minus 28 lakhs as a fixed cost. You will get a profit of 60 lakh, which means around 88 lakhs divided by 0.4567. Around you have to make 1 crore 92 lakh 68,666.52. Done. Next, to make the same profit, if the fixed overhead is increased by 5%, so new same thing but 5%, like that. Okay, mark it as LMR, that is before going to exam, see and go it once, because it is one of the different kind of question and only question available like this, where you are going to calculate your PV ratio that way, combined PV ratio, because you don't know. See, if they give after merger, they are going to work at this proportion, then you can take that proportion. But here you don't know what proportion. So what I will do, at 100% I will calculate. My sales will be how much, my variable cost will be how much. If the both works at 100%, I can find out how much is my PV ratio. Accordingly, we are going to do that. XYZ is engaged in manufacturing toys. It can produce 420,000 toys at its capacity of 70%, which means 100% is how much, sir? 420 is for 70, 100 is 6 lakh. Company's process of determining selling price for this one. Direct material it will say 60, direct labor is 30. indirect overhead, fixed is so much, variable is so much. Semi-variable, 5 lakh per annum up to 60% of capacity and 50,000 for every 5% increase in the capacity or part thereof up to 80%, and thereafter it will be 75,000 for every 10% increase in capacity. Company desires to earn the profit of 25 lakh for the year. Company has planned the factory will operate at 50% capacity for the first 6 months and 75% for the further 3 months, and the balance 3 months it will operate at 100%. You are required to determine the average selling price at which each toy should be sold to earn the desired profit. They want to make 25 lakh. Give the above scenario. Advise whether the company should accept an offer to sell each toy at 130 or no. Now, guys, I am going to split into like this. First 6 months, next 3 months, next 3 months. Direct material is 60. Try to understand. First 6 months, company is planning to operate at a 50% of capacity. That is 6 lakh into 50% into 6 by 12. That is guys 3 lakh. Half of that, 1,50,000 toys. For the next 3 months, they are planning to operate at a 75%. 4,50,000 divided by 4. 1,12,500 toys. For the next 3 months, they are planning to operate at 100%. 1,50,000. Done. Now, for the first 3 months, direct material cost will be how much, sir? 60 into 150,000. 90 lakhs. For the next 3 months, how much it will be, sir? 112,500 into 60. 67 lakh 50,000. For the next 3 months, it is 150,000 into 60, which will come to again 90 lakhs. Done. Direct labor, they are telling 30 per unit. That is 150,000 into 30, 45 lakhs. $112,500 into 30, 33 lakhs 75,000. And 45 lakhs. Variable overhead, 15 per unit. So 15 into 150,000, 22 lakh 50,000. 22 lakh 50,000. 112,500 into 15. 16 lakh 87,500. Done. Next, fixed cost. That is 65 lakh 50,000. Let it be fixed. Let's see later. Now semi-variable, 5 lakh per annum up to 60% of capacity. So first will fall under this. First level will fall under this. That is 5 lakh per annum. So for half year it is 250,000. For half year it is 250,000. Done. Next, thereafter capacity, that is 50,000 for every 5% increase in capacity up to 80%. So for the next 3 months it is going for 75, which means 5 times it will increase. 5 times 50 to 60 to 6, 3 times, sorry, 60 to 65, 65 to 70, 70 to 75, 3 times. that is 150,000, 6,50,000 total it will be for 3 months, 1,62,500. After that 100%, what they are telling, up to 80% it will go like that. That is 4 times it will go like that. So it will become 7 lakh. After that 75% for every 10% increase in capacity. So 2 times again 150,000. So total will become 8,50,000. So 8,50,000 into 3 by 12, 2,12,500. This will be my total cost. 90 lakh, 45 lakh, 22,50,000, 2,50,000, 1 crore 60 lakhs. $6,750 plus 33,75,000 plus 16,87,500 plus 162,500. 1 crore 19 lakhs 75,000. Next one, it is 90 lakhs plus 45 lakhs plus 22,50,000 plus 212,500. 1 crore 59 lakh 62,500. My total cost other than fixed cost is how much, sir? Plus 1 crore 19 lakhs 75,000 plus 1 crore 60 lakhs. Four crore 39 lakh 37,500 plus fixed cost is how much? 65 lakh 50,000. So total my cost will be 5 crore 4 lakh 87,500 and I am expecting a profit of 25 lakhs. Expecting a profit of 25 lakhs. So total my sales should be 5 crore 29 lakhs 87,500 from how many units, sir? From 4,12,500 units. 4,12,500 units. Which means rupees 128.45 is what I am going to charge minimum. 128.45. So if the offer price is 130, accept. 129, accept. Offer price is 130 also accept. 129 also accept. Got it? I hope it is clear. So that will give you more than the desired profit only. Mayura Chemicals Limited buys a particular raw material at rupees 8 per liter. At the end of processing, department 1, this raw material split off into product X, Y and Z. Product X is sold at a split off point with no further processing. Y and Z requires further processing before they can sold. Product Y is further processed in department 2. Product Z is further processed in department 3. Following is the summary of the cost. So department 1, whatever the cost is there, everything is a joint cost. Department 2, further processing cost of Y. Department 3, further processing cost of Z. Sales, closing inventory, sales price. Y, no closing inventory. Z, there is a. Guys, there were no opening and closing inventory of basic raw material at the beginning of the year, end of the year. All finished inventory in liters was completed as to processing. Company uses NRV to allocate a joint cost. So they are using NRV. Schedule showing the allocation of joint cost, calculate the cost of goods sold of each product and cost of each item of inventory, comparative statement of gross profit. Sir, here to compute what units I should take, sir, sales units I should take or closing units I should take, guys, always try to remember produced units. Why? Here, whatever the joint cost I'm incurring, not for the units sold, I'm incurring it for the units produced. So for decision making, I should take units produced, not units sold. So here I should consider 15,000. Here anyhow 15,000. Here I should consider 30,000. See here, as I already told you, for the joint cost allocation, I'm not going to consider the actual sales units. I'm going to consider the units produced, because cost I'm incurring is for the units produced, not to the units sold. So 15,000 into 30, 15,000 into 64, 30,000 into 50. I will get to know my final sales value. Okay. And also my further processing cost. For X, there is no further processing cost. But for Y and Z, there is a further processing cost of 450 plus 210. That is 660,000 and 650 plus 450, which is 11 lakh. So I have 6 lakh 60 and 11 lakh. 6 lakh 60 and 11 lakh. Now I will get a NRV. Now on this basis, I am going to apportion the joint cost. How much is joint cost, sir? 480, 550, 598,000. I am going to apportion 598,000 in this ratio. I will get to know joint cost allocation. Now comparative statement. Now I should take the profit comparability. So I should take the actual units produced. That is 3 lakh as sales, 960 and 1125 minus COGS. I will get a gross profit. Simple. This is ABC one. Just go through it if you get a time. Otherwise, you should know exactly. By reading a question, you can solve that particular sum. This is that hospital sum. Ditto. Again, I am not going to solve. But always and always remember, they have told that 120 days had the full capacity of 100 patients per day. Okay. And another 80 days, they had 40 beds occupied, where full extra beds were hired at a charge of 50 rupees per bed, which will be variable. This did not come more than 5 beds above normal capacity. The total higher charge for the extra bed incurred is 20,000. So how many extra beds we have incurred in that particular year? 20,000 divided by 50. 400 extra beds we have incurred per that particular year. Remember that. Not per day. 120 into 100, 12,000. 80 into 40, 3,200 and 400. That is 15,600 bed days or patient days. 15,600 bed days or patient days. So in the earlier one, doctor's cost they have given in this table only, but here they have given here. Keep that thing in mind. On the basis of the number of patients attended and time spent, which means they are telling that doctor cost is variable in nature. All other things remain same. You can go through that once. And here, see here, Premier Industries has a small factory where 52 workers 52 workers are employed on an average for 25 days a month and they work 8 hours per day. The normal downtime is 15 percentage. The firm has introduced the standard costing for cost control. Its monthly budget for November shows the budgeted variable and fixed overhead as so and so. Budgeted. The firm reports the following detail of the actual performance. Actual hours worked. Actual production expressed in terms of standard. That is standard for actual. Actual variable overhead is so much. Fixed overhead is so much. You are required to compute so and so. And a control ratios. Okay. Done. First, variable overhead expenditure variance. Expenditure variance is nothing but, guys, standard rate minus actual rate into actual hours. Standard rate minus actual rate into actual hours. How much was a standard rate, sir? Standard rate, guys, 52 workers are employed, 25 days in a month. Okay. 8 hours every day. Done. 10,400. However, we are thinking that 15% loss is also there. 1,560. Which means net, we are telling 10,400 minus 1,560. 8840. 8840. That has budgeted hours at least. 8840 budgeted hours. So try to understand, if the normal loss is there, no need to adjust it anywhere because the normal idle time is getting adjusted in the standard. Standard only were increasing with that budgeted, normal rate, normal loss. Done. Now, how much is a variable overhead recovery rate, standard rate? 106,080 divided by 8840. Rupees 12 per hour. Variable overhead, standard rate. Whereas fixed overhead it is 221,000 divided by 8840. Rupees 25 per hour. Fixed overhead, standard rate. Now, standard rate is how much, sir? For variable, 12. Guys, this, instead of dividing and all, what I am going to do is, I am going to reframe it as standard rate into actual hours minus actual rate into actual hours. Standard rate, 12 rupees. Actual hours, 8,100 minus actual rate into actual hours, that is 1,02,000 actual overhead. So 12 into 8,100, 97,200, 102,000, that is 4,800 adverse, because your standard is less than actual. 4,800 adverse. Efficiency, that is standard hours minus actual hours into standard rate. Standard hours minus actual hours into standard rate. Standard hours is 8,800. Actual hours is 8,100. Standard rate is rupees 12, which means 700 into 12. 8,400 favorable. Why? Your actual is less than standard, which means you are more efficient. The work which you should have completed in 8,800 hours, you are completing in just 8,100 hours. Awesome. Next, fixed overhead budgeted variance, that is nothing but your cost variance. That is actual fixed overhead incurred. 2 lakh. Absorbed will be standard hours for actual output into recovery rate. That is 8,800 is standard hours into recovery rate is 25, which will come to 2,20,000. Awesome. You are recovering more. Recovering more means favorable. Recovering more means favorable. How much is favorable, sir? 8,800 into 25. 2,20,000. Around 20,000. Around rupees 20,000 is favorable cost variance. 20,000 is favorable cost variance. Now, sir, expenditure variance means what, sir? Actual 2 lakh, budgeted 221,000. 21,000 adverse, sorry, favorable, because you are incurring less than what you thought you are going to incur. Capacity variance. Capacity variance, guys, how many hours we asked you to work? 8840. But how many hours you are actually working? Just 8,100. Oh my god, you are not utilizing 100% of capacity. Adverse only into 25. That is 740 into 25. 18,500 adverse. That is 18,500 adverse. Efficiency. The work which you should have completed in 8,800 hours, you are completing in just 8,100 hours. Awesome. Favorable. 700 into 25. 17,500. Favorable. Done. Capacity ratio. What is the formula for capacity ratio, sir? Actual hours divided by budgeted hours. Actual hours is how much? 8,100. Budgeted hour is 8840 into 100. Done. Next, efficiency ratio. Standard hours by actual hours. Standard is how much? 8,800. Actual is 8,100. Activity ratio is what, sir? Standard by budgeted. Standard is how much? 8,800. Budgeted is how much? 8,840. That's it. Guys, detention charges, whether you should include in the cost? No. Demurrage? No. Cost of returnable containers? Net amount you should consider. CGST, if its ITC is not available, consider. If the ITC is available, don't consider. Shortage due to abnormal reason, don't consider. Costing P&L. These are the things. With that, we have completed January 21 paper. With that, we have completed January 21 paper. Okay. Now the time is 11:53. We'll start at 12:01 AM. Okay. Now we are starting with July 21 paper. Answer the following. Limited has provided the following information about the following items of inventories, like around 6 inventories they have given. They have adopted classifying the inventory 5% or above of the total inventory cost as A category, item constituting 6% or less of the total inventory cost as C category, and remaining as B category. Now what you are going to do, you should find out how much is the total cost here. That is not unit cost, unit into unit cost. unit into unit cost. You are going to calculate the total cost. Based on the total cost, you are going to rank it. Basically, 25 into 50, 1250, 300 into 1, 300, 50 into 80, 4000, 75 into 8, 600, 225 into 2, 450, 75 into 12, 900. Now, total is how much, sir? Total is 1250 plus 300 plus 4000 plus 600 plus 450 plus 900, 7500. 7500. Now, 1250 divided by 7500 into 100, 16.67 percentage. Done. 300 divided by 7500 into 100, 4 percentage. 4000 divided by 7500 into 100, 53.33 percentage. 600 divided by 7500 into 100, 8 percentage. 450 divided by 7500 into 100, 6 percentage. 900 divided by 7500 into 100, 12 percentage. Now what we are going to do, sir? I am going to give the rank here. Rank 1, rank 2, rank 3, rank 4, rank 5, rank 6. Now 6% and less, the line item 2. Line item 2, that is C category. Line item 2, C category. And next, 15% and above, A. Now remaining things you can classify it as B. Okay. The step ladder method and all, it is there. I'm not going to solve it now. AUX has an annual demand from a single customer for 60,000 COVID-19 vaccine. Customer prefer to order in the lot of 15,000 vaccines per order. The production cost of vaccines are 5,000 per vaccine. The setup cost is 4,800. Carrying cost is 12 per vaccine per month. That is rupees 144 per annum. Find the most economic production run. Square root of 2 into D, 60,000. Yes, setup cost 4,800 divided by carrying cost 144. 2 into 60,000 into 4,800 divided by 144. Square root of that 2,000 vaccines. Calculate the extra cost that company incurs due to production of 15,000 vaccines in a batch. Now, if they produce in 15,000, how much extra cost they incur? Setup cost. Guys, for setup to be done, because 60,000 is annual requirement. So, setup cost will be 4,000 into 4,800 into 4. 19,200. However, if at all we go for the EBQ, then 30 setup to be done as 4,800, which will come to 1,44,000. So minus 19,200. 1,24,800 savings is there. However, coming to carrying cost, half of 15,000, that is 7,500 into 144, 10,80,000. If we go for the 15,000, it will be 10,80,000. Here it will be half of 2,000, that is 1,000. into 144, 1,44,000. 1,44,000. So here we are going to save how much, sir? Here we are going to save 9,36,000. In total we are going to save 124,800. That is 9,36,000 minus 124,800. 8,11,200. 8,11,200 is what we are going to save, or what we are going to spend extra, you can tell. 8,11,200. If you don't go for EBQ, you will spend extra. LR is considering two alternative methods of manufacturing a new product it intends to market. The two methods have a maximum output of 50,000 and produce identical item selling price of 25 each. Method 1 semi-automatic, method 2 fully automatic. Variable cost and fixed cost. Cost indifference point, that is, if you produce how many units, your cost will be same under both the methods. Let's say that will be X units, that is 15x plus 1 lakh will be equal to 10x plus 3 lakhs. Always remember, indifference will exist only and only when one is better in fixed cost, one is better in variable cost. So it is 5x is equal to 2 lakh, x is equal to 40,000. X is equal to 40,000. That is at 40,000. At 40,000, the cost of both will be same. Cost of both will be same. The break-even point of each method in terms of units. Guys, selling price is 25. So the contribution here is rupees 10. Here is rupees 15. So break-even will be fixed cost divided by contribution per unit 10. So it will be 10,000 units. Whereas for the second one, fixed cost is 3 lakh divided by 15 is a contribution. Here it will be 20,000 units. Sir, how to conclude which is better? Guys, if at all it is less than the break even indifference point, then go for one with the lesser fixed cost. If at all more than the break even, go for the one with the lesser variable cost. Done. Next. The following data relates to manufacturing of a standard product during the month of March 2021. Opening stock of raw material, opening stock of WIP, purchase of raw material, carriage inward, direct wages, cost of special drawings, direct expense. This is raw material consumed. This is your works cost, purchase of raw material consumed, carriage inward, raw material consumed, direct wages. Higher charges for a plant, direct expense. Return of a raw material consumed, you should reduce. Carriage on return. Guys, always remember, this is one extra thing here. Carriage on return, they are treating it as a factory overhead. In question, if they give, just treat it as a factory overhead. Expense for participation in industrial exhibition. Why will participate in industrial exhibition, guys? Just to sell your product. That is nothing but your selling and distribution overhead. Legal charges, general admin overhead. Salary to office staff, general admin overhead. Maintenance of office building, general admin overhead. Depreciation on delivery vehicle, selling and distribution. Warehousing charges, finished goods, selling and distribution. Closing raw material they have given. Store overheads on materials are 10% of the material consumed. Store overheads means here, guys, they are talking about factory overhead. So add it to factory overhead. Factory overhead are 20% of the prime cost. This also will come. Total 30%. I mean 10% on my material consumed and this one. 10% of the output was rejected and 5,000 is realized. You should reduce it while arriving at COP. 10% of the finished product was found to be defective and defective product were rectified at an additional expenditure equivalent to 20% of the proportionate direct wages. Guys, rectification of defective also treat it as forming part of your factory overhead. That is, before arriving at factory cost, you should add this rectification cost also. The total output is 8,000 units during the month. Try to do it. This is split of SPNA. This is already given in the study material. If you know, joint product by product. Following information is given relating to newly set up organization. Number of workers replaced during the year, R. Number of workers left and discharged, S. Average number of workers 500. Compute the employee turnover rates using separation method and flux method. Separation method 25 by 500 into 100 and flux method 50 plus 25 divided by 500 into 100. Equivalent employee turnover. Given the organization was set up in the January. So January means here whatever they have given is for 3 months. What you should do, this is for 3 months, for 12 months question mark. Or you can do into 12 divided by 3. Okay. You are going to do that way. Question number 3A. They are asking you to prepare a cost sheet and ascertain the profit as per the cost records and reconcile profit of the financial records with the profit as per cost records. So, they are asking you to prepare a cost sheet first. I'll just show with this only. First term. Direct material 6,50,000. Direct wages 350,000. With that we'll get a prime cost. Factory overhead 260. But listen here. Factory overhead 50% is fixed, 50% is variable. Which means guys 260 variable leave on actual basis we can take, no problem. 130,000, 130,000. This variable 130 I will take directly. However, factory what they are telling here, listen. Normal production capacity is 20,000 units. Indirect expenses are absorbed in the cost accounts on normal production capacity. Which means, guys, 20,000. So, 130,000 divided by 20,000, which means per unit we are planning to recover 6.5 per unit. However, we are able to produce and sell 15,000 units. So 15,000 into 6.5, 97,500. My factory fixed overhead is 97,500. Variable is 130,000. Works cost I got. Next again, admin overhead 105,000. Admin overhead 100% is fixed. So 105,000 I am planning to recover from the 20,000 units, which means I am able to recover it just from 15,000 units. Again the under absorption is there. 105,000 divided by 20,000 into 15,000. 78,750. 78,750. Done. Selling overhead 85,000. What they are telling? Completely variable, so it will come as it is. Loss on sale of investment won't come in cost sheet. Dividend won't come in cost sheet. Sales will come at the end. Now, indirect expenses done. Notional rent is there. That should come in the cost sheet. Notional rent will come. So cost of production, selling overhead, you will find this one. Done. Now reconciliation. Cost sheet, so dividend we didn't include, so add it to the profit. Notional rent, basically what they're telling about notional rent. Notional rent of the own premises charged. So we treated it as expense. Now reduce it. Reduce it means increase the profit. Factory overhead undercharged. Treat it as expense. Reduce it from the profit. Admin overhead undercharged. Reduce it from the profit. Loss on sale of investment. Reduce it from the profit. You will arrive at profit as per financial accounts. This is one of the important question because the absorption is there in this. In the cost sheet, the absorption is there. So it will be treated as a important question. Go through this once before going to exam. This is already there in your study mat actually. If you know, it's already there in the study mat. Correct? In the practice questions. Like this absorption thing. So on that based only they have given. So one thing you have to understand guys. If at all you see the study mat properly, then it won't be difficult to get a good marks in costing. That is, you should see the study mat and you should understand it. Then it will be easy to get a good marks in cost accounting. Now listen here. A manufacturing unit manufactures a product XYZ which passes through three processes X, Y and Z. Material consumed at process X, direct wages, process Y, direct wages, process Z, direct wages. The total production overhead is 15,750 and it was recovered at 150% of the direct wages. It is recovered as 150% of the direct wages, which means 15,750 is 150. 100 how much? 10,500. Your direct wages is 10,500. See here, 4,000, 3,500, 3,000, 10,500, which means 4,000 into 150. Here the overhead will be 6,000. 3,500 into 150. Here the overhead will be 1,750. 3,500 into 150. 5250. Here it is 4,500, like that. 15,000 units at 2 rupees were introduced in process X. So extra 30,000 rupees is a material cost. The output of process passes to the next process and finally 12,000 units were transferred to finished goods. So finally from Z we transferred 12,000 units. No stock of materials or WIPs were left at the end. So there is no closing stock there telling. X, normal wastage is 6%, value of scrap. Y normal wastage you don't know, but 2 rupees. Z 5% and 1 rupee. Find out the percentage of wages in process Y. Given that the output of process Y is transferred to process Z at 4 rupees per unit. So try to understand what is happening. Let's assume 15,000 units were introduced. In that 6% is a normal loss of product process X, correct? 15,000 into 6%, 900 units. 900 units. Now 14,100 units only, let's say we received at Y, and also they are telling Z 5% is a normal loss, and we know that Z input was there. In that 5% only we assumed, let's say 12,000, which means let's say 12,000 is nothing but 0.95, that is 95% of input. Let's assume, so Z's input is 12,631.5 only. Okay, now which means in Y, how much is our total loss? In Y, total loss is 12,631.5 minus 14,100, 1,468.5. Now what we will think, okay sir, our total loss is 1468.5. For both of that we assumed only normal loss is actual loss because of lack of information. For y also we are going to assume this as normal loss, and we are going to calculate a percentage on our input. No, you should not. Why sir? Because they have given here rate per unit. So what sir? So try to understand x. How much is the total cost of x, guys? Total cost of x was direct material introduced 30,000 plus material 2,600 plus wages 4,000 plus overhead 6,000, around 42,600. They have transferred this total cost with 14,100 units, correct? Yes sir. And later what we did, for that we incurred 2250 and 3,500 and 5250 as additional cost, and in y in total we incurred 53,600. However guys, okay, x there is a recovery also, give me a second. Not 42,600 fully transferred, in that there is a scrap of 6%, that is 15,000 into 6% into 1.1, around 990 they reduced, which means they transferred 14,100 units at the rate of 42,600 minus 990, 41,610, correct? For this we incurred process y cost, that is 41,610 41,610 plus 2250 plus 3,500 plus 5250, correct? So the cost became 52,610. However there was some normal loss recovery, because of which 2 rupees we are recovering per unit, and the finally after doing all these things we are getting per unit as rupees 4, which means guys try to understand 52,610 minus let's say normal loss units as x into 2 whole divided by input 14,100 minus x should give me 4, that is 52,610 minus 2x is equal to 14,100 into 4, 56,400 minus 4x. Now 2x is equal to 3790, x is equal to 1895. So guys, normal loss is 1895, not 1468, which means there is a abnormal gain in this. There is a abnormal gain in this particular thing. See here, 1895 is normal wastage, so 13.344. So in the process y there is a abnormal gain. Try to understand this. If at all they haven't given per unit so much, then we would have assumed everything is a normal loss. But as they have given, per unit will change if at all we change the normal loss units. So for the per unit basis only we should calculate how much is a normal loss. Okay, this question go through once, other things remain same, so I'm not going to look into it. Anyhow, this is there in the study mat, this B point, go through that. C is your contract cost, ignore. That was all about your third question. Sorry, fourth question. Listen here. A standard output of product DJ is 25 units per hour in manufacturing department, not per employee. In a whole manufacturing department, in 1 hour you can produce 25 units. That doesn't mean that 1 hour is a labor hour. Try to understand. 1 hour whole department's hours, which means 100 workers are there. If the 100 workers work for 1 hour, how many labor hours? 100 labor hours. In this 100 labor hours, how many units could be produced? 25 units. Moral of the story: one unit needs 4 hours. One unit needs 4 hours. In 40 hours week, the department produced 960 units of DJ despite 5% of time paid was lost due to abnormal reasons. So 40 hours week, in that they produced 960 units it seems. Okay. The hourly wage rate actually paid were 6.2, 6 and 5.7 to Group A consisting of 10 workers, Group B consisting of 30 workers, Group C consisting of 60 workers. That is, in standard there is nothing like Group A, Group B, Group C, but in actual hours it is there. Actual hours paid. Guys, actual hours paid, Group A, 10 workers. For 40 hours we are paying to them 400. Group B, 30 workers. For them we are paying 40 hours, 1200. Group C, 60 workers, and we are paying them for 40 hours, which will come to 2400. Done. Now, for the same thing, how much is a standard hours? Guys, as I already told, for standard hour there is nothing called Group A, Group B, Group C. Standard is only one kind of labor. So, how many units you are producing? We are producing 960 units, and each unit need 4 hours, which means standard is 3840. Standard is 3840. Got it up. Standard is 3840. Done. Actual hours paid. Actual hours worked. Before that, idle time. Idle time they are telling 5%. 400 into 5%. 20. 1200 into 5%. 60. 2400 into 5%. 120. Now, actual hours worked will be 380, 1140 and 2280. This will be your actual hours worked. This will be your actual hours worked. Done, sir. Next is what? You know the standard rate. Standard rate is only one rate. That is the standard wage rate per labor is same for all the workers, whereas they haven't told how much it is, but they have told labor efficiency variance 240 favorable. Efficiency variance means what, sir? Standard hours minus actual hours worked into standard rate. Now, if the standard hour is more, then only the efficiency will be there. Actual hours worked is how much, sir? Actual hours worked is 380 plus 1140 plus 2280, which will come to 3800 into standard rate. I don't know, I will take it as SR, will give you positive 240. Now 240 divided by 40, 6. Standard rate is rupees 6. Standard rate is rupees 6. Actual rates you have, using that you can find out all this information. Okay. Sir, gang variance is what, sir? Gang variance is mix variance. Gang variance is mix variance. Yield variance is revised standard hours minus standard hours. In the given question, yield variance might not be there. Why, sir? Because revised standard hours and standard hours will be same. Sorry, mix variance won't be there. Why, sir? Per unit mix variance won't be there. Why, sir? Because yield means revised and standard, that is actual minus standard. Straight away that is your efficiency. However, gang means what? Actual and revised standard, both are same, no? So PSV manufactures and sells a single product. This one manufactures and sells a single product and estimated the following related information for the period. So November, December, January, February, March. 5 months information they have given. Opening stock of finished goods, sales in units, selling price they have given. Closing stock of finished goods at the end of the March is 10,000 units. Closing stock here they are telling 10,000 units. Each unit of finished output requires 2 kg of raw material A, 3 kg of raw material B. You are required to prepare a following budget for the period. Sales budget they are asking in the rupees, that is 3 lakhs for the month of November, 35,000 into 12, 4,20,000 for the month of December, 38,000 into 15, 5,70,000 for the month of January, 25,000 into 15, 3,75,000 for the month of February, and 4,40,000 into 20, around 8 lakh for the month of March. Next, production budget. They are telling, see, this is your sales budget, done. Production budget in units they are asking. Try to understand. They have given a March month's closing. That is 10,000 units. Now, November month's closing is nothing but a opening of December. So closing stock will be 3,000. December month's closing is nothing but opening of January. Closing of January is nothing but opening of February. Closing of February is nothing but opening of March. Simple. Now I know opening, I know sold units, I know closing stock. So units to be produced is very simple. What you are going to do, sir? Very simple. I am going to take the sold units, for that add the closing stock minus the opening stock. I will get to know how many units to be produced. Next they are asking raw material production A and B. That is, I will get to know how many units to be produced. A, you should use 2 kgs per unit of the units to be produced. 3, this one. Consumption budget will be ready. Raw material budget. Not spending much time on it. Sixth one is your theory. Guys, by the way, I forgot to tell, in your study material, one stock out question is there now. One single stock out question, tier question. Kindly go through that properly before going to exam. The stock out question, once go through that carefully. Okay, it might come in the examination. This was all about your July 2021. Next, we'll start with the December 2021 at 12:45. Okay, we'll be starting with December 21. We'll be starting with December 21 paper. Okay. XYZ uses two type of material, basically material A and material B, has provided the following data: opening stock, purchases, closing stock. You are required to calculate the material A, material B's inventory turnover ratios. Very simple. Cost of material consumed divided by average inventory. The number of days for which the average inventory is held for both material A and B. Also, you have to calculate how many days we are holding the inventory on an average. 360 days is a year. So, first, cost of material consumed, that is opening stock plus purchase minus closing stock, 120 minus 20, 1 lakh. Material B, 32 plus 51, 83,000 minus 14,000, 69,000. Average inventory is opening plus closing divided by 2. 30 plus 20, 50 divided by 2, 25,000. 32 plus 14, 46 divided by 2, 23,000. So inventory turnover ratio for the first one, it is 1 lakh divided by 25,000, 4 times. For the second one, it is 63,000 divided by 23,000, 3 times, which means number of days on an average inventory was held. So 360 days, 4 times we are changing, means around 90 days inventories were held on an average. Here it is 360 by 3, which will come to 120 days. So comment is A is fast moving compared to B. Going to the second one. The accountant of KPMR Limited has prepared the budget for the coming year. Production and sales. So there is no opening, closing and all. Selling price per unit, direct material per unit, direct labor per unit, variable overhead per unit, fixed overhead per unit they have given. Okay. Fixed overhead per unit at the given level. At the given level, which means you should calculate the total fixed overhead. Then that will remain same for everything. Unless and until in a percentage it changes. I mean total as a whole. After reviewing the above budget, the management has called the marketing team for suggesting some measure for increasing the sales. Marketing team has suggested that by promoting the product on social media, the sales quantity of the both the products can be increased by 5%. That is, quantity of units sold could be increased by 5%, they are telling. Which means, one second. So quantity. Also, the selling price per unit will go up by 10%, they are telling. But this will result in increase in the expenditure on variable overhead and fixed overhead by 20% and 5% respectively for both the products. You are required to prepare a flexible budget for both the product before promotion, after promotion. Very simple, guys. Before promotion, it is 4,000 units, 3,000 units. Selling price they have given, direct material they have given. So sales first before promotion, it is 4,000 units into 200, 8 lakh. 3,000 unit into 180, 5 lakh 40,000. Direct material, that is 80, 4,000 into 80, 3 lakh 20,000. 3,000 into 70, 2 lakh 10,000. 4,000 into 40, 1 lakh 60,000, that is direct labor. 35 into 3,000, 1 lakh 5,000. Variable overhead, 20 into 4,000, 80,000. And 3,000 into 25, 75,000. Fixed overhead, 40,000 and 30,000. Now profit will be 8 lakh minus 320,000 minus 160,000 minus 80,000 minus 40,000, 2 lakh. 540,000 minus 210,000 minus 105,000 minus 75,000 minus 30,000, 120,000. This is before promotion. Now, after promotion, sales, what they are telling? They are telling sales quantity for both the product will go up by 5%. So 4,000 plus 5%. 4,200 units will be the sales, and 3,000 plus 5%. 3,150 will be the sales unit, and they are also telling selling price will go up by 10%. So 220 and 198 done, and this will increase in the variable overhead and fixed overhead by 20% and 5%. Variable overhead will become 24 and 30. 24 and 30. Yes, boss. Tell me, what's your doubt? Next, fixed overhead is basically 40,000 was there. Now it will increase by 5%. 40,000 plus 5%. 42,000. 30,000 plus 5%. 31,500. Done. This will be your fixed overhead. Now, after budget, how much it will be, sir? 4,200 into 220. Sales will be 924,000 and 3,150 into 198. That will be 6,23,700. This will be your sales. Next, direct material, 4,200 into 80, 336,000. 3,150 into 70, 2,20,500. Direct labor, half of this, that is 1,68,000. 336 divided by 1,68,000, 1,10,250. Variable overhead, 24 into 4,200, 1,08,000. 30 into 3,150, 94,500. Fixed overhead is 42,000 and 31,500. 924,000 minus 336,000 minus 168,000 minus 1,08,000 minus 42,000. 2,77,200 and 6,23,700 minus 220,500 minus 110,250 minus 94,500 minus 31,500. 166,950. 166,950. Give me a second, I will check your doubt. 1 second. 2,77,000 and 166,950. Sir, what to do in case we got any adjustment which we don't know? And when it's new in the question, because of not knowing one adjustment, we could not attend the whole question. No adjustment will be like that. Part of the question you will be able to adjust. I mean, you will be able to do it. As it's a stepwise marking, don't skip the whole question. Just try to do something. Just try to analyze the adjustment. Somehow do some assumptions and try to solve it. Don't skip it. A skilled worker is paid a guaranteed wage rate of 150 per hour. Standard time allowed is 10 hours. He took 8 hours to complete the job. This is actual hours. He has been paid the wages under row 1 incentive. Calculate the effective hourly rate of earnings under row 1 incentive. Effective hourly rate they are asking. That is 150 into 8 plus standard hours 2, hours saved 2, standard hours 10, hours taken 8, hourly rate 150, which will come to 150 into 8, 1200 m plus 8 into 150 into 2 divided by 10 m plus mrc 1440. 1440 divided by 8 hours, rupees 180 per hour. Effective hourly rate is rupees 180 per hour. Calculate the time in which he should complete the job if the worker is placed under HALC and he wants to maintain the same effective hourly rate of earnings. Then he should complete the job at 50%. You know that. Because at 50%, HALC and row 1 earnings will be same. A product passes through process 1 and process 2. They're asking you process 1 account, abnormal gain or abnormal loss account. Material issued in process 1, 80,000 debit side, wages 60 debit side, manufacturing overhead 50 to 500 debit side. Normal loss anticipated is 5%. 9650 units were the units produced and transferred out of process 1 to process 2. Input were 10,000, which means 10,000 was input. In that 5% means we are expecting 9,500. However, 150 is what, sir? Abnormal gain. 150 is what, sir? Abnormal gain. Now, accordingly, we are going to do that. But in the abnormal gain account, please be careful. You are going to write it as by process, whatever it is, to normal loss. That is 150 unit into scrap recovery of 5 rupees. That you are going to reverse it. Because actually that is not a scrap. You didn't recover only. Right? So that's the thing. Hope it's clear. You're going to do that way. Not much special question. This leather bag question. The following information related to the production of leather bag for the month of September, 1 month. Leather sheet and cotton clothes are the main inputs. 2 meter of leather sheet is required and 1 meter of cotton cloth is required for a bag. 2000 meters of leather sheet and 1000 meters of are purchased at 320,000 and 15,000 respectively. Freight paid is 8,500. Freight paid is 8,500. Stitching and finishing need 2000 man hours at the rate of rupees 80 per hour. So now this is your direct labor. This is your direct material. Other direct cost. This is your direct expense. 10 rupees per labor hours. That is 2000 hours. G Limited have 4 machines at a total cost of 22 lakhs. Machine have a life of 10 years with a scrap value of 10% of the original cost. Which means around 19 lakh 80,000 is your depreciable value. And it is charged on the straight line method, which means 10 per year. Per year it is 198,000. Per year it is 198,000. However, however, guys, one thing you have to remember, we are calculating per month divided by 12. 198,000 divided by 12. Around 16,500 is your factory overhead depreciation. The monthly cost of administration and sales office staff are 45,000 and 72,000 respectively. Both I can take to COS. G Limited pays 120,000 per rent for 2,000 square feet of factory premises. Administrative and sales office acquires 240 and 200 respectively in the factory space, which means 240 plus 200, 440. That is 1,960 is occupied by factory, 440 is occupied by sales and this one. Accordingly, what you are going to do? You are going to divide the rent of 120,000 with 2,400 square feet. That is rupees 50 per square feet. So for factory it is 50 into 1,960. 98,000. For your office administration it will be 240 into 50, which will come to 12,000. For the sales it will be 200 into 50, which will come to 10,000. Freight on delivery, this is your selling and distribution. During the month, 35 kg of scrap are sold at 150. You should reduce it while arriving at COP. There are no opening and closing of input material, which means you are producing how many bags then? 1,000 bags. Because 2,000 meters of leather, you can produce 1,000 bags. There is a finished stock of 100 bags in the stock at the end of the month, which means 900 bags were sold. Accordingly, we'll do the cost sheet, nothing special here. AZ company has prepared its budget for the production of 2 lakh units. The variable cost per unit is rupees 16 and fixed cost is 4. The company fixes its selling price to fetch a profit of 20% on total cost, that is rupees 20 into 20%. They want to fetch at least rupees 4. Present break even they are asking. Guys, how much is the total fixed cost? Total fixed cost is 8 lakh. Total fixed cost is 8 lakh. Selling price is how much? Cost itself is 20. They want 4 rupees profit. That is 24 rupees. So in the 24 rupees, 16 rupees is variable cost, means contribution is rupees 8. Contribution is rupees 8. So guys, 8 lakh 8 lakh is your fixed cost, divided by contribution per unit is rupees 8, which means present break even in quantity will be 1 lakh units. 1 lakh units. In sales it will be 1 lakh into 24, rupees 24 lakhs. Rupees 24 lakhs. Done. PV ratio. You know that 8 rupees is a contribution, 24 rupees is a selling price, 33.33%. Revised break-even sales and revised PV ratio, if it reduces its selling price by 10 rupees, which means the new selling price will be 24 minus 10%, 21.6. But your variable cost remains same, because that has nothing to do with your profit, selling price. So 5.6 is your contribution. So it is 5.6 divided by 21.6 into 100, around 25.92 or 93, let's say around 26% is PV ratio. Now they are asking break even also, that is 8 lakh, fixed cost won't change, divided by 25.92%, let's say. What would be the revised sales in quantity and the amount if the company desires a profit increase of 20% more than the budgeted profit? Right now they are making a profit of 4 rupees for 2 lakh units, which is basically 8 lakh. Now they want to make 9 lakh 60,000 and selling price is reduced by 10% as above. So the selling price will be 21.6. So they want to earn a contribution of 5.6 per unit from X units. So, and your fixed cost of 8 lakh you should recover. Sure. Fixed cost of 8 lakh is required. So 8 lakh plus 9 lakh 60,000, 17 lakh 60,000 divided by 5.6. So you have to sell around 3 lakh 14,286 units. 3 lakh 14,286 units. That will be your revised sales. This is the question number 3 is just like your the bus question what is there in your study mat relating to school students. Less than 8 kilometers, no, less than 4 kilometers, more than 4 kilometers, half the charge, that one. Okay, listen here. Paras Travels provides a minibus to an IT company for carrying its employees from home to office and dropping back after office hours. It runs a fleet of 8 minibuses for this purpose. Buses are parked at a garage adjoining the company premises. Company is operating in two shifts. One shift in the morning, one shift in the afternoon. The distance traveled by each minibus one way is 30 km. Company works 20 days a month. Done. The seating capacity of each minibus is 30%. The seat is normally 80% occupied during the year. Detail of the expenses they have given. For a year expense they are asking here, so no worries. Paras Travels charges two type of fares from employees. Employee coming from the distance beyond 15 kilometers away from the office are charged double the fare which are charged from the employees coming from the distance of up to 15 kilometers. 50% of employees travel in each trip are coming from the distance beyond 15 kilometers from the office. Charges has to be based on the average cost. So listen here. Driver salary 20,000 per month. So per bus per annum. Per bus per annum. I'm going to take per bus per annum. Okay. Because they're asking single minibus per annum. So 20,000 is a driver salary per month. So in a 12 months it is 2,40,000. Lady attendant salary 10,000 per bus. That is around 1,20,000. Cleaner, one cleaner for two minibus, 15,000 per cleaner per month. So 15,000 into 12, however, divided by 2. Cleaner it is 90,000. Diesel average 8 kilometers per liter, rupees 80. So now we have to calculate how many kilometers we are traveling. Guys, morning from company it will go for how many kilometers? 30 kilometers. Okay. And again bring those employees to company 60 because it is garage at a company. Now again from the company it will go to employees location and it will come back 60. Like this it will do twice. Why sir? This is relating to morning shift, afternoon shift, again it will be there. So 120 kilometers plus 120 kilometers, 240 kilometers per day. Bus is traveling 240 kilometers in a month, 20 days it is doing this. In a month how many days? 20 days. So 240 into 20 into 12, 57,600 kilometers it is traveling in a year, one bus. So 57 600 divided by per kilometer per this thing 8 kilometer you can run, so 7200 liters is required at the rate of 80 per liter. 57,600 divided by 8 into 80, which will come to 5,76,000. Insurance charges 2% of the purchase price. How much is the purchase price of the minibus? 15 lakh. 15 lakh into 2%. 30,000. License fees and taxes 5080 per minibus per month. So 5080 into 12. 60,960. Garage rent paid 24,000 into 12. 2,88,000. And repairs and maintenance. Yeah, you prepare for LMR. LMR in the sense that you should not leave and go. That doesn't mean that only that you should read and go. So repairs and maintenance, engine oil and lubricant for every 5760 it is 2856 per bus. That is 57,600 divided by 5760 into 2856. 28,560. Purchase price, residual life and scrap value. That is 12 lakh is your depreciable value for 8 years. Per year 150,000 is your depreciation. So total cost per year is how much, sir? 240,000 plus 120,000 plus 90,000 plus 576,000 plus 30,000 plus 6960 plus 288,000 plus 28,560 plus 150,000, which will come to 15,83,520. Your total cost is 15,83,520. Now guys, they are asking average cost per employee per month. Now try to understand. The bus is total carrying how many employees in a year? Capacity is 30, but only 80% is occupied, which means 30 employees at 80%. 24 employees. Sir, here passenger kilometer and all we don't calculate. No. Why? You are going to charge them per month, no? Or per annum. Why you are going to calculate passenger kilometer and all? Don't. Okay. So in each trip, it carries 24 employees. Morning they will take them, drop. Afternoon leave them back, and again take the others to the office and again leave. Basically 24 employees. It do two shifts in each bus. In a day 48 employees will travel. However, in that for the 24 employees you are going to charge the normal rate. However, for the remaining 24 employees, basically you should take a morning trip. Let's say morning trip, afternoon trip. In morning trip for 12 employees you are going to charge normal rate. And next it is 24. It came 36. Here it is 12 into 1, 12, 12 into 2, 24, 36. So total it is 72. Now 15,83,520 divided by 72. Around 21,993.33 divided by 12, around 1,832.77. into 2 will be for the people who are coming from the far. Like that they are going to do it. Total cost is 1331, right? We got 1583. Why is it so? Oh, ho, ho, ho. Guys, here be careful. Try to understand. Garage rent paid. It is not for a bus. It is not for a bus. For a whole 5 bus together. For a whole 5 bus together. Okay. So 24,000 into 12 divided by 5 you should do. Here we didn't do it, but you should do. In the previous attempt, the question you mentioned in LMR has actually come up. Is it? Those are important questions. Generally, they will check. That's why we treat it as LMR, no? That's the thing. This drug question, it is already there in the study mat, guys. Go through it once. ABC. This is your contract costing. Ignore. 4A, ignore. R Limited showed a net profit as per the cost accounts. The following information was revealed. Prepare a reconciliation statement showing profit as per financial records. So guys, over recovery of selling overhead. So you should increase your profit because you showed more expense. There you haven't showed more expense. Overvaluation of closing stock. You showed more income, more profit because your closing stock and profit are directly proportional. Your closing stock and your opening stock and profit are adversely proportional. The more the closing stock you show, more the profit. So you showed more profit. Now reduce it. Rent received credited in financial accounts. Here you didn't do it. So you should increase your profit. Bad debts provided in financial accounts. You didn't provide for it. Reduce it. Income tax provided in financial accounts. Income tax provided in financial accounts. So you didn't reduce your profit. Loss on sale of capital asset debited in financial accounts. Reduce here. Under recovery of admin overhead in cost accounts. Under recovery of admin overhead, you showed less expense. So reduce your profit. So lot of less except 2. Basically the same LMR means last minute revision. Correct. That is the questions which you should see and go before going to examination. Because you can't go through all the questions now. That one. Now listen. In a manufacturing company, the standard unit of the production for the year were fixed at 120,000 units. Guys, this is the similar kind of question which is there in your case-based scenario in your study material, standard costing. Okay, listen. We are planning to produce 120,000 units. Now, and these were budgeted. Fixed 12 lakhs, sir. Semi-variable 180, in which 60% is fixed and 40% is variable. So 180,000 into 60%, which will come to 1,08,000. 1,08,000. And here it will be variable will be 40% of it, 72,000. Variable is so much. This is your budgeted. So my budgeted fixed overhead in total will be 12 lakh plus 1 lakh 8,000, 13 lakh 8,000. And budgeted variable overhead will be 6 lakh plus 72,000, 6 lakh 72,000. 6 lakh 72,000. Actual production is 8,000 units. Oh my god. See, this is for a whole year. This is for a whole year. Here they have given per month. Each month has 20 working days. Awesome. During the month, there was one public holiday, which means 19 is the number of working days, which means for the capacity, you have to compute budget, revised budgeted units. During the month of the actual overheads were as follows. Fixed is so much, semi-variable 19,200. Again, in that 19,200 guys, 60% is fixed, 11,520. In the 19,200 into other 40% is variable, 7,680. So your actual fixed overhead is how much, sir? 1,10,000 plus 11,520, 1,21,520. And your actual variable overhead is basically 7680 plus 48,000, 55,680. You are going to do this way. Now you got to know actual fixed overhead as well as budgeted. You are required to calculate the following variances for the month of April. Overhead cost variance. Overhead cost variance means it includes your variable as well as fixed. It includes your variable as well as fixed. And fixed overhead cost variance, variable overhead cost variance, together it will give you overhead cost variance. Together it will give you overhead cost variance, fixed overhead volume variance, fixed overhead expenditure variance, calendar variance. Calendar variance means how much you thought of producing and now again how much you revised that you might produce. Not actual, both are based on budget, but one is revised budget, one is planned budget, one more is new revised budget. Okay, give me a second. Guys, and that service costing, I hope you remember the truck question is there in average. They asked under simple average as well as weighted average. Basically absolute 10 kilometer, commercial 10 kilometer, penalty for overloading and all. That question before going to exam, please see and go once. Okay, the truck question in service. So first, before doing the overhead cost variance, here let's first find out fixed overhead cost variance. Fixed overhead cost variance is how much you have absorbed and how much you have actually incurred. Guys, absorption is based on budgeted data, that is 13 lakh 8,000, and per unit you are planning to recover how much, sir? That is 1,20,000. So standard rate is 13,08,000 divided by 1,20,000, which will come to rupees 10.9 per unit. This is standard rate. For variable it is 6,72,000 divided by 120,000 units. Rupees 5.6 per unit. Rupees 5.6 per unit. Now, your fixed overhead variance is very simple. Absorbed overhead minus actual overhead. Absorbed overhead is how much, sir? Absorbed overhead is 8,000 units. 8,000 units into 10.9 per standard rate is 10.9, no? 10.9, which will come to rupees 87,200, whereas your actual overhead is 121,520. So your under recovering, which is adverse, how much, sir? 34,320 adverse. Okay, going to variable, same formula, absorbed minus actual. Absorbed is how much, sir? 8,000 into 5.6, 44,800. Actually incurred 55,680, which means 10,880 adverse. So together I can tell my overhead adverse variance is 34,320 plus 10,880, 45,200 adverse. 45,200 adverse. Next, fixed overhead volume variance. From how many units you thought of recovering? You thought of recovering from 10,000 units per month. Correct, sir? 10,000 into 10.9. But you are able to recover only from 8,000 units. 8,000 into 10.9. That is 8,000 into 10.9. 87,200 minus 1,09,000. That is 21,800 adverse. Fixed overhead expenditure variance. Budgeted. You budgeted how much? 13,08,000 per year. So per month it is 1,09,000. You budgeted 1,09,000, but you actually incurred 121,520, which means basically 109,000 minus 121,520, around 12,520 extra you incurred adverse. Calendar variance. You thought you were going to produce 8,000 units. Sorry, not 8,000, 10,000 units. Correct? Where your working days were 20. Now that is reducing it to 19. So in the revised budgeted is how much? 10,000 divided by 20 into 19. 9,500, which means earlier your budgeted was 10,000. Now yourself you are reducing it to 9,500. So recovery won't happen as much as you thought. So it is adverse. That is 500 into 10.9. 5,450 adverse. Simple 10 marks question. Always remember, guys, you should never skip these two chapters. Which two chapters, sir? Marginal and standard. Why, sir? Because that is going to save your time a lot if you know how to solve. This is the same one question we have done, no treatment question, same question, and I am expecting that in the examination, so we are going to see it again. It recovers a factory overhead at a predetermined rate of 20 per man day. During the total factory overhead incurred and the man days actually worked was 35.5, that is your actual overhead, and 1.5 respectively. So how much you are absorbing, sir? You are absorbing 20 into 1.5 lakhs, 30 lakhs. You are absorbing 30 lakhs, but actually you incurred 35.5. However, out of 35.5, 2 lakhs was due to strike period. So that should not be considered as actual for while calculating under absorption, over absorption. Okay. And 1 lakh was respect to previous year's booking, which is 32.5. So your actual is 32.5, which means rupees 2.5 lakhs is under absorption. Done. What they are telling? During the period, 50,000 units were sold. Awesome. At the end of the period, 12,000 completed units were held at stock, but there was no opening stock, which means total we produced 62,000 units during the year. However, there was no stock of incomplete units at the beginning, but at the end of the period, 20,000 units are there, which may be treated as 65% complete. Equivalent you should consider 20,000 into 65%, 13,000, which means equivalent units of production during the period is 75,000 units. On investigation, it was found that 40% were due to the factory inefficiency. So, out of 2.5 lakhs, 40%, that is rupees 1 lakh, is due to inefficiency. Charge it to costing P&L. Remaining 1.5 lakhs, that we have to attribute it to the these things, which means supplementary rate. So rupees 1.5 lakhs I should distribute among 75,000 units, which means basically rupees 2 per unit. Now show the accounting treatment. For the cost of sales, I should increase cost of sales. Cost of sales I should debit. How much, sir? 2 rupees into how many units sold? 62,000. 1 lakh 24,000. Okay. And also finished goods, closing stock, I should increase. How much, sir? So I should debit it. 13,000 into rupees 2. 13,000 into rupees 2. That is 26,000. Oh, sorry. Cost of sales only 50,000 units were sold. So 1 lakh. Finished goods, 13,000 units, 26,000, and not 36,000, 12,000, 24,000. And your WIP also should increase by what, sir? WIP also 13,000 equivalent units, 2 rupees, which means 26,000. All this should be debited to overhead account credit. WIP 26,000, finished goods 24,000, COS 1 lakh, costing P&L 1 lakh, that is the 1 lakh this thing. So credit overhead account. This is the journal entry to be passed. Briefly explain the techniques of costing. JPBP, setting labor standards. Go through this question once, guys. Cost control and cost reduction. Go through this ones. That might come for MCQ. Cost control and cost reduction. With that, we have completed 2021 December question. So we have 22 2 attempts, 23 2 attempts, 24 2 attempts, 25 1 attempt. 7 questions, 7 papers we got. Okay, time is 1:36. We are starting at 1:42. We are starting with the next one. See, if at all you sit on solving all these things alone, no, it needs 1 week to complete everything. So if you keep on watching and if you keep on listening properly, then it will be easy for you guys to do it fast. Yes. Guys, now proceeding to May 22 paper. A Limited, a toy company, purchases its requirement of raw material from S Limited at rupees 120 per kg. Company incurs a handling cost of 400 plus freight of 350 per order. So ordering cost per order is 750. The incremental carrying cost is 0.25 per kg per month. So per annum it is 0.25 into 12 rupees 3. In addition, the cost of working capital finance and the investment in inventory of raw material is rupees 15 per kg per annum, which means plus rupees 15, total rupees 18 carrying cost. The annual production is 60,000 units and 5 toys are obtained from 1 kg of raw material, which means for 5 toys you need 1 kg. For 60,000 toys, how much you need? For 60,000 toys, you need 60,000 divided by 5. 12,000 kgs. 12,000 kgs. Calculate the EOQ. Square root of 2 into 12,000 into O is 750 divided by C 18. 2 into 12,000 into 750 divided by 18 and square root of that 1000 kgs. EOQ is 1000 kgs. Our advice: how frequently company should order to minimize its procurement cost? That is 360 divided by, basically try to understand what is happening. Requirement is 12,000 kgs and per 1000, that is per order, which means 12 orders we should place. In 360 days, if we place 12 orders, 30 days once you should place the order to reduce it. Calculate the total ordering cost and total inventory carrying cost per annum as per EOQ. Calculate the total ordering cost. Ordering cost will be 12 orders into 750, 9,000. Inventory carrying cost half of 1,000, 500 into 18, 9,000. Done. PQR Limited has replaced 72 workers during the year. So R is 72. The labor for the quarter, flux method they have given, replacement method, separation method. Now 0.08 is, guys, 72 divided by average number of workers. So average number of workers will be 72 divided by 0.08, which comes to 900. Okay. Number of workers left and discharged during the year. Guys, now you know the separation, 0.05. Number of separations I don't know, but average I know, 900. So 900 into 0.05 will give you 45. 45 is separation. Number of workers recruited and joined during the year. Now flux method I know, 0.16. That is into 900. 900 into 0.16. 144. In this 144, guys, in this 144, separations are 45. Replacements are 72. Other 27 are what, sir? Other 27 are total new employees. Equivalent employee turnover. Whatever the rates are there, now they have given for a quarter into 4, you will get a equivalent employee turnover. The top tech manufacturing company is presently evaluating 2 possible machines for the manufacturing of superior pen drives. Machine A, machine B. Recommend which machine to be chosen. Would your answer change if you are informed that near future demand will be unlimited and the capacity of 2 machines are as follows: 12 lakh, 12 lakh, why? Guys, try to understand. Now, the capacity is 8 lakh and 12 lakh. 8 lakh and 12 lakh. Selling price is 400, variable is 240, which means contribution is 160 and 140. Contribution is 160 and 140. Now 8 lakh into 160 minus 350 lakhs. 350 lakhs. So around 9 crore 30 lakhs is a profit under machine A. Machine B, 140 into 10 lakhs. Contribution minus 200 lakhs. $12 crore. Which one would you recommend? Machine B I would recommend. Would you change your answer if you are informed that in near future demand will be unlimited and the capacity of two machines will be 12 lakh only? In that scenarios, guys, 160 into 12 lakh. $160 into 12 lakh. That will give you contribution minus fixed cost is 350 lakhs. Profit of around 15.7 crores. First machine will give you 15.7 crores. Second machine, contribution is 140 and 12 lakh units. Around 16 crore 80 lakhs minus 200 lakhs. Around 14.8 crores. In that scenario, I am going to choose machine 1. This one, listen. Coal is transported from two mines, X and Y, and unloaded at plots in the railway station. X is at a distance of 15 km. So, there are two mines, X and Y, and there is a plot at a railway station. Okay. What they are telling? X is at a distance of 15 kilometers. Y is at a distance of 20 kilometers. Next, a fleet of lorries having carrying capacity of 4 tons used to transport coal from the mines. Record reveal that average speed of the lorry is 40 kilometers per hour when they are running and regularly take 15 minutes to unload at railhead. So unloading it will take 15 minutes. 15 minutes. However, lorry speed is 40 kilometers. Guys, if this time if they give this in examination, listen how they are going to give. They are going to give two different speed. That is, from X to plot, speed could be 40 kilometers. From plot to X, as it is goes as an unloaded vehicle, I mean without any load, they might give 60 kilometers per hour. Okay. So accordingly, you should consider how many hours you need to go for these things. Average loading time at X is 30 minutes. Average loading time at Y is 25 minutes. And also in RTP, there are two questions. Basically, you should don't forget. One, they have anyhow put in your study material relating to that perishable goods. EOQ maximum level when the perishable goods are there. That one question. And one more question is, okay, whether you accept the quantity discount or no. The answer will be no. Then they will be like, okay, if you don't accept the quantity discount, tell your counter, that is how much percentage if they give as a discount you are going to accept. That one question is there in the recent RTPs. That also you go through once. Basically, you should take the total cost as EOQ and take the price as X and you calculate it like that. You will understand when you see that. I already solved in class, but yeah. at mine X, done. Additional information. Driver's wages, depreciation, insurance, taxes 12 rupees per hour. Operated fuel, oil, tires, repairs and maintenance, etc. 1.6 per kilometer. You are required to prepare a statement showing cost per ton kilometer of carrying coal. First, how many ton kilometers, or before that, per trip, how much is your kilometers you are traveling? X 30 kilometers, Y 40 kilometers. That is going from the mine to plot, plot to mine. Done. Now, guys, if you go at a 40 kilometers per hour to cover 30 kilometers, how many minutes it will take? Guys, 40 kilometers 60 minutes, 30 kilometers question mark, 60 divided by 40 into 30, it takes 45 minutes. It takes 60 minutes. I can tell it as 1 hour and 0.75 hour. 1 hour and 0.75 hour. Done. Now, driver wage, depreciation, insurance 12 per hour. So that is 0.75 into 12. Rupees 9. Here it is 1 hour into 12. 12 only. Done. Next. Operated fuel, oil, etc. 1.6 per kilometer. So 30 kilometer into 1.6. 48. Next is 40 kilometers into 1.6. 64. So it is rupees 57 and rupees 76. Rupees 57 and rupees 76. Done. Now that is your cost. That is your cost. Now ton kilometers. Guys, X 15 kilometers we go with how many tons? 4 tons, right? 4 tons. 15 kilometers we go with 4 tons. Other 15 kilometers we come up with 0 tons, which means 60 ton kilometers per trip. Okay. Y 20 kilometers we go with 4 tons and 20 kilometers we come back with 0 tons, which is 80 ton kilometers. So here 57 divided by 60, rupees 0.95 per ton kilometer. Here it is 76 divided by 80. This also 0.95. Both it is 0.95, 0.95. Oh, but the thing is, guys, try to understand here. We didn't consider the loading and unloading time. Loading it takes 30 minutes, unloading it takes 15 minutes, 45 minutes. So one more 0.75 is there again. So this is not 9, this is 18. Okay. Here loading 25 minutes, unloading 15 minutes, total 40 minutes. So total 100 minutes. Guys, 12 rupees for 60 minutes. For 100 minutes, how much? 20. This will be 20. So this will be 56, 66. This will be 84. Now, 66 divided by 60, 1.1. Here it is 84 divided by 80, 1.05 per ton kilometer. We are going to calculate this way. One point one and 1.05. Now concentrate. In a manufacturing company, the overhead is recovered as follows. Fixed overhead, a percentage of direct wages, factory, fixed percentage of direct wages, admin overhead, fixed percentage of factory cost. Company has furnished the following information: direct material, direct wages, selling price, profit percentage on total cost. You are required to compute the percentage of recovery rate of the factory overhead and admin overhead, calculate how much it is and all. This is same like your ICI material question. That reverse calculation heading they have given now, if I am not wrong, illustration number 9 of the overheads. That one. Now, guys, direct material 1,08,000, 75,000. Direct wages 84,000, 60,000. That will give you prime cost 1,92,000, 1,35,000. Add factory overhead. They are telling factory overhead is percentage of direct wages. I will take it as 84,000 into F percentage. I will get the F in decimals now. 60,000 into F percentage. I can't change it because same percentage I am going to recover from the different cost. Different jobs. Now it will give me factory cost. Factory cost will be how much, sir? 192,000 plus 84,000 F, 135,000 plus 60,000 F. For that, I am going to add the admin overhead. Admin overhead, they are telling fixed percentage on factory cost. A is a percentage, so A percentage on 192,000 plus 84,000 F, and A into 135,000 plus 60,000 F. As it's a job, there will be no opening, no closing. So guys, this itself will be my total cost. This itself will be my total cost. But they have given us how much is the total cost. Where they have given, sir? Guys. If the cost is 100, selling price is 112. So 112 means 333,312. 100 means how much? That is 333,312 divided by 112 into 100. 2,97,600. Okay. Next one. 100 means I don't know, but 120 means 2,52,000. 100 means how much? 252,000 divided by 120 into 100. 2,10,000. Now I will draw the equation using this. How, sir? 192,000 plus 84,000 F. 84,000 F plus 192,000 A plus 84,000 FA will give you 297,600. I will nicely arrange it and write 84,000 F plus 192,000 A plus 84,000 FA is equal to 297,600 minus 192,000. 1,05,600. This I am going to take it as equation number 1. Equation number 2, that is 135,000 plus 60,000 F plus 135,000 A plus 60,000 FA is equal to 2,10,000. 2,10,000. Now 60,000 F plus 135,000 A plus 60,000 FA is equal to 210,000 minus 135,000, which will come to 75,000. 75,000, I am going to take it as 2. Now if you solve the 1 and 2, you will get the answer. Now let's say I will take it as 60,000 F plus 135,000 A plus 60,000 FA is equal to 75,000. Sir, now we have to find out a multiplier, blah blah blah. Guys, don't do all those nonsense things. Here it is very simple. Try to understand. 84 is how many times of 60? That is 84 divided by 60. 1.4 times of 60, correct? So multiply the second equation by 1.4. Multiply the second equation by 1.4, which means 84,000 F plus 192,000 A plus 84,000 FA is equal to 1,05,600. Now multiply second equation by 1.4 because 84 is 1.4 times of 60. So 60 into 1.4, that will also become 84,000 FA. 84,000 F plus 135 into 1.4, 1,89,000 A plus 84,000 FA is equal to 75,000 into 1.4, which will come to 1,05,000. So what will happen, sir? Now these two will get cancelled. Here it will be 3,000 A is equal to 600. A is equal to 600 divided by 3,000, which will come to 20%. So A is equal to 20%. Apply it on some equation so that you will find out F also. That's it. And accordingly, you are going to calculate for this job. This escalation claim is your contract costing. Ignore. SR Limited is a manufacturer of garments. For the first 3 months of the financial year, production will be constrained by direct labors. It is estimated that only 12,000 direct labor hours will be available in the each month. For marketing reasons, production of either two garment must be at least 25% of the production of other. Estimated cost and revenue. Shirts, fabrics, dyes and cotton, direct labor, fixed overhead and profit. For the month of July, that is after April, May, June, after first quarter, direct labor will no longer be constrained. The company expects to be able to sell 15,000 shirts and 20,000 shorts in July. There will be no opening stock in the beginning of July, which means whatever is produced in the first quarter is sold in quarter. Sales volume are expected to grow by 10% per month cumulatively thereafter throughout the year. So from the July month, it will be 10%, 10%, 10%, 10%. Following additional information. Company intends to carry stock of the finished garment sufficient to meet 40% of next month's sales. Estimated selling price will be same as follows. Calculate the number of shirts and shorts to be produced per month in the first quarter to maximize company's profit. You know, whenever the constraint is there, what you should do, you should find out contribution per unit of constraint. Now, shirts. How much is contribution per unit of shirt? 60 is the selling price. Raw material 24. Dyes and cotton 6. Direct labor 8. Which means 1 hour we are taking. Which is 22. Contribution is 22. Sir, fixed overhead, that won't come. Contribution means sales minus variable cost. For the second one, shorts, 44 minus 12 minus 4 minus 4. 24. And here try to understand 8 rupees per hour means here we are taking 1 hour, here we are taking 0.5 hour. Now, how much is the contribution per hour? Contribution per hour. Here it is 22 only, but here it is 48, which means short will be rank 1, shirt will be rank 2. But they are telling that some constraint they told no. For market reason, at least 25% of the production of the other should be there, which means you should produce. For example, now if you produce the shorts 100, you should produce 25 shirt. You should produce 25 shirt. Now, I don't know how much shorts to be produced. That I will take it as X. Okay. X. Now, it will take 0.5 hours. Correct. Also, we know that 0.25x we should produce as a shirt, the other one, which will take 1 hour. Yes. Together, it's going to give us how many hours of labor, sir? 12,000. 12,000 hours of labor. That is 0.5x, 0.75x, 12,000 divided by 0.75. X is equal to 16,000. 16,000 shirts, which means 4,000 shirts to be produced in the first 3 months. I will show the workings here. So 16,000 unit, 4,000 and 16,000 sales budget. Now see what they are trying to tell. For July, August and September. July there is no restriction from July, which means how much our demand is there that we will meet. 15,000 and 20,000. August 10% increase, right? 10% increase. So 15,000 plus 10%, 20,000 plus 10%. September, again 10% increase, cumulative, which means August 10%, that is 16,500 plus 10%, like that it is. 22,000 plus 10%, cumulative basis. We'll find out the sales budget, production budget. In the month of July, no opening stock. Sales demand is there. Closing, we are planning to keep here onwards. From the July month, we are planning to keep the closing. The company intends to carry the finished goods sufficient to meet 40% of the next month's sales. Accordingly, we are going to do it. Nothing special here. Cost sheet, guys. Any special thing is there here? Stock of raw material purchase, manufacturing wages, depreciation on plant, expense paid on this one, lease rent, administration overhead, expense paid for pollution control and engineering maintenance. Guys, don't think it as a production, this production cost, and don't think quality control and all. Pollution control, it form part of your factory overhead. Closing stock, primary packaging, form part of your cost of production. R&D, cost of production. Selling and distribution. This opening stock they have given. Entire opening stock was sold. 3,000. Nothing special in this. I'm not going to solve it. Let's not waste the time on that. So the complete production operation requires 2 processes. The raw material first passes through process 1, where chemical G is produced. Following data is furnished to related to that. Opening WIP, they have given material input, work complete, closing WIP, opening WIP, material cost, this one. This is new, material input cost is new. If I'm not wrong, this is the same question which is there in your study material. I'm not going to discuss it again. Okay. Let's not waste our time. I hope you have gone through this question already once. Look at this question. For A, 4B, sorry. EV Limited started a manufacturing unit from 1st October. It produces a designer lamp and sells it at rupees 450. During the quarter ending 31st December, first quarter for them, basically third quarter, it produces and sold 12,000 units, suffering a loss of 35. During the quarter ended next quarter, it produced 30,000 units and earned a profit of 40, which means 12,000 units at 450. Sales is 54 lakhs, but loss is 12,000 into 35. 4,20,000. Next quarter, 30,000 units into 450. One crore 35 lakhs. But the profit is 30,000 into 40. 12 lakhs. So I know the change in sales. I know the change in profit. Using that, I can find out PV ratio. Total fixed cost incurred. I know the PV ratio. Using that, I will find out contribution of one thing. Profit, I know the balancing figure will be fixed cost. Break even, I know fixed cost, I know PV ratio, I can compute break even. Calculate the profit if the sales volume is 50,000. That is 50,000 into variable cost, that is PV ratio will give me contribution, minus fixed cost as I calculated above will give me the answer. Journalize the, sir, are you live or is this a premiere? I hope you got your answer. So, journalize the following transactions assuming the cost and financial accounts are integrated. Direct material issued to production. Direct material issued to production, basically guys, that is WIP to stores ledger control. Allocation of wages indirect. Indirect means factory overhead control to wages control. Factory overhead over-absorbed. Over-absorbed means basically we are going to charge it to costing P&L. Costing P&L to factory overhead. Administration overhead under-absorbed. Under-absorbed means charge it to costing P&L. Costing P&L to admin overhead. Over-absorbed means you should credit it to costing P&L. That is factory overhead to costing P&L. Costing P&L to admin overhead. Deficiencies found normal, which means you are going to charge it to production overhead. WIP to SLC, wages, factory overhead to costing P&L, costing P&L to admin, factory overhead to stores ledger control. This is ABC. I'm not going to discuss that. Our manufacturing department departments of a company has employed 120 workers. The standard output is 20 units per hour. and wage rate is 25 per labor hour. So 120 workers, when they work for 1 hour, they are able to produce 20 units, which means in 120 hours, labor hours, you are able to produce 20 units, which means per unit, it is 6 hours. Per unit, it is 6 hours. In a 48 hours week, our department produced 1000 units despite 5% of the time paid being lost due to abnormal reason. The hourly wage rate paid were so and so. First, actual hours. Actual hours are very simple. 120 workers working for 48. Actual hours paid. 120 workers working for 48 hours. 5760. Idle time, 5% of this. 288. Actual hours worked. 5760 minus 288. 5472. Now standard hours. Guys, 1 unit take 6 hours. So now we are producing how many units? 1000 units. So standard hours are 6000 hours. Standard rate rupees 25 per hour. So you have all the information here using that labor cost variance. Standard hours into standard rate minus actual hours paid into actual rate. Rate variance, standard rate minus actual rate into actual hours paid. Efficiency variance, efficiency standard hours minus actual hours into standard rate. Idle time variance, idle time into standard rate. Idle time is nothing but actual hours worked minus actual hours paid minus actual hours worked. RST Limited is under the joint cost XYZ. Products are processed further. Pre-separation cost are apportioned on the basis of weights of output of each product. The following detail is provided. Cost incurred up to separation point. This is your JC. Output they have given 100, 70 and 80. Cost incurred after separation is so much. Selling price after further processing is so much. Before further processing is so much. Prepare a statement showing profit or loss made by each product after further processing using presently adopted policy. Advise whether they should process it or no. So guys, try to understand how much is my joint cost. 10,000. I'm going to apportion it on the basis of the weights, that is 100 plus 70 plus 80, 250. So 10,000 divided by 250 per kg or per liter 40, that is 100 into 40, 4000. 40 into 70, 2800, 3200, 2800 plus 3200 plus 4000. Done. Now this is your joint cost. Now everything is further processed. So sales will be how much? Sales will be 50 into 100, 80 into 70, 60 into 80. 50 into 100, 5000s. 80 into 70, 5600. And 60 into 3000, 60 into 80, 4800 minus joint cost 4000, 2800, 3200, 1000, 2800, 1600. Further processing cost 2000, 1200, 800, basically negative 1000, 1600 and 600, which means guys A should not be further processed. B and C, you can just, you have to check, try to understand. Here, how much is a additional sales for A? 25 per unit, that is 100 units, 2500. Incremental revenue is 2500. In case of B, it is 10 into 70, 700. In case of C, it is 15 into 80, 1200. Incremental cost 2000, 1200, 800. So product Y don't produce, because your incremental cost is greater than incremental revenue. This overtime premium, one of the very important theory question you can expect in the examination. Wants to grab some special order, overtime is required to meet the same. Department X works overtime to make the shortfall in the production due to some fault of management in Department Y, charge it to Department Y. Work overtime regularly throughout the year as a policy due to worker shortage. That basically worker shortage, guys, you are going to treat it as a normal and inflated rate you calculate and charge it. Due to flood in the Odisha, that is charge it to costing P&L. Customer request job, and this grabs some special order to meet the urgent orders. Overtime will be overheads. Please go through this question. One already it's there in your study mat once. Go through that. With that, we have completed May 2022 paper. Now we'll be discussing November 2022. Okay, November 2022. Here onwards, if anything reverse, like repeated things are there, we'll just proceed without discussing that. Okay. Because majority of the questions we have discussed now so far, so you will only see how the examination questions are same kind of things are repeated again and again. Now the time is 2:26. We'll start at 2:32. Okay, we'll start at 2:32 a.m. Yes. We'll continue. Yes. Now we'll continue with November 22 paper. A Limited is a pharmaceutical company which produces vaccines for monkeypox, COVID-19 and chickenpox. A distributor had given an order for 1600 monkeypox vaccine. The company can produce 80 vaccines at a time. To process a batch of 80 vaccines, they have given direct material, direct wages and lab setup cost is so much. Production overhead are absorbed at the rate of 20% of direct wages and 20% of production cost is charged in each batch for the selling, distribution and administration. Company is willing to earn the profit of 25% on sales. Total sales value of 1600 monkeypox they are asking. Selling price per unit of vaccine they are asking. So basically guys, 1600 means how many batches? 20 batches. So 4250 into 20, because per batch cost we know 85,000. 500 into 20, 10,000, and 1400 into 20, 28,000. Production overhead is absorbed at the rate of 20% of direct wages, that is 2,000. And total cost is now 85,000 plus 10,000 plus 28,000 plus 2,000, 1,25,000. On this we will add 20%. 25,000. That will give you total cost 1,50,000. For that, they are telling that 25% of the sales value is the profit, which means 33.33 on cost, which is 50,000, which will come to 2 lakhs. So the selling price is 2 lakhs. Two lakhs. Also, they are asking per vaccine how much? 2 lakhs is for 1,600. So 2 lakh divided by 1,600. 125 per vaccine. This one is there in your ICA material. I am not going to discuss ABC. Users 7,500 per month, which means annual requirement is 7,500 into 12, 90,000. Purchase price is 1.5. Carrying cost is estimated 20% of the average inventory on annual basis. Cost of placing an order getting delivered is 15. It takes 1.5 months to receive the delivery from the date of placing an order, and safety stock is 3,200 valve is desired. You are required to calculate the EOQ. EOQ is, guys, square root of 2 into annual requirement is 90,000 into 2AO. O is how much, sir? Ordering cost. Ordering cost is 15 divided by C is how much? C is 1.5 into 20%. 0.3. That is 2 into 90,000 into 15 divided by 0.3, square root of that, which will come to 3,000. 3,000. So 90,000 divided by 3,000. 30 orders we should place. 30 orders we should place. 360 means 360 divided by 30. Around 12 days once we should place the order. 12 days once we should place the order. Okay. Reorder point is how much, sir? Reorder point is, they are telling that, see here, let me show it here. Reorder point is, try to understand maximum consumption. Whenever the question is silent about different kind of consumption, whatever the consumption is there, that itself is maximum, that itself is minimum, that itself is average. So 7,500 per month for 1.5 months is maximum lead time it will take. Also, we want to keep 14,450. 14,450 walls, which means our reorder level or reorder point or reorder quantity to be made is 14,450. If the wall cost is so much, again the things will change, that I am not going to discuss now. Sells a product Y at the price of 300, variable cost is 180, fixed cost is so much, profit is so much. This also I am not going to discuss now. All those things are similar things are discussed already. Without the aid of robot, with the aid of robot, this question is as same as your study mat question what they have given. With the help of computer, without the help of computer, that question. A skilled worker in PK Limited is paid at a guaranteed wage rate of 15 per hour in 48 hours week. Standard time to produce a unit is 18 minutes. During the week, a skilled worker Mr. A produced 200 units of product. The company has taken a drive for a cost reduction and wants to reduce its labor cost. Calculate the wage of Mr. A under each of the following method. Time rate. As per time rate, week, that is week consisting of 48 hours, we are paying 15 rupees per hour, which means 720 rupees we are paying on a timely rate. Okay. Piece rate. Piece rate is very simple. Guys, 15 rupees we are paying for an hour, but they are telling 15 rupees is for 60 minutes, for 18 minutes question mark, because one unit takes 18 minutes on an average. 15 into 18 divided by 60, around rupees 4.5. Now, how many units here is producing? Is producing 200 units at the rate of rupees 4.5, which will come to rupees 900. Okay. Halsey premium plan. Halsey, for standard hours we want. Actual hours we know 48 hours, but standard hours we want. One unit takes 18 minutes. So 200 units takes how many? So 200 into 18, 3600 divided by 60, 60 hours. Standard time is 60 hours, actual time is 48 hours. Halsey, that is 48 into rupees 15 plus half of time saved 12 hours into hourly rate 15. $90, 810. Row 1, 48 into 15 plus time saved 12 out of time allowed 60 into 48 into 15. $864. Suggest which bonus plan the company should follow. Company should follow Halsey because they are paying less under Halsey. Next one is this activity based costing. I'm not going to discuss that anyway. Third one, a contract costing, ignore. Unlimited produces and passes through the process 1 and process 2. Company has provided the following information: raw material, direct wages, realizable value of scrap, normal loss, units transferred, sales. So nothing special in this question, not going to discuss, because all these questions we have discussed so many times. This is nice question, decision making question. An agriculture an agricultural based company having 210 hectares of land engaged in growing 3 different cereals, namely wheat, rice and maize annually. The yield of the different crop and their selling price is follows. Yield in kgs per hectare 2500 100 per hectare, okay, and selling price is per kg. Now variable cost, labor charge, packing material, other variable cost, this is per kg, this per kg, rupees 14 per kg, here it is rupees 13 per kg, Here it is rupees 150 per kg. The company has a policy to produce and sell all three kind of crops. The maximum and minimum area to be cultivated for each crop is as follows. Maximum, minimum, both the rule are there. Rank the crop on the basis of contribution per hectare. Guys, try to understand. Selling price per kg is 20. Variable cost per kg is 14. Which means, can I tell contribution per kg is rupees 6? Yes. 40 and 13. That is rupees 27. Yes. 250 into 150. 250 minus 150. That is 100. Rupees 100. Now that is contribution per kg, but I want to know per hectare. How to calculate per hectare? Sir, I know how many kgs I am able to produce per hectare. So what I am going to do, I am going to calculate per hectare how much. Per hectare how much? That is basically 6 rupees per kg, and in 1 hectare 2000 kgs. That is rupees 12,000. 27 for 500. 13,500. Done. 100 for 100. 10,000. So ranking: rice first, wheat second, maize third. But you can't directly decide completely on that. Why? Minimum criteria is also there. Determine the optimum product mix. Guys, first make sure maize 10 acres should be there. Okay. Now rice 50 acres, let's say, because that is the first rank, no? So 50, 60, and how much is remaining? 150 is remaining. Out of 210, 60 is gone, 150 is remaining. So wheat you can go for 150 hectares, no doubt in that. And accordingly you are going to calculate the profit. Okay. They produce two masks, disposable mask as well as cloth mask. Direct material, direct wages, production overhead. Direct material cost per unit of cloth mask was twice as of direct material of the disposal mask. As I told you guys, if you remember super pen, normal pen question, direct material, direct labor, if you remember. So that's what I am trying to tell. Now almost majority of the questions we have seen. So extra adjustment won't be there. Much won't be there. That's the thing. Okay. So that is ditto question. You go through it on your own once. Now A, B and C are the three raw materials required. The standard material input required for 1000 kg of finished goods as follows. We need 1100 kg. During the period, company produced 20,000 kg of product M, which the actual quantity of material consumed you leave. Now, when you wanted to produce 1000 kg, you wanted A 500. Now you want to produce 20,000 kg, standard quantity of A will be 10,000. Okay. When you wanted to produce 1000, B was 350. Now, when you wanted to produce 20,000, B should be how much, sir? 7,000. When you wanted to produce 1000, C was 250. Now, when you wanted to produce 20,000, C should be how much? 5,000. So that is 17,000, 22,000. In the 10% loss will go 2,000. Correct. 20,000. Done. This is your standard quantity. Actual quantity they have given here. Actual price they have given here. Standard price they have given here. Only thing is RSQ. If they ask a RSQ, how to find it out, sir? Very simple. Total of AQ is how much? 11,000 plus 17,500, 22,000. Now 22,000 in the ratio of 500, 350, 250, 1100. 22,000 divided by 1100, 20. 20 into 500. 10,000 divided by 500 into 350. 7,000, 5,000. This is your revised standard quantity. Material cost variance, standard quantity into standard price minus actual quantity into actual price. Price variance for each raw material, price variance, standard price minus actual price into actual quantity. Usage variance, standard quantity minus actual quantity into standard price. Yield variance, standard quantity minus revised standard quantity into standard rate or standard price. These are the things for 10 marks. Oh my god. B. X Limited follows non-integrated financial account, shows the net profit of so much. You want to find out the cost profit, which means whatever done in the financial, we should reverse it. Whatever done in the cost, we should do it. Legal charges provided in financial accounts. So increase your profit, no more expense, because in costing it is not there. Interim dividend received, reduce your profit, that is not there in costing. Preliminary expense, increase your profit, not there in costing. Over recovery of selling overhead, reduce your profit, there it is there more. Profit is all of this one, decrease your profit because it is not there in the cost. Undervaluation of closing stock in cost accounts. In cost account you showed less profit, here also you show less profit. Over recovery of production overhead in cost, there you showed more expense, here also show more expense, less profit. Interest paid on debentures, add back to profit. We produce two products out of a joint process. The NRV of the byproduct is used to reduce the joint production cost before the joint costs are allocated. During the month, company incurred a joint production cost of 4 lakh. Main product L is not marketable at split off, thus it is processed further. Production L and byproduct M. Selling price is 5. So 5 into 200,000. Done. Now, how much is your joint cost? 3,99,000. 3,99,000. Now 10,000 into 45. 4 lakh. 10,000. Yeah, 4,50,000. And joint cost is 3,99,000. So that is around 51,000. Also further processing cost of 1,01,000, which means around negative 50,000 is your loss. Now selling price to, if you wish to earn the profit of 1 lakh, so 10,000 into X minus joint cost 3,99,000. That is 10,000 minus 10,000x minus 3,99,000 minus 1,01,000 should give me profit of 1 lakh. So how much is X you are going to compute? Sixth one, the theory. This B is there. Now how you are going to treat that one? You check once. And this one, cost units. Go through these ones. With that, we have completed our November 22. So now we'll be left with May 23. Having trouble with only reconciliation. All you have to do is what profit you want to find out, you should check, like final result. So what we did while arriving at that final result, we should do it for the base book also. What we haven't done there, here we have done, reverse it. Basically, you should find out how it is affecting the base book's profit or loss. That's it. Practice it. Guys, 4 more papers are there. We'll do one thing. Five papers are there. We'll do one thing. We'll continue tomorrow. Okay. 5 papers are there. We'll continue tomorrow. That is, which are those 5, sir? May 23, November 23, May 24, September 24, Jan 25. 2 old syllabus paper, 3 new syllabus paper are there, that we'll see tomorrow. Okay, bye bye. Thank you so much. All the best. Study well. Okay, don't waste time tomorrow. Tomorrow evening we'll update you guys about the timings. Fine. Keep subscribed to the channel to know the notification, to get the notification relating to the classes. Bye bye. I hope your preparations are going well, guys. Yes. So without wasting much time, we are starting with the remaining papers. Okay. We are going to start with the remaining papers. That is, last 5 papers are remaining. We are going to discuss that. Sir, tell the important theory topics. Theory topics, whenever the theory questions coming, whether it should be read before the exam or no, I am telling it, right? So, I am already telling it. Yes. Isala cup namde, RCB win, yeah, pakka. Forget about all those things. Final has time, but your exam is tomorrow. Concentrate on that. You should study so good that tomorrow after exams, you should peacefully watch a match without thinking much about exams. Yes, guys. Okay. Listen. We are starting with next paper, that is May 2023. TSK Limited, not CSK, TSK. Manufactures a variety of products. The annual demand for one of its product X is estimated as 135,000 units. Product X2 is to be manufactured in batches. Setup cost of each batch is 3375. 3375. The inventory holding cost is rupees 5 per unit. It is expected that demand of product X would be uniform throughout the year. They are asking you EBQ. Guys, square root of 2 into 135,000 into square root of 2D. Yes, setup cost is how much, sir? 3375 whole divided by holding cost is 5. That is 2 into 135,000 into 3375 divided by 5, square root of that 13,500 units. 13,500 units. Assume that the company has a policy to manufacture 7,500 units of product X per batch. Calculate the additional cost incurred. That I have already solved in so many questions. I am not going to show the same things again. They are asking you calculate the weekly earnings of one operator under total existing time rate system, row 1 premium, Halsey premium. Assume the operator works for 48 hours in a week and produces 100 toys. Done. Now, SMC Limited is producing a particular design of toys under the following existing incentive system, guys. Normal working hours is 48 hours and late shift hours in a week is 12 hours. Total is working for 60 hours. Rate of payment. Normal working rupees 150 per hour, late shift rupees 300 per hour. Average output per operator for 60 hours per week is 80 toys. the company's management now decided to implement a system of labor cost payment, which either the Rowan premium plan or Halsey premium plan, in order to increase output, eliminate overtime and reduce the labor cost. Following informations are obtained. Following informations are obtained. The standard time allowed for 10 toys is 7.5 hours. Time rate is 150 per hour as usual. Assume the operator works for 48 hours. This is actual hours, and produces 100 toys. Now guys, if the operator produces 100 toys, then 110 units takes 7.5 hours. Yes, so 100 should take 75 hours. 100 should take 75 hours. So standard hours are 75. You are required to calculate the weekly earnings of one operator under the existing time rate. Rowan premium, Halsey premium. See here, I'm going to show it here. Now try to understand, when the employees are working for 60 hours, how much we are paying? 150 for normal hours, 300 for overtime, which means total we are paying 10,800. So on an average we are paying them 180 per hour, right? 10,800 for 60 hours, so 180 per hour. However, now due to Halsey, or now what they are getting paid is basically guys 48 hours at the rate of 150 and 12 hours at the rate of 300, 10,800. Now if they go for a Halsey or Rowan, let's say, what is the formula? Time taken into hourly rate plus time saved divided by time allowed or standard time into time taken into hourly rate. So time taken into hourly rate, 48 into 150 plus time saved. Guys, out of 75 hours, if the 48 hours if they have worked, which means 27 hours they have saved. So 27 divided by 75 into 48 into 150, 9792. If it's a Halsey, it is time taken into hourly rate plus half of time saved into hourly rate. So time taken into hourly rate, that is 48 hours at the rate of 150 plus 50% of time saved into hourly rate. You are going to calculate that way. The following information relating to ZB Limited for the year, PV ratio they have given, margin of safety they have given, and fixed cost they have given. Guys, you know the PV ratio, you know the fixed cost. Using that, of course, you can find out break even. Break even is fixed cost divided by PV ratio. If at all you get a contribution per unit, you will get it in units. When you get it in percentage, you will get it in amount, 42 lakhs. 42 lakhs. Total sales value they are asking at present. Try to understand. 42 lakh is nothing but 75% of your sales, because 25% is margin of safety out of total sales, which means 75 should be break even sales. So total sales is 56 lakhs. Proposed sales value. If company wants to earn the present profit after reduction of 10% fixed cost, now they want to earn the same profit. Right now, how much profit they are earning? Guys, contribution at the current profit is 56 lakhs into 30%. 16 lakh 80,000 minus fixed cost of 12 lakh 60,000, 4 lakh 20,000. Right now we are earning a profit of 4,20,000. Now what they are asking, in future how much you should do if at all your fixed cost comes to just 10% less than that, which means it will become 1260 minus 10%, 11,34,000 to earn the same profit, which means my contribution required is 11,34,000 to recover the fixed cost, 4,20,000 to make the profit, 15,54,000. Now, guys, selling price is not changing, variable cost is not changing, which means your PV ratio won't change, which means 15,54,000 is 30% of your sales. So total sales will be how much, sir? 51,80,000. 51,80,000 done. Sales to be made to earn the profit of 20% on sales, assuming fixed cost remains unchanged. Now, to earn the 20%, like let's say sales is X, so the contribution will be 0.3x, correct? Minus fixed cost. Fixed cost they are telling remains unchanged, 12,60,000. Should give me 20% of sales, 0.2x. Now, 12,60,000 divided by 0.1, which will come to 1 crore 26 lakhs. 1 crore 26 lakh. They are asking new MOS if the sales value at present as computed in 0.2 decreased by 12.5. So what would be the new MOS? Guys, try to understand. Whenever the sales value decreases, break-even point has nothing to do with that. Break-even point has nothing to do with the selling price. Of course, selling price changes, break-even changes. But the number of units sold, it has nothing to do with the break-even, which means break-even remains same. Now what they are telling, right now sales is how much? 56 lakhs. They are telling if it falls by 12.5%, which means it falls to 49 lakh. How much will be your MOS? Guys, break even will be at 42 lakhs only, which means MOS will be 7 lakhs. Margin of safety will be 7 lakhs. This is how you are going to compute this. Next, one of the important question or one of the question you can expect in the examination relating to toll plaza. Not a normal question, one of the different question. Concentrate. RST Toll Plaza Limited built an 80 kilometers long highway between two cities and operates a toll plaza to collect toll from passing vehicle using the highway. The company has estimated that 50,000 lightweight, 12,000 medium weight, 10,000 heavyweight vehicles being used the highway in 1 month in outward journey and the same for the return journey. Okay. So how many in a month? Lightweight vehicles 50,000, medium weight vehicle 12,000, heavyweight vehicle 10,000. This is one side. As per government notification, vehicle used for medical emergency, members of parliament, essential service are exempt from the toll charges. It is estimated that 10% of the lightweight vehicle will pass the highway for such use. So whatever the lightweight vehicles are there, no, of the 10% is this only, which means for us the revenue generation lightweight vehicles are only 45,000 lightweight vehicles, one side. And also it is the policy of the company that if vehicle returns within 24 hours of their outward journey, the toll fare will be reduced by 25% automatically. It is estimated that is while coming back, they will be charged only 75% of normal rate. 30% of chargeable lightweight vehicles written within a specific time frame. So try to understand. First, outward no changes at all. Lightweight vehicle, medium weight vehicle, heavyweight vehicle. Lightweight vehicle 45,000 in a month I am talking. Heavyweight medium weight vehicle 12,000, heavyweight vehicle 10,000. Whereas onward, that is when they come back, they are telling same number of vehicles will come back. 45,000, 12,000, 10,000. However, in this 45,000, only 70% will be paying the full money. Remaining 30% will be paying 25%. 75%, which means I am going to split that 45,000 further into two. 70% and 30%. 45,000 into 30%, 13,500, and 45,000 into 75%. 70%, sorry. 45,000 into 70%. 31,500. Done. Now, the toll for medium weight vehicles are to be fixed as 2.5 times of the lightweight vehicle, and heavyweight is 2 times of medium weight. So try to understand. If for lightweight, if you charge 1, here the medium weight will be paid at 2.5. If the medium weight is 2.5, then the heavy weight is 5, because 2 times of medium weight, 5. So onward again, for 31,500 I am going to take the same things. However, for this 13,500 I am going to take 0.75, because they are getting a deduction of 25%. The toll and maintenance cost for the month is so much. Company requires a profit of 10% over the total cost to recover this one, which means the total how much we should recover in a month is 59 lakh 9,090 plus 10%, around 65 lakhs. Around 65 lakhs. What they are telling? Calculate the toll rate for each type of vehicle. If concessional facility are not available on return journey, then this will also be 1. So how many equivalent vehicles are traveling? Here 45,000 plus 12,000 into 2.5. 30,000. That is 45,000 plus 30,000 plus 50,000. 1,25,000. And same thing here, 1,25,000. 2,50,000 equivalent lightweight vehicles are traveling in the same highway. Lightweight vehicle, equivalent lightweight vehicles are how much? Equivalent lightweight vehicles are 2,50,000. Now guys, 2,50,000 around 65 lakhs divided by 2,50,000. Per light vehicle we are going to charge 26 per side. Okay, if at all it is medium weight, we are going to charge 2.5 times of that, 65. If it's heavy weight, 130. Done. Next, if at all concessional rates are available, Calculate the toll rate charged from the lightweight vehicle if the return journey concessional facility is available, assuming revenue earned from the light vehicles calculated in option 1 remains same, which means how much revenue we earned earlier. We earned 45,000 into 2, right? Two sides, 90,000 into 26, that is 23 lakh 40,000 rupees. 23 lakh 40,000. This is what we should earn now. However, from how many vehicles, sir? Onward we will consider 45,000 only of outward, but while coming back, this 13,500 is not actually 13,500 because they will be charged with only 75%. So 10,125, remaining 31,500 will be that much only. That is 45,000 plus 10,125 plus 31,500, which will be 86,625. Guys, 23 lakh 40,000 divided by 86,625. Around, we should charge around 27.013 per vehicle. This is what we are going to calculate. I hope you guys understood. But one of the important question, keep that thing in mind. One of the important question. Next, calculate the consumption of raw material in kgs month by month in total. Calculate the month wise. This is same question what is available in your study material. If you know, guys, budget and budgetary control, this is ditto question is available in your study material. I am not going to do it now. But in study mat, they have done it. The stores ledger, they have done it in some different way. But you do it in a normal way. That is receipts, issues, balance. Do it in this way only, we'll get a answer. B is not there. Contract costing. Prepare a budget showing a current position and the position of the next year, clearly indicating the total product wise contribution and profit for the company as a whole. PQR Limited manufactures 3 products X, Y and Z. The output of the current year 250,000, 280,000 and 320,000 respectively. Selling price of product X is 1.25 times product Z, whereas product Y can be sold at double the price at which product Z can be sold. So selling price of product X is 1.25 times of product Z, whereas Y is double of product Z, which means X, Y, Z. If the selling price of Z is A, Y can be sold at double the price of Z, then the selling price of Y is 2A and selling price of A is 1.25 times of product Z, that is 1.25A. This is your selling price. Product Z can be sold at a profit of 20% on its marginal cost. So Z we can sell it at cost plus 20%. Cost plus 20%. But which cost, sir? Marginal cost. Variable cost. Direct material cost, direct wages they have given. Raw material used for manufacturing all 3 products are same. Direct wages are paid at rupees 4 per labor hour, which means X is consuming how many hours of labor? 4 hours, because we are paying 16 rupees. Y is consuming 6 hours. Z is consuming 4 hours. total overhead cost of the company is 52,80,000 for the year, out of which rupees 1 per laborer is variable and rest is fixed. So guys, I will tell that in the next year it is expected that sales of product X and product Z will increase by 12% and 15% respectively, whereas Y it will decrease by 5%. Total overhead cost of the company is estimated at 55,08,000, that is increasing. Variable cost is rupees 1 per laborer remains unchanged. It is anticipated that all other costs will remain same. There is no opening and closing. Selling price per unit of each product will remain unchanged in the next year. Prepare a budget showing the current position. So next year whatever the change is happening, that is not due to change in the selling price, that is due to change in the sales units. They are asking you to calculate the or show the current budget and all. Now listen. First let's calculate the variable cost. Guys, product Z, 20 rupees is direct material cost, 16 rupees is direct wages, and variable overhead is rupees 1 per laborer, so total rupees 4, which means marginal cost is rupees 40. Marginal cost is how much, sir? Rupees 40. Now the selling price will be 40 plus 20%. 40 plus 20%, 48 rupees. So Z we can sell it at 48. Y will be 2 times of that, rupees 96. X will be 48 into 1.25, rupees 60. Selling price I got to know. Selling price I got to know. Other things I will show it here only. Selling price 60, 96, 48, and contribution per unit. How did you arrive at contribution, sir? Variable cost of all the three. How to arrive at variable cost of all the three? X variable cost will be rupees 36 plus 4, 40. Y 44 plus 6, 50. Z we already calculated 40. 40, 50, 40 is your variable cost. From the selling price, if you reduce 60 minus 40, 20, 96 minus 50, 46, 48 minus 40, 8. And units to be sold, they only have given 250, 280, 320. You will get the total contribution. From that, if you reduce a fixed cost, how did you arrive at fixed cost, sir? Very simple, guys. Here, variable overhead per unit of X is how much? Variable overhead per unit of X is how much? Rupees 4. Correct? Yes. And how much it is? How many units? 2,50,000 units, which will come to rupees 10 lakh. Okay. Variable overhead for product Y is how much? 280,000 into rupees 6. 280,000 into rupees 6. 16,80,000. Variable overhead of Z will be how much? Per hour it is, per unit it is 4 rupees. Number of units are 320,000. 12,80,000. Total is how much, sir? 12,80,000 plus 16,80,000 plus 10 lakh. 39,60,000. Total overhead is how much, sir? Total overhead is 52,80,000. 13,20,000 is fixed overhead. 32,20,000 is fixed overhead. I will get the profit. Now they are telling next year selling price will remain same, contribution will remain same. However, sales quantity, there is an increase by 12%, decrease by 5%, increase by 15%. I will get the contribution, and what they are telling about this one, the total overhead for the next year is estimated as 55 lakh, whereas variable remains same. Variable remains same means 280,000 into 4 m plus 266,000 into 6, no, 6 m plus 368,000 into 4 m plus MRC 41 lakh 88,000. 41 lakh 88,000 minus 55 lakh 8,000 new overhead. 13 lakh 20,000 will be fixed overhead in it. So profit will be so much. That's simple. 10 marks question. Here that prices are the important thing, that you should know exactly how to proceed with it. If you know how to calculate that prices, then all other things will become easy. So I hope it is clear. If it is clear, we can proceed to the next one. They are asking you, prepare cost sheet, calculate the selling price where the 20% on sales is charged, basically 25% on cost. Stock of finished goods. Opening you know, closing you don't know. That you can find out anyhow. Stock of raw material, WIP. Raw material purchased. Guys, this will direct material consumed, reduce it from the direct material consumed. Add it to the works cost, reduce it from the works cost while arriving at a works cost. That is after gross works cost. Raw material purchased, direct material consumed. Carriage inward, direct material consumed. Direct wages paid, direct wages. Royalty paid, direct expense. Purchase of a special design molds and patterns, direct expense, but estimated life is 12 production cycle. Here assume that one production cycle is completed in 1 month. How many months they are asking? 1 month they are asking, which means divide by 12 you should do. Amortization, power, fuel and haulage, factory, you can treat it as direct expense or factory overhead, your call. Research and development should form part of your COP. Primary packaging should form part of your COP. Admin overhead, if the admin overhead nothing is given, you can treat it as general or relating to production. If it is relating to production, form part of COP. If it's general, form part of cost of sales. Salary and wages for supervisor, factory overhead. Opening finished goods is valued at 8.05. During the month, 152,000 units were produced, 150 to 600 were sold. Which means, how many units were there? Opening 2,500. How many units were produced? 152,000. Which means total became 154,500. From 154,500, we are selling 150 to 600, which means 1,900 is closing. Selling and distribution is to be charged at 20 paise per unit extra. Assume one production cycle. One of the easiest question, you can go through it once. Nothing special is there. All are same. See, they have given solution by considering it as both alternative solutions. ABC company produces a product X that passes through three processes R, S and T. Three type of raw material J, K and L are used in the ratio of 40, 40, 20 in the process R. The output of each process transferred to next process. Process loss is 10% of the total input of each process. At the stage of output in process T, a byproduct Z is emerging and the ratio of the main product X to the byproduct Z is 80:20. Selling price of the product X is 60 per kg. Company produced 14,580 units of X. Material price of J is 15 and 9. Material L is 7 per kg. RST variable cost and fixed cost they have given, let it be. The byproduct Z cannot be further processed. Sold at 30 rupees at a split off. There is no realizable value of the process loss at any stage. Present a statement showing apportionment, etc. Before that, you should know exactly how much is the input. You don't know the input. How we can find out the inputs are very simple. They have given output of product X. They have given output of product X. How much? 14,580. Okay. They have given it as 14,580. And they are telling Z will be 20%. I mean, in the ratio of 4:1, 80:20, which means 14,580 divided by 80 into 20, 3645. 3645, which means 14,580 plus 3645, 18,225. 18,225. Now, guys, this is output of process T, process Z. No, process T. Output of process T. What they are telling, the output of each process transferred to next process. Process loss is 10% of the input in each process, which means whatever the input was there in the process T, of the 10% is the loss, which means input, if I take it as the input of the process T, I take it as T, then 10.10 T minus 0.1 T is equal to 18,225. So input in the process T would be 18,225 divided by 0.9, 20,250. Can I tell that 20,250 is nothing but output of product X, processes? Yes, sir. So input of processes, if I take it as S, the loss will be 0.1 S, which will give you 20,250. So 20,250 divided by 0.9, 22,500 is input of S. If the input of S is 22,500, output of R is 22,500. If the output of R is 22,500, the 22,500 is 90% of what is introduced in the R. So how many units are introduced in the R, sir? 25,000 units are introduced in the R. 25,000 units are introduced in the R. In that, how much is J, K and L? 40, 40, 20. That is, guys, 40, 40, 20 is nothing but 10,000 units, 10,000 units, 5,000 units. This is what we introduced. Now you know that all other things not much difficult to ascertain. See here. $25,000, that is 10,000, 10,000 and this one. Calculation of joint cost. In R, we gave an input of 25,000 units. Variable cost per kg is 5. Variable cost is 125. Fixed cost. Total cost of R is so much. Yes, sir. T. We got to know the total joint cost. And This is your raw material JKL prices and process cost. Total joint cost is so much. Apportionment. Two products are coming, X and Z. Z is byproduct, X is main product. So sales value of Z is so much, X is so much. As both has a, I mean even byproduct has a good market value, we are going to consider it as normal product and we are going to apportion it. We are going to apportion it at the ratio at sales at split off point. Accordingly, we'll find out the profit. Actually, this paper was good paper. If you were conceptually strong, you would have scored very well. This ABC costing, I mean absorption, activity based costing, absorption, that just go through that once. I'm not going to solve it here. Calculate the product mix they are telling, which means to generate a maximum profit. It is the key limiting factor in the marginal costing question. MNP Limited produces two products A and B. Direct material, direct labor, variable factory overhead, selling price. The availability of machinery is limited to 55,000 hours. The monthly demand for product A and B are 5,000 and 6,000 units. The fixed expenses are 140,000. That you leave. Variable factory overhead are rupees 4 per machine hour. Now, here 40, here 20 is there, which means how many machine hours were used in product A? 10 hours. That's why it becomes 40. Here 5 hours. That's why it becomes 20. Now, guys, just check whether you can sell both. 5,000 into 10 hours, 50 hours, 50,000 hours we need here only. 6,000 into 5, 30,000 hours we need here only, which means we need 80,000 hours. But we don't have so much. Only 55,000 hours. Key constraint. In that scenario, what I should do, sir? Contribution per unit. But for the key limiting factor, first we'll calculate per unit how much. That is 35 plus 55, guys. 55 plus 35 plus 40, 130, 180. Contribution per unit is 50. Second one, it is 60 plus 45 plus 20, 125 minus 175. That is also 50. Nice. However, we should take a call on contribution per labor hour or per machine hour. Per machine hour, because that is a key limiting constraint. Now, 50 were earning by using 10 hours of machine, which means rupees 5 per machine hour. 50 you are earning, sometimes the question will be on the basis of savings. Okay, not on the sales. That time you should consider the savings. If that is relating to cost, machine should be bought or no, all those. How much you are saving total per hour, how much you are able to save, that way. Now, here 50 is for 5 hours, which means 10 rupees per hour. Better rank 1 is your second product, that is B. Rank 2 is first product A, which means you are going to produce 6,000 units of B. That is 6,000 into 5, 30,000. Remaining 25,000 hours are there, no? In that, per unit 10 hours is required, which means around 2,500 hours of A also you are going to produce. So, product mix to maximize the profit is 6,000 units of B, 2,500 units of A. Hope it is clear. Look at this question. 10 marks, standard costing question. Calculate the standard price per kg and the standard quantity of raw material. Calculate the material usage variance, labor cost variance, labor efficiency variance, and calculate the fixed overhead cost variance if the fixed overhead expenditure, and they're asking you to calculate volume variance also. Basically fixed overhead they're asking all the three, major one. However, labor they are not asking much, only two they are asking. Material they are asking one. But this is one of the nice question. See, this May 23 was good paper, conceptual checking. However, for students, it was not good. Now listen. NC Limited uses a standard costing system for manufacturing of its product X. Following information is available for the last week of the month. 1 week information they have given. 25,000 kg of raw material were actually purchased for rupees 3,12,500. That is how much per kg? Rupees 12.5 per kg. Actual price. The expected output is 8 units of product X from each 1 kg of raw material. There is no opening and closing inventory. The material price variance and material cost variance as per the records are 12,500 and 1,800 adverse respectively. The standard time to produce a batch of 10 units of product X is how many minutes? 15 minutes. The standard wage rate per labor hour is 50. The company employs 125 workers of two category, skilled and semi-skilled, in the ratio of 60 and 40. But as per standard, only one is there. But actually, they are employing in that ratio, 60 and 40, which is basically 125 divided by 100 into 60. 75 and 50. The hourly wage actually paid were 50 and 40. The weekly working hours are 40 hours per worker. Standard wage rate is same for skilled and semi-skilled workers. The monthly fixed overheads are budgeted at 17,480. Overheads are evenly distributed throughout the month, assuming 4 weeks a month. So per week budgeted was how much? Per week budgeted was 76,480 divided by 4. Rupees 19,120. In the last week, actual fixed overhead expenditure is 19,500. Guys, one thing though here we already calculated. What is it, sir? Fixed overhead expenditure variance. How much it is? Budgeted was 19,120. Okay. Actual overhead is 19,500. Which will come to rupees 380, however adverse. Rupees 380 adverse. Now calculate the standard price per kg and standard quantity of raw material. Guys, they are telling the price variance is 12,500 favorable. $12,500 favorable. And also they are telling that 1,800 is material cost variance. If the cost variance is 1,800, price variance is 12,500, material usage variance will be 14,300 adverse. Yes or no? Material usage variance is 14,300 adverse. Done. Now try to understand. Price variance. Price variance is basically standard price minus actual price into actual quantity. Standard price minus actual price into actual quantity, which means guys, do you know the standard price? We don't know the standard price. Let it be SP. Do you know the actual price? Yes, we know the actual price. How much? 12.5. Do you know the actual quantity? Yes, we know the actual quantity because nothing is left as a closing stock and all. 25,000. Which means 12.5 into 25,000. 3,12,500 divided by 25,000. This should give you favorable situation. Favorable means standard price is more than actual. 12,500 positive. That is 12.5 into 25,000. That is 3,12,500. This side it will be negative. When you take it to the that side, it will become positive. That is 3,25,000 divided by 25,000. So standard price is rupees 13. Standard price is rupees 13. Next, standard quantity of raw material. Calculate the material usage variance. Material usage variance I already calculated and told you how much. 14,300 adverse. Okay. Also, using the same material usage variance, that is standard quantity minus actual quantity into standard price. Standard quantity minus actual quantity into standard price will give you negative 14,300 because your actual quantity is more. Now, standard quantity I don't know, but actual quantity we know 25,000 into standard price we know 13. That is minus 14,300. 13 standard quantity minus 25,000 into 13. 3,25,000 is equal to minus 14,300. Now, three lakh 10,700 divided by 13, around 23,900 kgs. 23,900 kgs. So that is your standard quantity. And you know one thing guys, what is it? The expected output is 8 units of product X from 1 kg of raw material. Now, standard quantity means what? Standard quantity for actual production. That is what they are trying to tell is, if at all your standard quantity is 23,900, that is for the actual production. That is actual production will be guys 23,900 into 8. 1,91,200 units. Sir, didn't understand. Try to understand. In question, if they give 191,200 units, what you will do? 191,200. 8 units need, sorry, 8 units of product X need 1 kg of raw material, which means how many kgs of raw material is required? That is 191 divided by 200. Whether we consumed it or no, doesn't matter. But we used to calculate that way as the standard for actual. No, that itself it is. So now using standard, I found out actual. Why, sir? You will understand. Now, labor cost variance. Before that, try to understand. The standard time to produce a batch is 10 units of product X is 15 minutes. The standard wage rate is 50. Now, company employees 125 workers. Okay. They are working 40 hours a week, which means actual hours actual hours worked is 40 into 125, 5000 hours. But standard hours for actual output is, actual output is how much? Actual output we calculated as 1,91,200. Guys, 1,91,200. What they are telling? 10 units need 15 minutes. 10 units need 0.25 hours. Now we are producing 191,200. That needs how many hours? 4,780. So standard hours are 4,780. Done. Labor cost variance. Standard hour into standard rate minus actual hours into actual rate. Standard hours into standard rate. Guys, standard hour is 4780. Standard rate is 50. 2,39,000. However, actual hours into actual rate. Try to understand. For 75 employees, for 40 hours, we are paying them 50 rupees. That is 1,50,000. For the remaining 50 employees, for 40 hours, we are paying them 40 rupees. 80,000. So total 230,000 minus 239,000, 9,000, but favorable. Why favorable, sir? Because we are spending less. Done. Labor efficiency variance. Labor efficiency variance. Guys, labor efficiency variance, that is standard hours 4,780 minus actual hours 5,000 into standard rate is 50, 11,000 adverse, rupees 11,000 adverse. Done. Calculate the fixed overhead cost variance. Very simple. How much is absorbed? Guys. In a week, the monthly, assuming a 4 weeks a month, in the last week, actual fixed overhead incurred is 19,500. Whereas how much we have planned? I will show it here only. Give me a second. 13 rupees. 23,900 only we got now. 23,900. Usage variance, cost variance, efficiency variance. Now see here. Fixed overhead cost variance. Standard fixed overhead minus actual fixed overhead. Let it be. Before that, expenditure variance 380 or something I showed you already. 380 adverse. That is your expenditure variance. Now, fixed overhead here. How much is absorbed? Guys, 19,120 was budgeted. 19,120 was budgeted. Yes, sir. 19,120 was budgeted. Budgeted overhead. And you can take the budgeted output. budgeted output, or you can take the budgeted hours. You can take the budgeted output or you can take the budgeted hours. Try to understand how many standard hours we are taking. 4780, and each and every hours we can produce 40 output. Each and every hours we can produce 40 output. 40 output, that is 1,91,200. 1,91,200. However, we had 125 workers. We thought all of them will work for 40 hours, which means they will work for 5,000 hours. They will work for 5,000 hours, and each and every hours they will compute 40 units, which means 2 lakh is our budgeted output. Now I will get to know how much is my budgeted absorption rate or standard rate per unit. That is 19,120 divided by 2 lakh. 0.0956 into how many units we have actually produced? 191,200. 18,278. But actual is how much? 19,500. 1 to 2 1 adverse because under absorption. Volume variance also you are going to calculate the same way. You want it in unit based. That is how many units you should have produced, how many units you are actually producing. Per unit how much recovery. Done. And mark it as one of the important one. If at all you are a September attempt student, if at all no sir, tomorrow itself is my exam, then see and go. Don't forget that one. One of the different question of standard costing. The following information is there. Financial accounts as well as cost accounts indicate the under recovery, over recovery and their effect on cost accounting profit. You are not required to prepare a reconciliation. Factory overhead as per finance it is 94,750, costing 90,000. So 4,750 is under absorption, under recovery. 4,750 under recovery, which means profit in cost accounting is more. Admin overhead 3,000 rupees under recovery, profit is more. Selling overhead 6,000 over recovery, profit is less here. Opening stock 5,000 overvalued. Overvaluation of opening stock leads to our decrease in profit, so profit is understated. Closing stock 2,500 overvaluation. Overvaluation of closing stock, profit will increase. So that is the thing. With that, we have completed our questions on that. Sir, theory, sir, define cost object. What do you mean by practical capacity, normal capacity, and how the normal capacity is determined? Important question. Theory, important. Capacity based questions. What is practical? What is installed? What is normal? What is actual, practical, all those things. ABM, state any reapportionment, no. How will you treat the normal, abnormal leave? These are the few things. Okay. That was your May 23 question. So now we are left with last 4 attempts papers. So we'll take a break now and we'll be starting in a while. So purchase price is 300. Carrying cost is 6% of purchase price, that is rupees 18. Ordering cost is 150. Consumption of material CEE per annum is 194,400. Lead time average, maximum, minimum. Maximum consumption of CEE per day is 200 kg, more than the average consumption per day, which means you will consume 200 units more than the average consumption. See here. required to calculate EOQ, that is square root of 2a. A is nothing but our 194 400. I will show it here only. Let's not waste time in solving this and all. So many EOQ questions we have seen. 2 into 194 500, 194 400 into 150 ordering cost into 18,800 units. Next, they are telling reorder level. Reorder level is max into max. Max into max. Now, maximum consumption, we don't know. However, maximum lead time is what, sir? Maximum lead time is 8 days. Sir, maximum consumption, how to compute? Guys, 194 400 you are consuming in 360 days. So on an average, always remember, average consumption itself is a for EOQ. If they don't give average like annual consumption, all you have to do is average consumption for that 360 days. You have to calculate as an average consumption, annual consumption. 194 400 divided by 360, 540. 540 plus 200, maximum is 740. Next, maximum stock level, reorder quantity, that will be your EOQ. Reorder level you computed. Minimum consumption, that is average is 540 less 200, 340. 340 into minimum lead time 4. You are going to compute that way. Not much things. B, a worker took 60 hours to complete a job in factory. Normal rate is 80. The worker is entitled to receive a bonus according to Halsey. Factory overhead recovered is rupees 60 per man hour actually worked. So the factory cost of the job is 37,280. Material cost is 28,400. This is ICA material question. Can go through that once. Illustration 10 or so, somewhere there. XYZ Limited manufactures 3 products, ABC. Product B is sold at a split off where the product A and C are sold after further processing. 10% of the quantity of A is lost in the further processing. Number of units produced and sold. A. Selling price after further processing cost. Joint cost up to split off is 5726. Prepare the statement showing using NRV method. So how much is the sales after split off? That is 3,60,000 into 9.5. 34,20,000. Okay. 2,10,000 into 6. 12,60,000. 4,50,000 into 12. 54 lakhs. Minus further processing cost. 860,000 nil 10,40,000. 34,20,000 minus 8,60,000. 25,60,000. 12,60,000 and 43 lakh 54 lakh minus 10,40,000. 43,60,000. In this ratio, you are going to distribute this one, joint cost. So assume XYZ has received an offer to product A at a split off as rupees 7. That is, they are going to, if at all you are going to sell it at 7, and 9 for the C, whether you will accept or no. But A, guys, normal question only. That is, you are going to compare extra revenue, how much you are going to generate, and extra cost, how much it is. Whether if the cost is more than the revenue, then better don't go for it. But here one thing you should see, 360,000 But the thing is, due to further processing, you are losing 10%, which means whatever your output minus 10% of output is giving you in 360,000, which is basically 360,000 divided by 0.9, which means at split off point, number of units you can sell is not 360, number of units you can sell is 4 lakh. Here they have considered, but you can consider here only. Okay, instead of taking 360, always remember incremental revenue. For calculation of incremental revenue, the revenue at 7 rupees is 4 lakh into 7, not 360,000 into 7. Accordingly, we are going to compare and check. Okay. They're asking you a cost sheet. Further, some of the finished goods was found defective and defective product were rectified by incurring additional cost to the extent of 33,600. Sir, rectification of this defective, where it will come, sir? It will form part of factory overhead. Cost of rectification is not included in the details mentioned above. You should include 120,600 generated during the year. That is, you should reduce from the arriving at COP. So, raw material, direct material consumed, opening stock, gross works cost, finished goods, while to the COP you are going to adjust to arrive at a COGS, material purchase, direct material consumed, freight inward, direct material consumed, direct wages, power and fuel, direct expense, cost of special drawing, direct expense, trade discount, reduce it while arriving at a raw material consumed, insurance on material procured, raw material consumed. If at all it's a go down insurance, you are going to treat it as a factory overhead. Rent of a factory building, 1/4 is office, which means 4/5 we are going to treat it as a factory overhead. Depreciation on machinery, factory overhead. Depreciation on delivery vehicle, selling and distribution. Consumable stores and indirect wages, factory overhead. Quality control cost, cost of production. Primary packing, cost of production. General admin overhead, cost of sales. Salary to marketing staff, selling and distribution. Packaging cost for transportation. Packing cost for transportation, again secondary you can treat, that is your selling and distribution. Closing they have given here. Accordingly we are going to adjust, not much. This is one of the basic budget question, go through that once, guys. Third one, ABC thing. This one is nice question. We have solved in class also, but concentrate. That is basically, try to understand, guys. For any hotel, whatever they are recovering from the customers, for example, you incur and you recover from the customer, then that is not your cost at all. That is not your cost at all. If you don't recover, that will be your cost. So try to understand. They offer a 3 type of room to the guest: deluxe room, executive room, and suite room. Other information is as follows. Room tariff, okay. Number of rooms, they got 20 deluxe room, 10 executive room, and 4 suite room. Average occupancy during the year 80%, 60%, 75%. Housekeeping expenses are 280, 320, and 425 per day per room. Okay. The hotel provides the complimentary breakfast facility to executive room and a suite room guest, which means that is expense only relating to guests over here, not deluxe room. Swimming pool facility is free of cost for the suite room guest. So that swimming pool is cost only for suite room, because only for them we are not charging for using the swimming pool. Restaurant and swimming pool is run by a contractor. He recovers 150 per person for a breakfast, 200 per person using swimming pool. Annual fixed charges they have given. Salary of the staff apportioned to the deluxe room, executive and suite room in the ratio they have given. Leave occupancy. You are required to calculate the profit. Assume double occupancy in each category of a room. So here not much thing guys. Here few things you have to remember. That is breakfast expense. For a deluxe room there will be no breakfast expense, but for executive room 10 rooms are there in a year, 360 days, okay, and it will be occupied at the rate of 60%. However, each room consists of 2 person. So if the room consists of 2 person, each person breakfast expense is 150. This is your breakfast expense relating to executive room. Suite rooms, sir. How many suite rooms are there? 4. 360 days. How much is occupancy? 75%. And how many person? 2 person into 150. Swimming pool only to suite. That is 4 into 360 days into 75% into 2 person, and per person they are charging us 200. So this will be our expense for a hotel. Kindly go through this once before going to examination. Royal Hotel question of your November 23. Fourth A we are not going to look into. That is ABC costing question. B. R Limited produces and sells 60,000 units at its Noida plant. Selling price of the product is 15. Variable cost is 80% of selling price, which means contribution is 20%. Fixed cost is 420,000. Company is continuously suffering the loss and they plan to shut down. Fixed cost is expected to be reduced by 250,000, which means although you shut down, you are going to have the fixed cost to the extent of 420 minus 250, around 170,000. That is 1,70,000 fixed cost you will have, no doubt in that. Plus due to shutting down 25,000 you have to spend extra, which means around rupees 1,95,000 is your shutdown cost. That is, although you shut down, you have to incur this. They are asking whether Noida plant should be shut down or no. If at all, yes. At how many units you should shut it down? Very simple, guys. Try to understand. If at all my loss is less than shutdown cost, if I run the business, if my loss is less than shutdown cost, of course I am not going to shut it down. Why? Because if I shut down, my loss will become more, because shutdown cost. Okay, if at all my loss by running is more than shutdown cost, then better to shut it down. So what you are going to check now, try to understand. Now we are selling 60,000 units, which means at the rate of rupees 15, out of which contribution is 20%, which means my contribution right now is how much, sir? 60,000 into 15 into 20%, 1,80,000. My fixed cost is how much, sir? 4,20,000. My loss is 2,40,000. If at all I shut down, then my loss will become 195,000. But now I am incurring a loss of 2,40,000. Better shut down. Find the shutdown point in units. At how many units you will shut it down? Very simple, guys. Try to understand. Let's take units be X. Okay. If I produce X units, contribution will be 0.2X. Yes, sir. Fixed cost, because I am running the business. So fixed cost is 420,000. Now, if at all my loss is beyond 195,000, I will shut down the business. If it is less than 195,000, I don't shut down the business, which means try to understand 195,000 minus 420,000, 225 divided by 0.2. Or I will take contribution in rupees. We want in units, no? 15 rupees into 0.2, 3 rupees, 3x. So 420,000 minus 195,000 divided by 3, 75,000 units. That is, if I sell 75,000 units, my loss will be 195,000 only. So that time, if you want, you can shut down. If you want, you can continue. End of the day, both loss will be same. However, if at all number of units produced and sold are less than 75,000, better to shut down because your cost will be more. If at all it is more than 75,000, then better to continue because your cost will be, loss will be less. Your loss will be less. Hope it's clear. Next, process account. Nothing special is there here. Input, indirect wages, output transferred, normal loss. Just go through that, guys. We have solved a lot of process costing yesterday itself. Fifth one, PQR uses a standard costing system. Great. They're asking you variable factory overhead expenditure variance. Expenditure variance is nothing but standard rate minus actual rate into actual hours or actual output. Fixed factory overhead expenditure variance. Fixed factory overhead expenditure variance. Hours can be found out. Done. Expenditure variance, budgeted overhead minus actual overhead. Fixed factory overhead efficiency variance, that is standard hours minus actual hours into standard rate, recovery rate. Fixed factory overhead capacity is budgeted hours minus actual hours into standard rate. Now, budgeted information, 84,000 units. Standard time for 1 unit of output 0.8 machine hour, which means we are expecting budgeted machine hour to be 84,000 into 0.8, 67,200 hours. Variable factory overhead per unit is rupees 16. Per unit is rupees 16, guys, which means per hour how much, sir? 16 is for 0.8. Per hour it will be 20. Per hour it will be 20. Fixed factory overhead is 672,000, which means my recovery rate will be 672,000 divided by 67,200, rupees 10 per hour. So rupees 20 per hour and rupees 10 per hour is a standard rate. Actual output is basically, guys, 87,600. So standard hours for actual output is 87,600 into 0.8, 70,080. Over variable overhead efficiency variance they have given, actual fixed they have given, actual variable they have given. First, variable overhead efficiency variance means formula is, guys, standard hours minus actual hours into standard rate. Now, standard hours we know 70,080. Actual hours we don't know, but standard rate we know rupees 20 per hour, which means that will give you negative 67,200 because your actual is more. Efficiency, less efficient, your actual is more, which means, guys, 70,080 into 20 minus 67,200, sorry, plus 67,200, no, 70,080 into 20 plus 67,200 divided by 20. Actual hours is 73,440 hours. Actual hours is 73,440 hours. Done. Variable factory overhead expenditure variance. Guys, standard rate into actual hours. Actual hours is 73,440 into standard rate is 20. 14,68,800 minus actual rate into actual hours. That is nothing but actual fixed overhead, sorry, variable overhead, 14,37,000, 31,800 favorable. 31,800 favorable because your standard is more than actual. Done. Next, fixed overhead expenditure variance. Budgeted was how much, sir? Budgeted was 672,000. Actual is how much, sir? 7,05,000. Around 33,000 more than budgeted. Adverse. Efficiency. Standard hours were how much, sir? 70,080. Actual is how much, sir? Sorry, standard is 73,000. Sorry, yeah, standard is 70,080. Actual is 73,440 into recovery rate 10 rupees per hour, right? Or 20 rupees, 10 rupees. 33,600. Adverse. Capacity variance. Budgeted hours were how much, sir? 67,200 minus actual hours are how much, sir? 70,080 into 10. 28,800 but favorable. Why it's favorable, sir? Because you are using more than what you are supposed to use in so many days, which means you are working more efficient, you are working more. That's the thing. Done. That is your this thing. The following data relating to the manufacturing of a product VD during the month. Good units produced 12,600, units sold 11,800. If the opening stock is not there, then the closing stock will be 1,200, sorry, 800. Let's see whether it's there or no. Direct wages they have given, admin overhead they have given, selling price they have given. Each unit produced require 2 kg of material Z and cost of material Z is 72 per kg. 10% of the production has been scrapped and fetched as a bad, which is 45 per unit. Factory overhead is 80% of wages. Selling and distribution is 54 rupees per unit sold. There is no opening and closing of material as well as WIP, so great. You are required to calculate the total cost. Very simple, guys. How many units, good units produced? 12,600. But actually, how many units we have given an input? We have given an input, try to understand, 10% of the production has been scrapped as bad, which means 12,600 is 90%. Around 14,000 is the input. 2 kg per material and it will cost you 72 rupees. Direct material consumed will be 14,000 into 2 into 72. 14,000 into 2 into 72. 20,16,000. Direct material consumed is 20 lakh 16,000. Next, direct wages 8 lakh 82,000 direct. Prime cost. Factory overhead, they are telling that 80% of wages, 8 lakh 82,000 into 80%. 7 lakh 5,600. 7 lakh 5,600. I will get the factory cost as there is no opening WIP, closing WIP. Less sale of scrap. Scrap, they are telling how many units? 1,400 units, and each unit will fetch you 45 rupees, which is 63,000. I should reduce. I will get a COP. Now, cost of production, I got to know. That is, COP is for 35 lakh 40,600 is for how many units? That is for 12,600 units. 281 rupees per unit. Whereas closing is how many units? Closing is, guys, 800 units. 2,24,800 I should reduce. I will arrive at COGS, add admin cost, add selling and distribution cost, COS. You will get the profit. But here be very careful. Direct material consumed, you should not consider it on the final product. In fact, you should consider it on how much you have actually given an input as. Construct the journal entries in the following situation, assuming that the cost and financial are integrated. Purchase of raw material. Purchase of raw material, guys, integrated it is. So SLC to vendor or bank. Direct material issued to production, WIP to SLC. Wages charged to production, WIP to wages control. Manufacturing overhead charged to production, WIP to manufacturing overhead. Simple 4 marks. In this not much theory questions are that great kind of thing. With that, we have completed all the old syllabus exam papers. Now we are left with 3 new syllabus paper. May 24, November 24 and May 25. May 24, November 24, May 25. However, May 24 MCQ papers we don't have. Okay. We'll be starting this at 6:15. Done. Now we'll be starting with this one. Concentrate. Tesco Cycles Limited used about 360,000 locks per annum and the usage is fairly constant, 30,000 per month. The cycle lock consists of 240 each at a wholesale rate and carrying cost is 10% as of that 24. And cost of placing order is 1,200. It takes 45 days to receive a delivery from the date of order. In order to avoid any kind of disruption, safety stock of 6,500 cycle lock is always maintained by Tesco. EOQ. EOQ is square root of 2 into A into O into C. Reorder level. You know average into average. You know average into average. That is 45 into per day how much you will consume. You are going to calculate. That is 1,000 per day. and you are going to add that 6,500. You will get to know reorder level. Company has been offered a quantity discount of 2% provided 30,000 at a time. Advice, normal question. Company produces A and B through a joint process. The joint product cost are material, labor, variable overhead, fixed overhead. A and B are sold at 20 rupees and 15 rupees. Split of the product produced are 2000 and 4000. You are required to calculate under marginal and physical unit method. Same question which we discussed in the previous year paper yesterday. Standard working hours 8 hours per day, 6 days per week. 4 employees, 150 is a maximum capacity. So 8 hours, 6 days, 4 weeks, 150 employees. This will give me maximum hours available. 8 into 6 into 4 into 150. 28,800 maximum hours available. Next, standard hours for actual output is what they are asking to calculate. Very simple. Budgeted hours will be how much? 8 into 6 into 4 into 125. Budgeted hour is 24,000. Now, they are telling actual usage of the budgeted capacity. That is actual hours by budgeted hours is 86%. That is 24,000 into 86 percentage. 20,640. Efficiency standard by actual into 100. So 20,640 divided by 110. Sorry, not 20. 20,640 into 110%. 22,704. I will show it here only. Activity ratio is standard by budget. Standard, you know, budget I showed you how to calculate. Standard capacity usage is budget by maximum. Budget is 24, maximum is 28,800 into 100. This one ABC, it's there in the study material. Go through that. This service costing question, they have asked the airlines question here first time. Sir, but it is not there in our syllabus. No, sir. In your syllabus, transportation is there. Airlines comes under transportation only. So, it operates a single aircraft 180, whereas the average normal capacity is estimated as 70%. The average one-way fare is 12,500. The cost of operation is fuel per flight. Food served on flight 270 per passenger. Commission paid. Fixed cost, lease and per flight, everything they have given per flight. Calculate the net operating income of making a per flight. Airline expects that its occupancy increase to 144 passenger if the fare is reduced to advise whether to be implemented or no. Guys, listen here. Now, first 180 seats we got, in that 70% is occupied, 126. We are charging 12,500 per passenger. However, fuel cost they have given, food 270 per passenger, commission whatever sales is there on that 7.5% contribution. Fixed expenses, they have given 2 fixed expenses here. You will get to know how much is your net income. Now they are telling, boss, now you are able to sell just, you are able to get only 126 passengers. If at all you reduce your fare to 11,670, then passengers will be 144. Okay, anyhow fuel will be same. Food expense that will change. Commission I mean it's on the basis of taking, so that will change, and contribution will get. Fixed cost, lease and salaries, you will get to know how much is your net income. So earlier you are making 1,92,000, now you are making 285,564. Of course it is better to go for the uh, lesser price, that is 11,670. Okay. A factory, this is basically flexible budget. I will just show it. A factory currently working at 60% of capacity at 12,000 units, which means for 100% it is 20,000 units. Management is thinking to increase the working capacity either to 70 or 90. 70 means 14,000, 90 means 18,000. It is estimated that it will be able to sell all the products produced. Great. At 70%, cost of raw material will be increased by 4%. Selling price will fall by 3%. At 90% capacity, the raw material will increase by 5%, selling price will fall by 4%. At 60%, product cost is 360, sold at 400, which means we are making a profit of 40 right now per unit. 360 is how, sir? Material 200, labor 60, factory overhead, admin overhead. Additional advertising 20,000 to be incurred if you want to sell it at 80%, that is for 90%. Basically, this is flexible budget. We have solved question like this yesterday only. Next, they're asking you to prepare a reconciliation taking cost accounts as a base, and which means you start with cost accounts and why it is required. When it is not required, that is when you maintain your books under non-integrated system, sorry, integrated system. That time there is no need of this one. Now, my costing profit is how much? 5 lakh 40,400. Factory overhead under absorbed, which means we should reduce our profit because there we have shown more expense in finance. It is over absorbed. Add back to profit. Interest paid on bank borrowings, reduce from the profit. Interest and dividend received, add to the profit. Notional rent of own premises charged, reduce from the profit because in finance it is not an income. Losses on sale of fixed asset and investment, uh, reduce from the profit because we haven't booked it in cost accounts, but in finance accounts, yes. Donation and subscription, reduce because there it is shown as an expense. Overvaluation of closing stock, reduce, there the closing stock is less profit. Store adjustment credited in finance book, add it. Depreciation overcharged in cost accounts, overcharged, add back to profit. Income tax provided, reduce. So 5,40,400 minus 84,800 plus 24,000 minus 50,000 plus 65,200 minus 60,000 minus 48,000 minus 18,800 minus 125,000 plus 7,500 plus 40,000 minus 150,000, 1,40,500. Give me a second. Somewhere I did the calculation error. 540,400 minus 84,800 plus 24,000 minus 50,000 plus 65,200 minus 60,000 minus 48,000 minus 18,800 minus 125,000 plus 7,500 plus 40,000 minus 150,000. 4,500. Give me a second. 84,800 less 24,000 add 50,000 less 65,200 add 60,000 less guys, that notional rent on own premises is there, no? Okay. That yeah. Notional rent on own premises, they're talking about expense. We booked it as an expense. Okay, not an income. We booked it as an expense, which means we have showed it as expense. Add it back. Add it back because it's not an actual expense, so it's not an expense as per financial accounts. Add it back. Add it back. If at all it is told as notional rent received, then if at all they have told notional rent received, then you should have reduced it. Here they are asking process P, process Q, abnormal loss, abnormal gain. However, try to understand. Two process P and Q, raw material used, raw material cost, direct wages, direct expense, selling price they have given. Why, sir? 3 lakh is recovered as a percentage of direct wages, it seems. Direct wages is how much, guys? 1,30,000, right? 52 plus 78. 1,30,000, which means 3 lakh divided by 130,000. Around 230.76 percentage. On that it is this thing. Actual output they have given. In that 3/4 of the output was passed to the process queue, which means remaining 1/4 is sold. Guys, sold means what you should do? The cost relating to the sold units you should transfer to costing P&L. You should transfer to costing P&L. That's it. Not special in nothing in special in this. I have solved a lot of question on this. Calculate the under absorption, over absorption. This is also 450,000, whereas 42,000 is absolute, which means that you should reduce while calculating under absorption, over absorption. 10,000 sold, 8,000 is there in finished goods, 5,000 of this 40%. Ditto question, guys. But here they haven't given how much is absorbed overhead. Absorbed overhead is 43,000 into 8, 3,44,000. 3,44,000 minus actual overhead. Actual overhead is not 450,000. 450,000 minus 42,000, 4,08,000. Difference will be under absorption, over absorption, and we are going to treat it the same way. We have discussed a lot of question on that basis. Again, I am not going to discuss that now. Super limited manufacturing company facing the problem of high labor turnover. Before analyzing they have given this is the ICI study mat question only, but bit of changes are there. I will tell. Sales they have given, PV ratio they have given. PV ratio they are nothing but profit percentage. Same. The total number of actual hours worked by a direct labor were 5 lakh. The actual labor hours include 60,000 to the training, of which 40% were unproductive. Which means, guys, 5 lakh. That 5 lakh I am going to divide it into 2. 440,000 and 60,000. Of course, 440 is completely productive. However, in the 60 they are telling, in that 60 they are telling 60% it is productive. That is 36,000 is productive. 24,000 is unproductive. So basically, 4,76,000 hours are productive hours out of 5 lakh hours, which means The sales which you are obtaining 2 lakh 16,000 2 crore 16 lakh 80,000 that you are obtaining just by working for 476,000 hours. Okay, done. Due to delay in the personnel department, 95,000 potential hours were lost. So one more this thing, 1,500 units of the output produced during the training period were defective. Cost of rectification is 40. That also should be added to the cost. Settlement cost is so much. Recruitment cost is so much. Cost of training is so much. Assume that the product you has been sold at prevailing. What would be the thing? Guys, very simple. Try to understand. 2 lakh 16, 80,000. Basically, total how much I lost? Productive hours. 95,000 delay. 24,000 training. 1 lakh 19,000 hours. 2 crore 16 lakh 80,000. I'm able to achieve just by working productively for 476,000 hours. However, 119,000 hours I lost due to unproductivity, which means around 54 lakh 20,000 rupees sales I left due to unproductivity. Now, due to this profit also I will lose 15%. Losing sales is not a big deal, but profit also we are losing. No, how much it is, sir? Profit we are losing 15%. Around 8 lakh 13,000 is the profit lost. Plus whatever they produced in the defective is there. To rectify the defective, extra 60,000 we are going to incur. If the old employees, that wouldn't have happened at all. Settlement cost 237,880. Recruitment cost 140,000. Cost of training 161,950. Total cost 8 lakh 13,000 plus 60,000 plus 237,880 plus 140,000 plus 161,950. Around 14 lakh 12,830 is what we are losing. 14 lakh 12,830. Done. Next. The following information is given by PQR Limited. Sales and this one they have given. You know that change in sales, that is 60 lakhs. Change in profit, that is 15 lakhs. Will give you PV ratio. Change in profit divided by change in sales is nothing but 25%. PV ratio is 25%. Now I can apply it to any level. Let's say 240 lakhs. 2 crore 40 lakhs into 25%. 60 lakh is my contribution. Now in that 11 lakh 20,000 is profit, means around 48 lakh 80,000 is fixed cost. Correct. So break even will be 48 lakh 80,000 divided by 0.25. 1 crore 95 lakh 20,000. It is estimated that variable cost will go up by 5%. Fixed cost will be reduced by 480,000. Selling price will remain constant. Calculate the sales volume to earn the profit of 15 lakh. Guys, now what they are telling? 24-25. Your sales price will remain constant. Now try to understand. 75% is variable cost. What they are telling? It will go up by 5%, which means variable cost will become 80%. However, selling price remains same, they are telling, which means PV ratio will be 20%. New PV ratio will be 20%. Fixed cost will be reduced by 480. Right now, fixed cost is 48 lakhs minus 480,000. So fixed cost to be recovered is 44 lakh. After fixed cost recovery, I have to make the profit of 15 lakhs. Around 59 lakh I need a contribution, that is 20% of sales, which means sales should be 2 crore 95 lakhs. Sales should be 2 crore 95 lakhs. And this is one of the very important theory question. Feedback control and feed forward control. Feedback control and feed forward control, one of the very important problem. I mean theory question. Keep that thing in mind. Treatment of idle time they are asking, one of the important theory here. The setting up time of the machine in case of direct workers A, normal idle time, you are going to add it to the cost. Normal break time for lunch, normal idle time, add it to the cost. Time lost due to breakdown of machine, abnormal idle time. That was your May 24. Now we are left with just two more papers, that is September 24 and Jan 25. Okay. Now we'll be looking at September 24 paper. Sagar Limited, an oil refinery, uses, see, this is MCQ question. So one by one we can see. Equivalent units of material and material cost per unit. First one, FIFO. Opening WIP 12,000 is there. Material wise 100% completed. Great. Introduce this 74,500. Unit scrapped is 1,900. Closing WIP is 2,600. Rest of the units were transferred to next process. So try to understand. Total 12,000 plus introduce 74,500. In that 1,900 is scrapped. 2,600 is closing, which means around 82,000 is what we are transferring to next process. In this 82,000, 12,000 is of opening, which means 70,000 is of during the period. So 70,000 and our completion is 100% relating to this. So equivalent material is 70,000. Done. Next, normal loss. Normal loss is 2% of the total input. Total input is 86,500. $1,730. Relating to that, nothing. So abnormal loss 1,730 minus 1,900, 170. Material wise 100% complete, so 170. Closing, this is transferred. Closing 2,600, 100% material wise 2,600. $70,000 plus 170 plus 2,600, 72,770. Now Option C. Price also we can check. How, sir? How much is introduced? 4,76,465 and scrap recovery is there. How much? 2 rupees per unit. Normal loss is 1730 into 2. 3,460. 476 465 minus 3,460 gives you 473,005 divided by 70 to 770, 6.5. Option C. Option C. Equivalent unit of labor and overhead. Equivalent unit of labor and overhead. Guys, first up, transfer to next process. Before that, transfer to next process is 82,000. In that, 12,000 is of opening. Correct. For that, 20% is processed during the period. 2,400 is for the period. Equivalent units. Remaining 70,000, in that 100% is also during the period only. Normal loss 1730, abnormal loss 170, degree of completion labor and overhead 70%. So 170 into 70%. 119. Closing 2,600 and closing wise 60% it is. 1560. So the equivalent units will be 2,400, 70,000, 119, 1560. 74,079. Cost will be they are asking 74,079. Option B. However, cost also you can check once. How, sir? 370, 395 plus 296, 316 divided by 74,079. Rupees 9. Matching. Value of the abnormal loss to be shown in the process account. Very simple. I know material wise how much it is. Material wise per equivalent unit 6.5. So abnormal loss material wise 170. So 170 into 6.5 M plus labor wise equivalent unit is 119. So 119 into per unit it is rupees 9 M plus MRC 2176. Option A. Value of the unit transfer to next process. Value of the units transferred to next process. Guys, material wise 70,000 into 6.5 M plus already there was total cost of 166,200 M plus labor and overhead wise again 70,000 plus 2,400. Next process transferred equivalent units are 72,400 into 9 M plus MRC 12,72,800. Option D. Value of closing WIP. Closing WIP material wise 2,600. So 2,600 into 6.5 M plus 1560 into 9 M plus MRC 30,940. Option C. Simple question. Next, one more case is there. FW Limited manufactures blah 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 blah. First, they are asking calculate per unit cost of material using average price method. Using average price method, guys. 4,800. Trade discount 2% on purchases. 4,800 into 2%. 96. We should reduce. Total duties 8% on purchase price. 4,800 into 8%, 384. Insurance charges 62,000 per year. Unit purchased during the year 60,000. So 62,000 divided by 60,000, 1.03. We just show it here only instead of sitting and solving this. They haven't given solution for this. Fine, no worries. Now listen. Units purchased is 60,000. Yes. Opening we had 5,000. Closing we had 4,500. 60,500. So we had an insurance of 62,000 for 60,500 units. On an average 0.12, you can tell that way. Next, units purchased during the year is 60,000. Let it be. Opening stock 5150 per unit. Okay. Closing 4,500. First, what they are asking, calculate the per unit cost of material using average price method. Guys, new material, how much it is? 4,800 minus 96 plus 384 plus 1.03. Around 5,090 plus opening was 5,050. 5120. Almost 5120, which is basically 5,119. They're getting it as 5,100. $4,800 minus 2% plus 384. Let it be. Let it be, that we'll see later. Now, coming back to the question, minimum stock level they are asking. Minimum stock level is nothing but reorder level, that is maximum into maximum minus average into average. Reorder level, that is maximum into maximum minus average into average, will give me the minimum stock level. Danger level, 2 weeks they are telling here. I'm going to take the average into 2 weeks. I will get the danger level. Calculate the number of days for which average inventory will be held. So how many days on an average inventory will be held. Basically calculate inventory turnover ratio and divide it by 365. 365 divided by inventory turnover ratio will give you how many days it is held. All these things, amount to be abnormal loss during storage to be transferred to the costing P&L, how much should be transferred. So due to normal wastage, abnormal wastage 40 units is there, no? For 40 units, how much you should transfer, they are asking. 10 into 5,000. That is 2 lakh 4,000. If you take the average cost as 5,100, it will be 2 lakh 4,000. Okay. Now, PS Limited is facing a downfall in its demand. Marketing team has suggested to reduce the selling price by 5% to compete in the market. Okay. Variable cost is 76% of the current selling price. You are required to find out the PV ratio, not PN, PV ratio after reducing the price by 5%. Guys, now let's say selling price is 100, which means variable cost is 76. They are telling, so now we are making a PV ratio of 24%. Now they are telling reduce it by 5%, which means bring it to 95. Just by changing selling price, our variable cost won't change. That will be 76 only. So it will be around 76 minus 95, 19. 19 divided by 95 into 100, 20%. 11th one, A. 11th one, A. In the automotive machine manufacturing sector, a component is manufactured. The EOQ for the component is 1500 units. The cost of placing an order is 100. Carrying is so much. The cost per unit of component. Calculate the annual demand for this specification. So EOQ they have given 1500 is equal to square root of 2 into annual demand. I don't know. I will take it as A. O we know. How much? 100. Carrying cost is 10% per annum, which is 2 rupees. Now 1500 into 1500, because square 22 lakh 50,000 into 2, 45 lakhs, divide by 100, divide by 2, 22,500. Option D. In a mutual project, both Raj and Bhuvan are contributing their efforts using identical materials. Raj receives a bonus based on the Rowan plan, while the Halsey determined a Bhuvan's bonus. The standard time allocated for a project is 150. Raj completes the project in 90 hours, while Bhuvan finishes in 120 hours. The normal wage rate of Raj is 30. The total earnings for both the workers are equal. They are telling total earnings of both the workers are equal. They are asking you to calculate the normal hourly wage rate paid to Bhuvan. So try to understand. First, calculate the earnings. Calculate the earnings of whom? Raj receives a bonus. The standard time allocated. Raj completes the project. Whose rate they have given already? Raj they have given. Calculate the earnings of Raj, guys. Very simple. 30 into Raj, the standard time. Raj completes it in 90 hours. Plus time saved is how much? Allocated is 150. He has taken 90, which means 60 divided by 150 into 90 into 30. 30 into 90 m plus 60 divided by 150 into 90 into 30. M plus around 3780. That is 3780 is the total earnings. Now they are telling for Bhuvan also it will be 3780, but plan is halsey, which means Bhuvan finishing it in 120 hours. Whereas hourly rate we don't know. I'm going to take it as hourly rate plus half of time saved 30 into hourly rate, that is giving 3780. That is guys 120 hourly rate plus 15 hourly rate is equal to 3780. 3780 divided by 135, 28, option D. 13th one, option D. See, all these earlier they used to give for 3 marks, 4 marks question. Now they are easily asking in MCQs. So you guys should know how the examiner thinking now. How easily they can make you guys sweat. On 1/4/2023, number of employees were 150. During the year, 30 workers resigned and 5 workers are discharged. So, separation is 35. Due to resignation and discharge, 15 workers were replaced. For the year, labor turnover by separation method. Basically, 35 divided by 150. Or wait, closing is how much, sir? 150 were there, opening, correct? 35 went out, 15 join in, 130. So opening was 150, closing is 130, divided by 2, 140. So 35 divided by 140. %25. A chemical is passed through 3 processes and the output of process 1 is transferred to process 2. The input of process 1 are 58,500, output is 55,200, normal loss is 2%, rest is abnormal. You are required to calculate the cost per unit cost of output of process 1 account if the total expense is 6,87,960. Are we recovering any scrap recovery? No scrap recovery. Divided by how many units? Input is 58,500 minus normal loss is 2% of 58,500. 1170. 687,960 divided by MRC 57,330 will give you rupees 12. B. Language achievers are renowned institutes specializing in a TOEFL preparation has secured a spacious hall for 20,000, that is rupees 20,000 on a weekly basis with a seating capacity of 250 students. Instructor, highly qualified and experienced, is compensated generously with the honorarium 1,500 per lecture. Additionally, he receives a reimbursement for travel expense of 200 per day, along with the refreshment of 1,500 per week to ensure his comfort and focus during teaching session. Administrative and miscellaneous expense covering essential utilities and materials are 500 per week. Language achievers has meticulously planned its curriculum, scheduling batch of 2 lectures per day, 5 days a week for 30 weeks, ensuring comprehensive coverage of course. Calculate the total cost. Basically guys, how many days a week? 5 days a week. How many lectures? 2 lectures. And how many weeks in total? 30. Total 300 lectures. 300 lectures, and the instructor will get 1,500 per lecture, which will come to 450,000. which will come to 450,000. Done. Next, reimbursement of 200 per day. So 200 into how many days? 5 days a week for 30 days. 150 days. So 200 into 150. Sorry, 200 into 150. 30,000. That is your travel reimbursement. 1,500 per week. So how many weeks? 30 weeks. 45,000. All 20,000 on weekly basis. 20,000 into 30. 6 lakhs. 6 lakhs. Done. Anything else? Refreshment done. This is 500 per week. 500 into 30. 15,000. 15,000. Done. These are the total cost. 4,50,000 plus 30,000 plus 45,000 plus 6 lakh plus 15,000. 11,40,000. Total cost is 11,40,000. Determine the minimum fees per student in the batch to cover its cost if the batch is fully occupied. That is, to cover the cost, if the 250 students were occupied, 11,40,000 divided by 250. At least 4,560 we should charge. Calculate the fees to be charged from each student if the batch is 80% filled, which means 250 into 80%. Around 200 students are there. Okay. And we want to achieve a profit margin of 25% on fees, which means on cost 33.33 percentage. 11,40.333333 percentage. 15,20,000. 15,20,000 we have to recover from the 200 students. We should charge 7,600. Done. Next. Prepare a reconciliation to arrive at a net profit or loss as per cost accounts. So start with the financial accounts. How much? 225,000. Preliminary expense written off. Add back. Because in costing it is not written off. Factory overhead overcharged in costing. You charge less expense, now charge more expense. Reduce profit. Expense on issue of shares in financial accounts. There is no expense as such. Add it back. Undervaluation of closing stock in cost accounts. So there they didn't show so much profit. Reduce it. Your profit. Interest on bank deposit in financial accounts. There is no such income there. Under recovery of admin overhead. They're under recovery, which means 25,000 less expense. You also decrease your expense, increase your profit. Notional rent charged in the cost accounts. Here also treat it as an expense. Under recovery of selling, add 35,000. Bad debt recovered in financial accounts, add 50,000. 225,000 plus 35,000 minus 20,000 plus 30,000 minus 65,000 minus 60,000 plus 25,000 minus 30,000 plus 35,000 plus 50,000. 225,000. 225,000. $225,000 plus 35,000 minus 20,000 plus 30,000 minus 65,000 minus 60,000 plus 25,000 minus 30,000 plus 35,000 plus 50,000. Second. September 24. $35 add, 20 less, 30 add, 65 less, 60 less, 25 add, 30 less, 35, 50, 35. Oh, it's bad debt, not a bad debt. Sorry, it's not a bad debt. It's bad debt recovered, guys. Bad debts recovered, which means you showed it as an income. Sorry, not bad debt. It's a bad debt recovered. So you showed it as an income. So you should reduce your profit because it's not your income. JC Limited has a production capacity of 80,000 units. Presently, company produces 60,000 units, which means 20,000 units are idle. Cost structure, material so much, labor so much, variable overhead so much, which will come to rupees 12. Total fixed cost is 3 lakh per annum. Present selling price is rupees 20 per unit in the month of January 2022. Company receives an offer from a Japanese client to supply 20,000 units at the price of 14 with the additional shipping cost of 8,000. On the basis of the changes in the profit, advise whether the company should accept the offer or no. Very simple, guys. Any of fixed cost is not going to change, and you don't have to sacrifice anything because you already have that excess capacity level, which means to produce that 20,000 extra, all we are going to incur is a variable cost, that is 6 rupees material, 4 rupees labor, 2 rupees variable, rupees 12. Okay, for 20,000 units, rupees 12 for 20,000 units, around 2,40,000. Also, they are asking us to incur one shipping expense of 8,000. So total 2,48,000 is extra cost what I am going to incur. However, what is the extra revenue I am going to make? 20,000 into 14, 2,80,000, which means around 32,000 is extra profit I am going to make. So better accept the offer. Accept the offer. Will you advise different if the customer is local one? Of course, yes. Why? Because if I give one local customer at the rate of 14, now whoever is taking at 20 rupees, they will also ask for 14 rupees. So for local one, we are not going to give it at 20 rupees for sure. Sorry, 14 rupees for sure. If the Japanese client offers for supply of 30,000 units to a price of 14, that is part of supply order is not accepted, which means you cannot tell, okay, 30,000, no sir, I have a capacity of 20,000, I will satisfy 20,000. No, either you should take whole 30,000 or you should ignore whole 30,000. Shipping cost is treated as a variable cost. Analyze the impact on profitability. Now, analyze the impact on profitability they are telling. Guys. Rupees 8,000 was for 20,000 units. If you treat it as a variable, for 30,000, how much? It will be rupees 12,000. Correct? Done. Now try to understand. To local, I am selling 60,000 units, but here onwards I should sell only 50,000 units. I should sell only 50,000 units. Why, sir? Because the 10,000 extra units, my Japanese client, if I want to satisfy, then I can sell only 50,000 to local. So that is 12 rupees is variable, contribution is 6 rupees. Contribution is 6 rupees. So 50,000 into 6, which will come to rupees 3 lakhs. Done. What about to do this thing? Japanese 30,000 into how much I am making, guys? 8,000 divided by 20,000 per unit 0.4 it is. So my variable cost will be 12.4 minus 14. Contribution is 1.6. 30,000 into 1.6. 48,000. Sorry, not 1.6. 48,000. Total contribution is 3,48,000, whereas fixed cost is 3 lakh, which means we'll make the profit of 48,000. We'll make the profit of 48,000. If we don't accept the offer, then if we don't accept the offer, we will be selling 60,000 units to the local market at a contribution of contribution for local is 6 plus 4 plus 2, 12, 18, 8, not 6, sorry, 8. So 50,000 into 8 is 4 lakh. 1,48,000. If at all I don't go for this, then I can sell 60,000 units at the rate of rupees 20, which means again, of course, I am going to make 8 rupees as my contribution. 60,000 into 8, 4,80,000 minus fixed cost is how much, sir? 3 lakh. Around 180,000. If at all I don't accept the offer, I will be able to make 180,000. If I accept only 148, better don't accept. So will not accept it. First we will accept. Second one, of course, we are not going to. Third one, profit will decrease by 32,000. So, because see here, I showed you know here. $148 if you accept. If you don't accept 180, 32,000 you will lose. So better don't accept. This is cost sheet question. This cost sheet question, in the cost sheet they have given works cost, here they have given prime cost. That's the only difference. I'm not going to solve it. But here you should be very careful in this one. The lucky draw and all, the consolation prices will be 4, 5 and all. So you should multiply it, not only directly one unit you can take. This is again direct question from your material. The only question is there relating to treatment of overtime. The same question they have asked. Flexible budget, guys. I'm not going to do that flexible budget and all now because it's already late. You guys have to study also. No. BG company produces a standard product and sold in the packet of 10 kg. The standard cost card per pack is as follows. Direct material 4 kg. So 10,000 standard. For 10,000, 4 kg of A, 8 kg of B, 6 hours of labor. Company manufactured and sold 1,600 packets in the month. So For 10 kg if it is 4, for 10 if it is 4, for 1600 how much? A and B. Standard quantity 640. For 10 it is 8. For 1600 how much? 1280. 1280. Actual quantity produces a standard product and sold in the packet of 10 kgs. Okay. Oh, it is per packet. Sorry. Per packet. So, try to understand. I took the input what is there inside packet. No, you should not take that because they have given per packet here. 1600 per packet 4 kg. So, for 1600 packet 6400. B per packet 8 kg. So, for 1600 12,800. Actual quantity 7,000 and 12,500. Revised standard quantity will be total of actual quantity 19,500 in the ratio of standard 1:2. 19,500 divided by 3. 6,500, 13,000. That will be your revised standard quantity. Standard price 50 and 60. Actual price 40 and 45. This is all relating to material. Coming to wages, they have given only one type of wages, 6 hours. So standard hours will be 1600 into 6, 9600 standard hours. But actual hours there is 10,000, that to different employees, and upon that 5% is abnormal idle time. So this is actual hours paid, not even actual hours worked. Accordingly, we are going to calculate that. Allocation of expenses, comprehensive machinery, do it. Baby Rose and Baby Lily. This is ABC. Oh, this one. See here. Decision making question. The company produces and sells two variants of the organic shampoo, Baby Rose and Baby Lily. Sales and cost data for both the product is there. Current demand 4,000 and 3,000. Production capacity is 7,500 and 6,000, which means we are producing well within the limit, which means we are not even touching 100% of our capacity. Selling price is 600 and 750. Variable cost, direct material 20 per liter, which means how many liters of direct material we are using? Here we are using 8 liters. Here we are using 10 liters. Done. Other variable cost 270 and 350. Fixed is 5 lakh and 450,000 for Baby Rose and Baby Lily. Production manager is informed that 1 lakh liters of material available for a production. A dealer has approached the company and proposed to purchase both the products at the existing selling price, which are to be produced by utilizing the remaining unused material. However, he has insisted that all bottles must have a packing of eco-friendly packaging, which will cost you extra 10 rupees. That is not like 10 rupees extra per bottle will be the thing. Required. Prepare a detailed statement showing overall contribution and profit of the company after acceptance of the dealer's proposal. First, just check whether you have enough material to produce total requirement. Guys, total. He is ready to buy whole 7,500 bottles. Okay. which takes 8 liters of material to produce a bottle. 60,000 liters is required. Okay, 6,000 bottles of this one is required, and which takes basically 10 liters. 60,000, 120,000 liters. But the best part is we have only material of 1 lakh liters. What is the moral of the story, sir? Key limited constraint or key limiting factor. In that scenario, what we should do, sir? Contribution per key limiting factor. Based on that, we'll decide which to produce more. So, guys, try to understand. Baby rose. Total variable cost is 160 plus 270, 430. Selling price is 600, 170. Contribution per unit is 170. Here it is 750 minus 550, 200. Per liter, how much, sir? 170 for 8 liters, which means 21.25 per liter. Whereas 200 for 10 liters, so rupees 20 per liter. So which is better? Baby rose is better. Second priority should be baby lily. Okay. Now already current demand and sales are there. 4,000 units we are producing already. 8 liters it consumes. $32,000 liters. Okay. Next. 3,000 bottles consumes 10 liters. 30,000 liters. 62,000 liters. Which means around 38,000 liters are pending. In that, guys, 3,500 units. If it takes 8, which means around 28,000 liters could be used. Around 10,000 more liters are there. In that, I can produce 1,000 units of baby lily, which means my production will be 7,500 bottles of baby rose. Okay, and 4,000 bottles of baby lily. Done. Now contribution will be how much, sir? Guys, try to understand this. I am going to divide it into two parts. Why, sir? You will get to know. In this 7,500, normally I am able to sell 4,000, 3,500 to this dealer. In this 4,000, 3,000 to normal, 1,000 to dealer. Guys, in the first case, contribution is 170. But in the second case, contribution will fall to 160. Why, sir? Because we have to give the extra bottle cost of 10 rupees due to eco-friendly bottle. Now here it is 200 and 190. Accordingly, you can find out a contribution minus fixed cost 5 lakh and 450,000. You will get the profits. This theory question is important. Controllable variance, uncontrollable, budget manual, performance budget, budget period. Okay, go through that. With that, we have completed, guys, September 24 question paper, and January 25 I already completed, and the video is available in the ArivuPro YouTube channel. Okay, you can go through that once if you want. That is, I will show how to check. All you are going to do is go to YouTube. Just open ArivuPro channel. So here ArivuPro Academy, live will be there. No, here if you go, yesterday's live you can find it here, and somewhere this costing paper review is there. No, costing paper review, you can watch that particular video for your 2025 January paper. With that, we have completed discussion of the papers, and will meet you guys after exams. Yes, in the felicitation. Yes. Chalo guys, study well. Don't waste your time. Just give your best, one paper at a time. So keep studying, work hard. All the best for your exams. Bye, 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 bye.